just wanted to start off with one thing which, we actually, when we were working on the report, etc., was actually wondering that from a private equity ecosystem point of view, and by this is to both of you, right? I mean, so feel free to, pick it up as it's appropriate. Which are the sectors in the tech ecosystem which you think is still underrepresented? Let's say the number of deals, let's say which you get in a month or a quarter. But sometimes you wonder, okay, you wish certain subsegments, opportunities are over-indexed, right? Which are subsegments which I think is underrepresented currently?
I'll just answer from the top of.
ICICI Securities India Investor Conference 2026. Our theme for this year is India Rising, the next chapter. A new phase of India's growth story is unfolding at the intersection of capital, technology, and industrial transformation. From capital markets and financial services to manufacturing, infrastructure, technology, and artificial intelligence. The conversations over the next 2 days will examine how India is positioning itself in an increasingly dynamic global environment. To formally welcome all our distinguished guests, it is my privilege to invite a leader who has been instrumental in shaping the strategic direction of ICICI Securities. Please give a warm round of applause in welcoming Mr. T.K. Srirang, Managing Director and Chief Executive Officer, ICICI Securities. Sir, I'd love to have you on stage, please.
Good morning, distinguished ladies and gentlemen. It's my privilege to welcome you to the ICICI Securities India Investor Conference 2026. This year's theme, India Rising, the next chapter, is both timely and intentional. It reflects not just where India stands today, but a transition that's clearly underway, with growing confidence and direction. We are honored to be joined by one of the most respected voices shaping India's financial and economic landscape. It's a privilege to welcome our chief guest and our keynote speaker, Sri Tuhin Kanta Pandey, Chairman of SEBI. Sir, under your leadership, India's capital markets have strengthened further with a continued emphasis on transparency, investor protection, and market integrity. Your balanced approach, encouraging innovation while maintaining robust regulatory standards, along with efforts to streamline processes and ease congestion without compromising safeguards, has reinforced the foundations on which India's capital markets continue to grow. To the leadership teams of over 130 companies present here, thank you for your partnership and for engaging with us over the next 2 days. And to our investors, policymakers, entrepreneurs, and industry leaders, both from India and globally, your presence reflects a shared engagement with the India growth story. We chose the theme India Rising not as a statement of arrival, but as a reflection of a transition. Across sectors, India is moving with greater consistency, from policy intent to execution, from informal to formal, and from domestic relevance to deeper global integration. At the same time, this remains a work in progress, with areas such as manufacturing depth, technological capability, and global competitiveness continuing to evolve. This combination of visible progress and future potential makes the India story both compelling and worth engaging with in depth. India remains one of the fastest growing major economies globally. Yet at the same time, the nature of growth is evolving. From advanced manufacturing and electronics to digital platforms, financial services, renewable energy, and emerging technologies such as artificial intelligence, the breadth of opportunity today is far wider than before. What we are seeing is not a single sector story, but a multi-dimensional transformation. Over the next 2 days, this conference is designed to reflect that breadth. Alongside corporate interactions, we have curated discussions bringing together policymakers, industry leaders, and investors. These conversations will span key themes shaping the next phase of growth, from capital allocation and the evolution of India's investor base to implications of AI, the rise of manufacturing ecosystems, and the continued expansion of digital and consumer businesses. More importantly, forums like this enable dialogue, bringing together capital and enterprise in a setting that encourages thoughtful exchange and long-term thinking. At ICICI Securities, we aim to be a bridge, connecting ideas with capital, ambition with execution, and investors with opportunity. This conference reflects that commitment. As we begin this conference with the traditional lighting of the lamp, a symbol of knowledge and new beginnings, I invite all of you to engage openly, challenge perspectives, and build conviction through dialogue. India stands at an important intersection where strong policy frameworks, deepening capital markets, and rapid technological adoption reinforce each other. Together, they are shaping the next phase of India's growth. If the last decade was about strong foundations, the decade ahead will be about execution, scale, and global relevance. The opportunity is significant, but so is the responsibility to translate it into sustained outcomes. We look forward to an engaging and productive 2 days ahead. Thank you, and once again, a very warm welcome to all of you.
Thank you so much, sir. Ladies and gentlemen, our keynote speaker this morning has held several important leadership positions within the Government of India, including Finance Secretary, Revenue Secretary, and Secretary of the Department of Investment and Public Asset Management. Today, as the chairman of SEBI, he oversees one of the world's most dynamic and rapidly evolving capital markets at a time when investor participation, innovation, and market depth continue to expand. I invite our chief guest, Shri Tuhin Kanta Pandey, Chairman, Securities and Exchange Board of India, to please come up on stage. May I also invite Mr. Rakesh Jha, Chairman, ICICI Securities, to kindly join us on stage to felicitate our guest. Truly an honor to have you with us, sir. Ladies and gentlemen, you can keep the applause going. Ladies and gentlemen, this is that moment that we all have been waiting for. We also have the lamp lighting ceremony, which is coming up in a few minutes from now. But before that, as a token of appreciation for our chief guest, here's a bouquet. I'd request Mr. Jha and Mr. Pandey to please stay back on stage. Every meaningful journey begins with a moment of purpose. To mark the commencement of ICICI Securities India Investor Conference 2026, we begin with the traditional lighting of the ceremonial lamp, symbolizing knowledge, wisdom, and progress. May I now request Mr. Sandeep Bakshi, Managing Director and Chief Executive Officer, ICICI Bank, and Mr. T.K. Srirang, Managing Director and Chief Executive Officer, ICICI Securities, to kindly join us on stage for the lamp lighting ceremony. A divine moment to receive the blessings from the forces above to start this momentous event. Ladies and gentlemen, a warm round of applause for our esteemed dignitaries as well. May I please request Sri Tuhin Kanta Pandey, Chairman, SEBI, to deliver the keynote address. I request the rest of the dignitaries to kindly take their seats as well. Ladies and gentlemen, Sri Tuhin Kanta Pandey, sir, I request you remain on stage. Ladies and gentlemen, we have a lineup of speakers where there's going to be exchange of information, insights, moments that you're going to be cherishing for the rest of our lives. Lovely to have you with us, sir. I request you to speak to our esteemed guests.
Shri Sandeep Bakshi, MD and CEO, ICICI Bank. Shri T.K. Sairang, MD and CEO, ICICI Securities. Leaders from finance, business, media. Ladies and gentlemen, a very good morning to you, all of you. It's a pleasure to address this distinguished gathering of market participants, issuers, investors, and leaders of our financial ecosystem. Let me begin with a simple question. When we say India rising, what does it really mean for each one of us in this room? Is it about higher GDP numbers, better infrastructure, or is it something deeper, a shift in how India saves, invests, and creates wealth? Because at its core, India's growth story today is not just about economic expansion, it's about formalization. It's about the financialization of savings, and importantly, it's about trust in institutions. We are living in uncertain times. Ongoing geopolitical developments, including war in West Asia, continue to affect inflation, trade flows, exchange rates, and external balances. Many economies are navigating uneven recoveries. And yet, amidst this uncertainty, India stands out for its resilience. India remains one of the fastest growing major economies, with growth estimated at 7.7% in FY26. However, due to the headwinds, there is some moderation in F27 growth estimates and increased risks of higher current account deficit and inflation. India's growth is anchored in domestic consumption, strong public investment, and improving private sector participation. Public capital expenditure has nearly doubled as a share of total expenditure, from about 12% in FY21 to 23% in FY26. Rapid improvements in physical connectivity, such as roads, railways, ports, airports, and rural and urban mobility, act as important growth enablers. Our energy transition is accelerating, with more than half of installed capacity now coming from non-fossil resources. And our digital public infrastructure has become a global benchmark, enabling inclusion, reducing costs, and strengthening governance. Investments in telecom connectivity, data centers, supply chains for electronics and semiconductor manufacturing, and battery storage have become building blocks for a digital AI economy. So yes, India is rising. But growth alone doesn't create prosperity. Growth must translate into opportunity into investment, and investment into wealth creation. This is where capital markets play a defining role. They are not merely reflecting India's growth, they are enabling it. They connect household savings with enterprise. They bring global capital into domestic opportunity. They convert economic momentum into investable assets. And the scale of this transformation is significant. In FY26, our equity issuance crossed 4.5 trillion rupees. IPO activity remained strong with 366 issuances, raising about 1.9 trillion rupees. Corporate bond issuances exceeded 9 trillion rupees. Market capitalization has grown from 69% of GDP a decade ago to about 128% today, notwithstanding some corrections which have taken place over the year. AIF investments have grown more than fivefold in recent years. We now have around 145 million investors in the securities market, growing at over 20% annually. Mutual fund assets have expanded from 12 trillion rupees to over 80 trillion rupees. This expanding base of investors is also reflected in how households are allocating their savings. Household participation in capital markets has been rising steadily. Household financial savings to GDP have increased to 21.7% in FY25 from around 20% in FY23. A revised methodology introduced by SEBI using granular market-level data and a wider coverage of instruments now presents a more accurate picture of this trend. Together, these developments point to a clear shift. Capital markets are increasingly becoming a core avenue for household savings and wealth creation. Such broad-based participation also places a greater responsibility on market design and regulation. But markets of this scale do not evolve on their own. They require a framework that balances ease of access, efficiency, and trust. At the regulatory level, our approach has been consistent: optimum regulation. Regulation that protects investors, preserves market integrity, and enables growth. Because growth becomes investable only when access is simple, processes are predictable, and markets function smoothly. Let me briefly touch upon this approach, how this approach has translated into action. Let me first come to capital formation. We have significantly improved the efficiency of capital raising. IPO timelines have been reduced, rights issues have been made faster. Listing norms have been rationalized to enable large issuers to list without immediate dilution pressures. We have also enabled companies undertaking reverse flipping to access markets more seamlessly, including allowing founders to retain ESOPs granted prior to IPO filings. Anchor investor norms have been broadened to allow participation from large FPIs operating multiple funds, helping deepen institutional participation. On the debt side, the corporate bond market architecture has been strengthened. The electronic book provider platform has been expanded to include issuances by REITs and InvITs, improving transparency and efficiency. In pursuance of budget announcement, a working group is sorting out operational details to introduce market-making framework to improve liquidity in corporate bond market. Additionally, SEBI and RBI are working together to introduce derivatives on corporate bond indices. Easier access for global capital. We have taken several steps to facilitate foreign investor participation. The Swagat framework provides a single window, streamlined onboarding experience for trusted investors. Regulatory requirements for FPIs investing in government securities have been eased. Processes have been simplified through standardized forms, digital signature-based document submission, and tracking mechanisms. We are working with custodian banks and RBI for further substantial reduction in the timelines for FPI registration and onboarding. Operational efficiency will also improve through measures like net settlement of funds, reducing costs and operational friction. Complementing these, broader policy measures such as latest tax exemptions for FPIs on government securities and removal of certain investment limits in corporate debt will further facilitate capital flows into debt market. Market structure reforms such as enhancement to closing auctions and block deal frameworks have improved price discovery and liquidity, especially meeting the concerns of the FPIs. Let me come to alternative investment ecosystem. In the AIF space, we have introduced a calibrated facilitative framework. We have enabled regulatory flexibility for accredited investor-only schemes and permitted encumbrance structures in infrastructure investments to support long-term financing. A fast-track mechanism has been introduced to reduce time to market for fund launch. We've introduced lighter compliance for inoperative funds, flexibility in retaining liquidation proceeds in specific scenarios, and dematerialization of AIF units and investments. Equally important has been our focus on ease of doing business for intermediaries. We have comprehensively reviewed the stockbroker regulations, making it simpler, clearer, and more aligned with evolving market practices. Operational flexibility has been enhanced, including allowing diversifications into activities regulated by other financial sector regulators. Compliance has been streamlined through initiatives such as common reporting platform called Samuhik Prativedan Manch, eliminating duplication across exchanges. The penalty framework has been rationalized to ensure consistency and avoid multiple penalties for the same violation. We have also introduced a calibrated framework for addressing technical glitches, focusing on material risks while easing the burden on smaller brokers. The objective across all these reforms is simple: reduce friction, improve clarity, and enable growth without diluting safeguards. But even the best frameworks cannot substitute for trust. And this is where intermediaries play a defining role. Stockbrokers in particular are the face of the market for millions of investors. They are the first point of contact. They interpret complexity. They shape investor experience. And with that comes responsibility. Responsibility to ensure robust onboarding through proper KYC, responsibility to prevent misuse and fraud, responsibility to provide fair, transparent, and prompt service, and above all, responsibility to act with integrity, avoiding conflicts of interest and mis-selling. Because ultimately, investors experience the market through intermediaries. As markets evolve, regulation must evolve with them. We are currently reviewing the framework for variable net worth requirements for stockbrokers so that capital requirements better reflect operational scale and risk. We are examining improvements in price discovery, particularly through the pre-open call auction mechanism for IPOs and relisted securities, to ensure more stable and efficient market openings. We are also working towards easing compliance requirements for research analysts, including rationalizing requirements such as call recording obligations in institutional interactions. For mutual funds, we are proposing a more practical framework for the use of intraday borrowing, not just as a contingency tool, but as an efficient mechanism for managing temporary liquidity mismatches. As we move forward, it may help to remember one simple anchor. Every reform we design, every system we build, every transaction we enable, ultimately reaches one person, the investor. If the investor feels informed, protected, and fairly treated, confidence will follow, participation will deepen, and markets will continue to grow on a strong and sustainable foundation. And that's the direction we should all strive to build towards. Thank you. Jai Hind.
Thank you so much, sir. Truly an honor to have you with us. Thank you, Shri Tuhin Kanta Pandey, Chairman SEBI, for your valuable insights and for setting the tone for the conversations that will follow over the next 2 days. I now invite Mr. Prasanna Balachandar, Executive Director and Head of Investment Banking and Institutional Equities, ICICI Securities, to deliver the thank you note.
Good morning, ladies and gentlemen. On behalf of ICICI Securities, I would like to thank Shri Tuhin Kanta Pandey for taking the time to join us today and for sharing his perspectives with the entire investment community. As India's capital markets continue to expand in scale, participation, and global relevance, the importance of trust, transparency, and market integrity has never been greater. Sir, your address served as a very timely reminder that strong markets built not only on capital and innovation, but also on sound governance, investor confidence, and robust institutions. So your emphasis on creating markets that are resilient, efficient, and investable for long-term capital resonates deeply with everyone gathered here today, from investors and entrepreneurs to business leaders and market participants. The conversations over the next 2 days, sir, will focus on India's next chapter of growth, and also happy to tell you that most of the themes that you had mentioned is forming a significant part of our discussions with investors and corporates over the next 2 days. Your remarks have also provided the perfect foundation for those discussions by highlighting the role that a strong, credible, and well-governed capital markets play in enabling that journey, and the corporate governance that is the responsibility of an intermediary truly stands out. On behalf of ICICI Securities and everyone present here, sir, I'd like to express our sincere gratitude for your time, your insights, and your continued contribution to the development of India's financial markets. Thank you once again, sir.
Thank you so much, Prasanna, sir, as well. Ladies and gentlemen, a warm round of applause for our dignitaries here as well. Thank you. This is like an epic turnout here. Before we introduce our next session, I would like to announce that there was a change in the schedule due to some circumstances. Now, as India advances towards becoming one of the world's largest economies, the question is no longer whether growth will come, but how capital will be allocated to capture it. The next decade will be shaped by a powerful intersection of market cycles, investment behavior, policy evolution, and the continued deepening of India's capital markets. Understanding these forces requires perspectives from both sides of the table, those who allocate capital and those who help shape the ecosystem in which it operates. To explore these themes, we are privileged to be joined by two distinguished voices. It is my privilege to invite one of India's most respected investment professionals. With over 3 decades of experience spanning across investment banking, research, fund management, and capital markets, he is widely recognized for his disciplined and often contrarian investment philosophy. His profound impact on value investing and market cycles has earned global recognition. Named CIO of the Year by Asia Asset Management and serves as a vital voice on the Committee on Equity Matters at AMFI. As Executive Director and Chief Investment Officer of ICICI Prudential AMC, he oversees one of India's largest investment platforms and is widely recognized as India's leading mutual fund and capital market investment guru. Ladies and gentlemen, please join me in welcoming Mr. Sankaran Narayan on stage, please. Ladies and gentlemen, sir will be coming in on stage in a jiffy, but I would love to have him along with a financial market expert with over 3 decades of experience across banking, regulation, and public policy. A former whole-time member of SEBI, he has held leadership roles at Standard Chartered, Deutsche Bank, and Citibank, and continues to contribute to academia and policy discourse through his work at IIT Bombay and the Observatory Group. Please welcome Mr. Anant Narayan, Professor of Practice at IIT Bombay School of Management and former whole-time member of SEBI. Ladies and gentlemen, they should be here in a few minutes from now. But in the meanwhile, leading this discussion is one of India's most recognized business journalists. For the last 3 decades, she has been at the forefront of business reporting and market analysis, moderating some of the country's most influential conversations on economics, policy, and corporate India. Please join me in welcoming Ms. Latha Venkatesh, Consulting Editor, CNBC TV 18. Before we begin this conversation, we'd like to take a moment to welcome Mr. Sankaran Narayan and Ms. Latha Venkatesh to the India Investor Conference 2026. May I invite Mr. Prasanna Balachandar, Executive Director and Head of Investment Banking and Institutional Equities, ICICI Securities, to kindly join us on stage and present a bouquet to our guests. Please give a thunderous round of applause for the formidable force on stage. Truly icons who make India proud. Now I'd request Ms. Latha Venkatesh, ma'am, to begin the conversation.
Thank you for the generous introduction. Naren, Anant, and I are all aware that we have large shoes to fill. We are replacing someone who has taken ill, and Mr. Kamath is not here with us. We wish him a very, very speedy recovery. but this is a very interesting dialogue, a dialogue between practice and policy. The long vision is the topic that we've been asked to discuss. This is kind of an overnight preparation, but my guests are conducting this dialogue on a daily basis, on an hourly basis, between practice and policy. So we should be in for some very interesting conversations. Anant, I'm going to start with you because there is this major policy announcement that came from the Reserve Bank on Friday. We don't have the details yet in terms of how the FCNR deposits are going to be hedged by the Reserve Bank, whether principal and interest will be hedged, and a whole host of other details, how much leverage will be allowed. As well, we don't have details about the ECBs that PSUs have been allowed to raise. But from what we have, and from the fact that you were a key player when the 2013 FCNR deposits were announced, I want you to explain what may be the depositors' interest. People are talking about 50 billion. Is that an underestimation or an overestimation?
No, thanks a lot, Lata and ICICI Securities for having me. It's always a pleasure. And I will take copious notes when Naren is speaking to figure out where to invest next. You're absolutely right. We don't have the details of the swap that the governor announced on Friday. So a lot depends on the fine print that finally comes out. But assume that what was followed in 2013 is also followed now in a sense. The subsidy that has been announced by the RBI is quite substantial. Effectively, what RBI is saying is that it is willing to sell 5-year forward dollars against the rupee at the current spot rate. So if, for argument's sake, dollar rupee today at spot is 95 rupees, RBI is saying, I will also sell you dollars 5 years from today at 95 rupees. Now, the actual market for dollar rupee in the free market, and there is a cross-currency swap market which quotes these things, is between 110 rupees and 115 rupees over the last few days. It's been volatile after the announcement, right? So essentially, RBI is saying, I'll give you a 15 rupee discount for every dollar, or maybe 15 to 20 rupee discount on every dollar. That is an amazing amount of money, roughly equal to 3% per annum running. So it's a huge subsidy, and the back of this subsidy, precisely the kind of leverage trade which happened in 2013 can follow, assuming that the RBI allows for leverage. So effectively what can happen is, banks can offer FCNRB deposits, offer to take deposits at a very high interest rate, let's say 5.5%, because they can swap this 5.5% in dollars into 5.5% in rupees effectively for the principal. We don't know about the interest. And obviously that 5.5% in rupees can be deployed into government securities risk-free at roughly at 7% or so. So you get a clean spread there. At 5.5%, when the NRI sees that number, she can in turn borrow against this deposit at something like 4.5% or so. So imagine the NRI would be in a position to borrow in dollars overseas against the collateral of this deposit at a rate lower than this deposit is worth. Which means on a leveraged basis, and if the same leverage that was followed in 2013 is followed here, 9 times leverage if it is allowed, effectively the NRI can get double-digit dollar return, maybe 14 to 15% return on their core principal. And the risk you're taking is India cross-border risk, which you and I know is close to zero. When has India ever defaulted on a cross-border obligation? So this is an extremely attractive scheme, both for NRIs, if it is followed the same way it was done in 2013, and for the banks raising these funds as well, which means it can be very, very successful. People are saying $40–50 billion. It can easily reach that amount if this process is followed. It might even come to a stage where RBI says, I've got enough, now please stop, before the 4 months are over. So it can be extremement successful.
No, that point is very, very well explained. Not for nothing, he's professor of practice at IIT as well. But Anant, the circular hasn't yet come. So there is this buzz in the market. Are they rethinking? Is the cost too much for Reserve Bank and things like that? the cost is well worth the reward, you would think? How would the central bank think?
See, the essential point that they're willing to take on the entire exchange risk has been made by the governor. What is remaining is principal, interest versus coupon. Will leverage be allowed, etc. So you're right, we have to wait for the fine print. But I started with the caveat. If it follows the same process it was followed in 2013, which means leverage is allowed, and yes, interest will not be hedged, it will still make for very, very attractive, combination of FCNR deposit as well as rupee deposits for the banks, simply because the discount being offered by the RBI is enormous. So as a statement of intent, I think it is extremely strong from the RBI, because it is effectively saying, I am willing to raise money and put my money where my mouth is, and I want to show confidence in the country and build buffers to give comfort to the people that dollar rupee is in good hands.
Well, let me just add my 2-bit. My first question to the governor was exactly this. Is this a copy-paste of 2013? Will banks get CRR and SLR relief for these deposits? And will leverage be allowed like last time? He said yes to all of them. So, the commitment is, as you said, in the statement itself, that the risk will be completely absorbed by the Reserve Bank, entire hedge for FCNR and partial hedge for ECB. This was mentioned in no uncertain terms, but I'm just putting that caveat on the table. But Naren, to your view, now, in terms of how FPIs might react, we got the feeling that even when FPIs were willing to put their toes in, there was this fear that they bring in and the next day the value goes down because of the currency. The currency was becoming self-fulfilling. If that is out of the way, which it looks like in the next few hours, perhaps by end of day we will know. Do you think that the FPI attitude to India, both in debt and equity, is going to be much different?
I think FPI and debt certainly, immediately. And one thing what we have to keep in mind is, and this is learning over the last 20, 30 years, you have to break vicious cycles. So when UTI was in trouble in 90s, they created SUTI and UTI. And no one would have believed SUTI would have created so much money. In 2008, for example, when Ben Bernanke bought warrants in all the banks and said, I'm backstopping all the banks, they made huge money on those warrants. In 2019-20, when, the government supported Yes Bank and made the other banks invest, a lot of people criticized, how can the banks make money? Every bank is sitting on huge profit out of that investment. So what we have learned is when you have vicious cycles, and because today we don't have current account deficit, we have a huge gold reserve, both with the people and the Reserve Bank of India, and still people question dollar rupee. You have to break vicious cycle. There's a cost for the vicious cycle which is very small, which Reserve Bank can afford to break. So that's where it is. So once the vicious cycle is broken, will FPI money definitely look more positively in debt? Yes. Equity is today, there's so many questions, AI, no AI, I mean, what's happening in the world? It'll come, but it's not something where one RBI policy changes equity money. And that is what is very evident at this point of time. But is this a positive development? It breaks the vicious cycle of rupee? Certainly. From that point of view, it certainly does.
Yeah, I mean, we are going to discuss both FPI attitude and our growth and earnings cycle in just a minute. Let's just finish the policy to practice dialogue on the most newsy bits, and I'll come to the larger growth issue. Anant, on the FPI, tax removal on FPI debt, both withholding and capital gains. In your learning and in your understanding, how good is this from an FPI point of view? You must have met many of them during your both trader journey and your SEBI journey. Will this be a huge relief? Will this be a minor relief? What can be the response?
So Lata, I think of the announcements made on Friday, this is probably the most consequential one in terms of medium-term policy. And I have to commend the government for biting the bullet and saying that at least for government bond investments, there will be no tax liability on foreign investors. Now, I know this is a tricky topic and lots of people have strong views on this, but the reality boils down to this. Globally, every country or most countries follow the OECD norm of saying that foreign investors will be taxed in their country of residence. So it's a residence-based taxation as opposed to paying tax where you're operating, as opposed to a source-based taxation. A few years back, we effectively moved to a source-based taxation where we said foreigners have to pay capital gains tax here. Of course, we also said that we will put in place double tax avoidance treaties, etc., so that the liability on foreigners does not go up across what they have to pay in their home country and what they have to pay here. However, in practice, that double tax avoidance did not work always.
Oh, really?
Yeah. In the sense, if you are a sovereign wealth fund, or if you're a person based in Singapore, or if you're an endowment for a university in the US, which is exempt from paying capital gains taxes, if you have withholding taxes in India, what do you set it off against? There is no set off. Secondly, if you're an investor coming via a fund and investing in India, then what you get when you exit is a provision for withholding tax which your fund deducts. That provision for withholding tax cannot be set off against the liability you have in your home country. Finally, and all of you are market participants, you'll understand this. In India, we calculate capital gains on a rupee basis. Now, a foreign investor might actually have a loss in a dollar basis or a euro basis, particularly at a time when rupee has been depreciating. But yet, you have to pay a withholding tax, which is computed in rupee terms. What do you set that off against? And finally, think of the process implications for people coming into the country. For every sale of security, you required a tax certificate telling you exactly what the tax liability is. You had to make sure the tax liability is made good. Only then you could remit the funds out. Can you imagine the nightmare? Now, I have to commend the government for doing the analysis and at least for government bonds removing this particular requirement. By the way, at least my back of the envelope implications. Foreigners typically hold about 3 lakh crores of government bonds. Assume a 7% interest. So every year, they're earning about 21,000 crore rupees. If you take 15% withholding tax, including surcharges, etc., that's about 3,150 crores of annual withholding tax held by the government. In the overall scheme of things, in the fiscal balance that we have, it's a rounding off error.
It's a decimal point.
It's a decimal point. So what are we trying to achieve by having these taxes? And I have to commend the government once again for removing this massive irritant for investors, at least for government bonds. Now, two things. We were not included into the Bloomberg Global Aggregate Index in the beginning of this year. There was a review done by that particular group, and they quoted a few issues. One of them was tax. This ordinance, which has been passed by the government, paves the way for Bloomberg Group Aggregate Index to include India into its index. I'm not saying it's a done deal. There are other issues that have to be worked out, but I have to again commend the RBI as well. Many of the other issues in terms of accessing government bonds, including on our systems, have actually been addressed by the RBI.
All the subcategories have been removed.
Subcategories have been removed. See, it's also a question of market access. Foreigners who are dealing in multiple countries don't want to log in only into a specific India system to be able to trade India bonds. They would rather do it through their Bloomberg front end or some other front end. What RBI has done, I have to commend them for understanding the market. They've actually created market access, and I believe even the Bloomberg access and other access will be available very soon. So actually, many of the irritants which were there for foreigners has now gone away, which means it's a matter of time, hopefully, before we get inclusion into the Bloomberg Aggregate Index. That alone should bring in passive flows of $25–30 billion to start with, besides getting in, Japanese insurance company, European insurance company flows on a regular basis. I'm also hoping that this paves the way for a similar discussion to happen on equity markets as well. Again, there's a lot of disinformation doing the rounds. Nobody is exempting FPIs from anything. We are simply saying, you please pay whatever taxes are liable in your home country rather than having to pay a tax here. By the way, if you and I are Indian residents, Indian passport holders, when we invest in the US and in UK or in Singapore or in Japan, we do not pay capital gains tax in those countries. We only pay capital gains tax in our home country in India, barring some very few exceptions like real estate investments and stuff like that. So we are simply going, India was a massive outlier in terms of the way we treated tax. Commend the government and the RBI for removing this aberration status, at least for government bonds. I think removing this for equities as well should be the next step.
That's extremely well explained. This unfortunately got into a narrative, you're taxing domestics and not FPIs. An extremely wrong comparison. It is a destination-based tax and you're taxed in the country of origin. That narrative needs to be re-established, and hopefully, like in 1991, some of the misgivings of policy will happen, and this dialogue between policy and practice will continue at the highest levels. But to continue that point, Naren, you began by saying that you think FPIs in debt will be impressed by the fact that they may not lose on the currency front. What are you picking up from your FPI visits? Do you think this Bloomberg inclusion looks ever more likely now?
I think so. I think, see, in debt, there are two factors. One is currency, second is taxation. Both have gone very positive. And so that's why I think the chances in debt are very, very high that Bloomberg can consider much more positively. And that's why I think on the debt side, clearly, I would say that the mood is very, very optimistic. Yields had gone off completely away from the repo in almost all the 3-year corporate bonds and all these things. It gave us an investment opportunity to invest, but it had diverged so much from the repo rate. So many of them are coming down now at the rates. So that's why I think on the debt side, clearly there is good scope, actually.
Yeah, actually, AAA companies are borrowing at 300 basis points above repo. Maybe that's not the comparison we should make, but so is the government of India. Borrowing, some 200 basis points above the repo. So this was a great opportunity. But more to the point, in terms of the current, currency flows or debt flows, last time before the JPM inclusion, people front ran. So do you really wait for the index inclusion, or even if, the wind is blowing in the right direction, things may work positively?
Actually, today you should look at how Japanese government bond yields are, how US government bond yields are. The gap is also very low. So for people to decide, okay, instead of buying Japanese government bond, let's buy India, that gap is so low at this point of time that how can people do this investing ahead? Because you're getting very, very juicy yields across the world today. I don't think Japanese government bond yields have ever been high like this in the last 30 years, maybe. So that's why and today US 30 years gives you 5%. So there are a lot of, there are challenges that India has managed their macro much, much better in the last 12 years, that the gap between Indian yields and the US yields is very different from 2013. So this is one of the things that we have to keep in mind when, that in 2013, you had 0 interest rates in the rest of the world. So if you offered 5.5%, you got 5.5% was a phenomenal rate. Today, 5.5% is a rate you can get in a 30-year government bond. So that is the difference at this point of time. So we are in a very, very different global environment in fixed income. I think totally different from 2013.
Since you picked up the mic, I assume you wanted to say something?
No, I think Naren makes an extremely important point. The steps which have been announced on 5th, first on taxation, this is a medium-term correction which had to happen. Do not say that this is a tijori which is being opened and suddenly flows will start to come in. We are simply creating the conditions for money to come in more on a realistic basis. Similarly, what has been announced on FCNRB is a way to shore up our immediate reserves so that it gives a lot more of buffers and confidence to the ecosystem to precisely do what Naren was saying, which is break this vicious cycle of negativity around the rupee. Having said that, that doesn't mean that we immediately start to see large amount of flows coming into the country. And here I want to add to the point that Naren is making. Look, we are trying to achieve multiple objectives together as a country. I'm kind of imputing motives out here between the government and the RBI. So we want a somewhat stable rupee, or at least a rupee that doesn't underperform the way it has been underperforming over the last 2 years. We don't want inflation to be too high. So we want the fiscal deficit to absorb a bulk of the energy prices, fertilizer prices, food prices after El Nino, etc. At the same time, we want interest rates to be kept under control because we want to give growth a chance. When you have multiple objectives like this, and as Naren pointed out, this is at a time when the difference between Indian interest rates and global interest rates is extremely narrow. So for foreigners to come jumping into India, they will look at this. They will look at a 10-year bond at 4.5% in the US and say, is 2.5% more than US Treasuries enough for Indian government bond? It's a calculus that they will make. So incidentally, this subsidy which is being offered by way of the FCNRB swap is effectively a price that we are paying to be able to manage all these objectives together.
Yeah.
You know, because something has to give somewhere. But I think it achieves a lot in terms of breaking the vicious cycle and creating the conditions for a lot of real economy changes that have to happen, starting with growth, innovation, FDI, manufacturing, etc.
You know, normally it's the guests on my channel are optimistic and I play the pessimist advocate, but today I'm going to play the optimist advocate.
Realistic.
Naren, see, this argument that interest rate differential is not good enough, I've heard for the last 24 months. But who sold out of India? FPI equity, not FPI debt. FPI debt has been reasonably sticky and there is a minor inflow coming on several months, you know, when equities was on the other direction. So that gives me the confidence that with all these nasty, you know, problems they faced on tax and delay in, you know, repatriating, it was not as if they found Japanese bonds good, sell today, by the next moment in another country, which is what they do in most other countries. In spite of all these problems, FPI debt was sticky. What makes you think they won't be sticky now that they don't have these problems?
No, I think you have to remember the size of the FPI debt market is fraction of the FPI equity market. And in FPI equity, you have to remember in 2024, our PE was possibly 1/3, 3 times the PE of most countries in the world. People ignore valuation when they're doing it because after 2023, we created an equity society in India where all the money came only in equity and not in debt. So due to that, we had a PE which was 3 times China or 5 times China. So FPIs did the logical thing, selling FPI equity. In debt, they have a very, very small exposure. Okay. Over the years, I would say the Indian government has been very, very careful in allowing access to Indian government debt from FPIs. I think across the world, India must be one of the most cautious jurisdictions in allowing foreign money.
No, can I add to that, Lata? Look, you've heard me argue this before. I agree actually at the core that India is doing well. And we have no reason to be diffident about it. And we'll discuss growth at some stage. I think we're doing reasonably well right now. But I want to make this point about when you say interest rate differentials low, how does it matter? And I'll give you my chota thesis around this. Okay. So first off, because interest rate differentials are low, in the debt markets, getting in flows can be a bit of a question mark because people will look at our rate compared to other countries. That's a small portion, as Naren points out, it's a rounding off error. I think there's a more insidious problem, which is that for a few years now, we have kind of discouraged interest rates and fixed income as an asset class as opposed to equity. For the simple reason, discretionary savings of many of the people in this audience itself will probably not go into debt markets simply because on a marginal tax basis, post-tax returns on fixed income simply do not look attractive enough to beat inflation expectations. On the contrary, equity markets with LTCG at 12.5% beyond 1 year at least give you the chance, and that's what advisors will tell you, of beating inflation on a regular basis. I think what has happened, therefore, is our savings, especially in the last few years, ever since indexation benefit on debt funds was removed, I think a lot of the discretionary money has moved away from debt markets into equity markets. Now, as a result of that, I would argue there have been pockets of overvaluation in some parts of equity markets, making it more difficult for equity inflows to come in, both FDI as well as FPI. In fact, you're created conditions for taking out the money rather than bringing in money. Our problem in the last few years, couple of years, has been net capital flows. I would argue that this narrow interest rate differential and probably subdued interest rate markets have played a form in both curbing debt inflows as well as equity inflows. One last point. We've discussed this before. One of the big issues is also been the speculative flows and the hedging flows going through in the market. They are a direct function of the differential between the US interest rates and Indian interest rates.
Anand, I want to browbeat this point in detail. So I will come back to it. It is just that for the moment, the other newsy bit that came on Friday was the GDP number. So let's discuss growth. And I have a whole set of questions on the next chapter of reforms that we have to talk about now. Now that, in a crisis, we always reform. So let's talk about that in a bit. But I'm very keen to understand this valuations and earnings growth argument now. My first question to you, Naren, is more macroeconomic. See, it was a surprise to all of us the way the GDP number came. The poll I got was 7.3% for fourth quarter, and even the highest number was not above 7.6, the range of expectations. There was no 7.8 anywhere in the analysts' expectations. That's exactly what we have delivered in the fourth quarter. Now, if you look at that, and you look at the RBI forecast, or all economists' forecast for the current year, 6.6. I mean, does it look like, we are that much slower, that the growth has to fall by almost 1.5 percentage points, 130 basis points? Or do you think that the strength of the performance in the fourth quarter and the subsequent auto sales in April, PMI in April, power consumption in April, just all the indicators are in such deep green, do you think that we are not going to have that bad, at least a first half?
Think of last year, they cut GST rate sharply, they cut income tax rate sharply. So when you have done all that, in fact, RBI did a lot to increase liquidity in the economy. All that helped the economy so much that we actually had a very good year in 2025-26. And in March, people decided, let's stock up after seeing the war. That also helped March. Because who would want to take risks on supply chain in a situation of a war? So that's why it was good. But look at what RBI has to do. They don't know how strong El Nino will be, how long the war will go. So it is better to be slightly cautious and forecast at this point of time. Do you think it's possible for RBI to predict on June 5th how strong the El Nino will be? I'm sure in August they will be much better equipped to think what has happened both to the war and to the El Nino. So that's why they have actually done a precautionary judgment of the future, which is absolutely right, because they have actually
I'm not
eased
asking you
enough.
to pick holes on RBI. The entire, on the street it is 6.3, by the way, the average. My sense is that we are overstating the worries on growth for the simple reason that look at the US economy, red hot, 172,000 jobs. Market estimate was 80,000. When did we last hear a doubling, more than double, actual job creation?
That is because there is an AI-driven boom.
So I'm asking you.
That AI-driven boom drags everything, because as the biggest economy in the world, you have actually dragged power equipment manufacturers everywhere in the world.
Let me just finish my question, because I'm playing the optimist advocate to the hilt over here. Very, very unlike a journalist. Today, Japan's GDP numbers came in. Expectation was 1.4. They produced 1.8. Highest, fastest growth in 4 quarters. We are talking large economies. Okay, we're getting these numbers from US. We are getting stronger numbers from China than before. They are also in the throes of a capex cycle. Relatively smaller economies like Taiwan and Korea are also in a capex cycle, though in terms of market cap, they are bigger than us. So I'm not talking small economies here. Japan, China, US, and Korea, Taiwan. Is there a global, higher than expected growth? And we are also benefiting from it. Higher than expected growth even in the 4th or 5th largest economy. So are we going to be surprised even globally in terms of growth? The recency bias of war and tariffs is probably making us more pessimistic than needed, is my question.
It's possible. Imagine the war gets over today. Oil falls $25. We don't have a big El Nino. The AI boom continues. You'll have better than expected growth in all parts of the world. Everyone will be happy. Why not? That will be a situation. I mean, look at it. Japanese equity market is close to all-time high. Indian mid-cap index is close to all-time high. Almost all the world indices are close to all-time high. So why should there be pessimism all around? Pessimism is only on the war and crude price, not in everything. You can look at...
I was just getting a sense that every number from every country is surprising on the upside, and we probably need to connect the dots. I was only asking you if we are missing these connections. You wanted to add to that?
Yeah, so again, I'll defer to Naren and this very knowledgeable audience here on the actual earnings and all that. But as a macro person, when I look at the overall performance of the listed space, I know that the benchmark indices don't seem to be doing too well in terms of earnings, right? The Nifty 50 or the Sensex 30. But if I look at the BSE or NSE 500, or if I look at the entire listed space, it's looking good. I mean, the performance has been 15% annual year-on-year growth, and which is more than 1.5 times the nominal GDP growth. It's looking pretty good compared to an FY25. I'll give you another data point, which I'm not sure why people aren't speaking about this more often. Look at the employment numbers. If you don't trust government numbers, look at CMI employment numbers. They're showing very robust growth over the last year and a half. For all this thing about, AI is going to create job losses and all of that, including in IT and IT-enabled services, CMI is saying that the number of jobs has gone up quite dramatically. CMI is saying 17 million non-farm jobs were created in the last 1 year. So actually, across earnings and across employment, there are good things happening in the country as well, not just in Japan or in other parts of the world. Now, as Naren rightly says, there is a lot of uncertainty going forward because we know there is an energy crisis going on. We know there is an El Nino, and therefore we don't know what happens to fertilizer prices and to food prices. So therefore, I think the RBI is absolutely right in trying to under-promise and over-deliver. But actually, there is something good happening on the underground. Mid-cap, for instance, what he mentioned as being an all-time highs, the earnings are fantastic in mid-cap and small-cap.
Yeah. Actually, I was trying to look up the CMI numbers, and you will be surprised that the strength of growth of the 4,300 companies, Anand and I were preparing for today's discussion, and he sent me the entire dump of 4,500 companies that CMI normally analyzes. And the earnings growth, if you don't just look at Nifty, but you look at the entire space, it's far stronger than what Nifty has been in single digits, which is my next question to you, Naren. The fourth quarter, even for Nifty, was better than the previous, and third was better than second. So what is your sense of earnings growth for Nifty and the broader universe for the current year? Is it likely to reasonably be better than last year?
See, there's momentum in auto is continuing. Momentum is many of the discretionary, like one of the gold jewelry companies, leading companies, had an analyst meet. They gave such a fantastic target for the next 5 years. So there are a lot of discretionary entities which are giving good growth. Most of the IT services companies show low growth. So we have a situation where underlying trends are fine. And I don't think at this point of time, but having said that, we don't know what is going to be, what's going to happen, how long will oil stay this high. When oil stays this high, look at the sacrifices that the government has had to make. You're talking about a 10 rupee drop in excise duty. Then you're talking about a drop in petrochemical customs duty. Now, if you look at this entire RBI swap, that is also a sacrifice by the Reserve Bank. So all these costs, they're all a fiscal cost. So that's why I believe that government is, that's why I said, if the war ends today and oil falls $25, we are in a different environment in this room and for all our investors.
Well, actually, the forecast we are getting from people, even if the war stops, is $90 or 85 to 90, for the simple reason that some reserves have been bombed, and it'll take time for them to, crank up and start producing. Again, these are forecasts which are coming from, even the IEA sounded very bearish when Fatih Barol spoke to Shireen just last week. Didn't sound extremely positive, but that's another matter. My sense is $90 is in the price across the world. But Anand, there's another interesting point you mentioned when we were preparing yesterday, that we are perhaps not yet counting the amount of good work, probably positive multiplier effect this increase in deposits can do to growth. See, we are talking about some $50 billion, even assuming it is a little less than that. We did not, discount that in our growth metrics when all these numbers were being, modeled. That is a substantial and slightly lower cost deposits available to banks. Can that have a positive impact? It's available, it's sloshing around in the system in a quarter.
So yes, Lata, so it's kind of tricky, and it's important we get the nuance correct. So assume we raise $50 billion through the swap route. What happens is you will have close to 5 lakh crores, 4.75, let's call it 5 lakh crores of deposits being created. banking liquidity will also go up by 5 lakh crores. Now, that's an enormous amount of liquidity which is being created, which can keep short-term rates low unless RBI sterilizes all this liquidity by issuing MSS or by increasing CRR, etc. So we talked about the fact that already our interest rate differentials in the world are very low. This could actually make it even lower if you have overnight rates, particularly in the short end of the curve. Then money has been created because deposits are being created, 4.75 lakh crores, 5 lakh crores. That's actual money being created. Yeah. Now, a lot depends upon how that money is deployed. This money, when it circulates, if it goes the wrong way, can actually fuel more imports, can fuel more demand, more imports. It can go out as capital outflows, or it can go further into equity markets through savings going into equity markets and create even more pockets of overvaluation there. On the other hand, if the money is going into debt markets, especially long-term debt markets, actually that will be a huge stabilizing force which will allow rates to remain low. At the same time, allow this money to be deployed into productive capital formation and therefore create fresh jobs, fresh businesses. So I think the RBI will be watching very closely both this excess liquidity as well as this deposit that's being created. And you've heard me talk about this. To ensure that this doesn't become a leaky bucket where the money flows out again into extra imports or capital outflows or only into equity markets, I think it's important we do some policy tweaks, including making, for all of us in this room, investments into fixed income markets a lot more attractive. The fact that we are being charged incremental marginal tax on our investments into fixed deposits and debt investments, I think is doing the wrong thing in terms of asset allocation for us as investors. And it is also creating problems in the efficiency of both the debt market as well as the equity market. Debt markets are starved for funds and for growth, and they are a critical component of capital formation. Equity markets can see too much of money flowing in from people like you and me, and that can in turn create pockets of overvaluation, actually create outflows of markets. So I think a big thing to debate would be, should we make the taxation across asset classes a lot more close to each other, rather than have tax decide whether we put money into equity or into debt? That could be a big stabilizing factor and a big reform to help us ensure proper capital formation and balanced capital formation happens.
I would just add to a bit over here. Going by what the government has had to expend, chances of giving away interest income, tax on interest income, which is now at slab rate, may be a little tough in the near future. If the change of heart happens, that will be very great. At the moment, the change of heart has only happened on capital gains on FPIs in debt. It's a long way off in terms of capital gains on debt on domestic investors, capital gains on equities in foreign investors, and interest income. Interest income is another issue altogether. It's not even capital gains. It is income tax. Whether they will go to that level of progress, we don't know. But I'm with you entirely in the reform chart that you are laying out.
Just 2 quick points.
Yeah.
One, the government is right. Most countries in the world treat interest as proper income. That's the fair point. There are some exceptions, but they tend to be exceptions. The only thing I would say is that given the state of our debt markets, the fact that our debt markets are barely 60-65% of our market capitalization in equity terms, whereas globally the norm is about 125-130%. Our debt markets need help. And to your point about giving up income on revenue at a tough time when, as Naren mentioned, the fisc is a problem, it's a question of nurturing capital formation. Because if you have the right capital formation, the GDP that will accrue from that multiplier will more than pay up for whatever you're foregoing in terms of tax. It's about don't tax the goose that's laying the golden eggs.
Yep. This is the lesson we learned in 1991, and one hopes derivatives of that will continue to happen every time we are in a crisis. And we learn that giving up money is usually a pathway to earning more money at a later date. Spectrum was given free in many countries because that led to e-commerce development. And so at every point, we have to learn this lesson. But Naren, by your viewers, your audience and my viewers will beat me up if I don't come to the nitty-gritties in terms of growth and where, the stock picking world. first, the question is, what kind of earnings growth are you expecting? Is it better than last year? And would you want to would you have a number, some in-house arithmetic on Nifty earnings and broader market earnings?
I think it's too early. We have to wait. The best time to give a
You'll
good
have a working
judgment is
number.
September, because you would have seen El Nino, what's happened to the war. Right now, if you look at it, you have to think what is the, the best strategists in India will start saying X OMCs. Then they'll start excluding oil PSUs. Then they'll do some other X and then say earnings growth is good. So, the reality is that at this point of time, ahead of both the monsoon and what has happened immediately, a lot of people get benefit out of, the inventory. And recently, I've been reading something called as Kalecki-Levy law or something like that. It seems when fiscal deficit goes up and corporate profits go down, that happens. And fiscal deficit, corporate profits also go up. So people are saying in US, corporate profits have gone up because fiscal deficit has gone up. In India, it's been very healthy that in the last 3 to 4 years, central government fiscal deficit has come down, but corporate profits have gone up. So this year, if fiscal deficit goes up because of all the sacrifices that the government has done, would you want to give a higher PE to corporate profits? This is a question which I read about recently. So I thought this is a very educated audience. I can ask them to think about it.
Well, giving higher PEs now is something you have to ask the foreign investors also. But by the way, coming to think of it, do you see any danger to Indian DII flows at all? The way in which the retail investor has behaved defies that fear. The money has marched on via SIPs or even non-SIP flows into mutual funds. But, with each passing month and your meter is not ticking forward, any fear about flows?
We've been worrying. I think it's like the Fox story. Every month we worry. And the level of leverage in derivative markets, the level of margin trading funding facility, which has been taken from brokers, even those have started to go up. So, it requires, that's the worry, that continuously leverage of the HNIs and retail keeps going up. And that's a scope for worry. Mutual fund side, even if SIP flows come down slightly, I don't think it's a problem. But we are more worried about the leverage in the derivative markets than about mutual fund flows. Because I think the mutual fund investor is at least a long-term investor they are not leveraged. But the derivative investor who's leveraged, and why should the MTF facility amounts keep going up today? It's, I think, at the highest ever at this point of time. That is more worrying for us.
Okay. Well, let me come to the specific sectors. And my a sector where I am the beat reporter, banking. There has been this spectacular run of public sector banks vis-a-vis private sector banks. I hope your owners don't mind that. But at the moment, do you think that has run its course and attention comes back to private sector banks? Or do you think that, public sector banks probably lack digitalization? That's what they tell me when I speak to the public sector bank chairman, that, 5 years ago, besides the fact that they were laden with more AQR than the private sector banks, they were also not as digitized. But now they're almost on even, level according to them. So they see this narrowing of valuations between PSU and public sector banks likely to continue or even improve. Your take, which sector would you bet on?
Any stock where FI holdings have been very high, that stock has been punished. So if you look at the amount of selling which has happened in the mega caps, which the FI has liked as on September 24, and see their FI holding as of today, that has been a big role. So our view is that if you have to look at something contrarian today, it would be all the stocks where FIs have sold for the last 20 months, relentlessly. And I think if you take a 3-year view there, that's why private banks come as one of the best sectors to invest for the next 3 years. Simply because in the last 20 months, I think FIs wake up every day in the morning and sell private banks. Because they used to have 40% of their portfolio in private banks. So for them, when they wanted to sell India, they had no choice but to sell private bank. One day they'll sell A bank, second day they'll sell B bank, third day they'll sell C bank. So we'll think that the problem is in A bank, but the problem was not in A bank. The problem was A, B, C, D bank were the 4 biggest stocks in their portfolio.
Okay. Well, actually, to develop that point, I heard that very interesting speech of yours saying, speaking about extremes, always get in when the market is at its extremes in the negative. Can you develop that point further? At the moment, if you have to talk about extremes that lure you and extremes that push you away, what sectors would they be? I
think most of the extremes are in countries outside India. India has not seen the extreme. Extreme may have been like last week, prior to the policy, corporate bonds trading at ridiculous yields compared to the repo rate. But if you look at equity, where is there euphoria in India? I don't think, except all the US-linked stocks like some capital goods stocks, I don't think there was any euphoria in India. I think there was a sense of irritation. Whereas you look at what we were told by a broker last week, that in Taiwan, people take personal loan and invest in semiconductor stocks. And in Korea, people they take loans against their insurance policy and buy stocks. I don't know whether people know there is a single stock leveraged ETF, which has some $20 billion or something like that in Hong Kong, which is a South Korean stock. Someone told me that. I checked, it looked like 16 billion or 8 billion. I couldn't make out the quantum. But today there are leveraged single stock ETFs available on those stocks which have gone up 400% and 500% in the last 1 year. So I think all the extremes that you want to look at is seen outside India. I think the more and more, I mean, we don't understand anything about it, but SpaceX IPO 60-page presentation is something I'm sure every investor would want to read. So these kind of things are very, very interesting to read, and India is far away from any of these things. It is like last week I had a presentation to make, I called it a boring market.
Okay. Yes, and those are the markets, according to your previous presentations, that should attract interest, at least investors, longer-term investors. Anant, you have this wide group of FPIs you speak with, you used to speak even more regularly, and you still speak to in your other responsibilities. What is the sense you're getting about AI as a whole? Is this danger that India would be the negative end of AI, job losses? Is that the narrative you're hearing? Or is the narrative that jobs have just moved from IT to GCCs and we are confusing the AI issue? How do we, see, the overall story with all of us is, even if the Gulf War ends today, from tomorrow we have to worry about AI. Is that, any better now? Is there an understanding that India need not be in the negative end?
So I think, Lata, there are positives to be seen. First is the moves in the market and the positioning in the market. Let's take dollar rupee. Dollar rupee has obviously moved sharply from 84 a year ago to 95, or wherever it is today. In real effective exchange rate terms, it's gone from 107 to 90, below 91 now. Okay, so it's corrected a lot. Now, alongside that, as I mentioned, the amount of fear and greed trades which have been put, which are people buying dollars because they're worried about what's going to happen to the rupee, I've counted $120 billion of such buying over the last 2 years. $200 billion is what RBI has sold. Out of that, $120 billion has been picked up by people hedging or taking speculative positions against the rupee. To me, that's great news for India. Because if everybody is positioned on one side, people are prepared for bad news, people aren't necessarily prepared for good news. Similarly, on equities, we've seen relentless selling coming through. Our weightage now in MSCI EM is now below 12%. Even there, it looks like many FPIs are actually underweight India, which means people again are not prepared for any good news on India. That's a great place for us to be in. Finally, on growth, as I mentioned, people are very knowledgeable here, they'll know better than me. But I can't see a problem on growth. Earnings looks fine to me. As I said, employment looks fine to me. If anything, the adoption story on AI in India, whether it's the software services companies, the GCCs, or normal corporates, is fantastic. You know, that Stanford report beginning of the year, which shows adoption in India is 3 times the global norm. The number of research papers on AI coming out from India is now rivaling China. The number of research citations, the number of GitHub contributions coming from India is rivaling the world. We are still low on patents, but everywhere else, I think our adoption rates are very, very high. Yes, we missed the bus on foundational models, but it does look like when it comes to the application stage, including with the software services majors, we actually have a story developing. These are consultants, software service majors are consultants who will be required whenever somebody decides to move towards agentic AI. So I think the negativity around India is frankly the positive. The fact that there is so much of negativity and people aren't prepared or ready for the fact that we have very, very bright people trying to prepare for the future.
That's extremely encouraging. Naren, 2 important stock market questions without which my viewers will be very, very upset with me. One, this correction that you're seeing, Kospi and Samsung and SK Hynix and TSMC and now Broadcom, all those chip stocks in the US, should we look at it as a good correction? Because if you look at the economy, it's red hot as we're looking at all the US economy indicators and Korean Far East economy indicators. So is this a healthy reset in a secular bull market for the moment?
Yeah, it is a healthy correction. You can't have some 9 successive weeks. I think US S&P went up. It went up, I think, 22% from the bottom. Something like that. It has to be a healthy correction. But even after this correction, I don't think on market cap terms it is cheap.
Okay. Well, the other question which I must ask you is, what are your favorite sectors at this point in time? We know that you are the contrarian and have always made money on contraries.
So oil and gas clearly, because no one wants to look at it.
Yes.
Banking clearly. These are 2 clearly at this point of time. I mean, the 2 sectors where maximum work we are doing and we are already having a position and we are struggling is FMCG and IT. But those 2, each have their challenges because both are seeing such low growth. So the growth has to come back in these sectors. That's what I would say.
Okay. Anant, last word in terms of getting back to practice and policy. What's the next big policy you want?
So look, I think we are in a good place overall. We have enough buffers to manage whatever ups and downs will come through because of Iran or El Nino, etc. But these buffers have to be utilized to correct some of the things going forward so that we get net capital flows in and we get back growth and innovation. Clearly, we have something to do as far as manufacturing is concerned. That remains a concern which has to be addressed. Now that we have those India, EU, India, UK, India, New Zealand kind of trade treaties, how do we use that to get back the manufacturing story? I think that's going to be a big one. Similarly, on innovation and the fact that we have growth, but we don't have enough private sector investments coming through. Rather than blaming the corporate sector for it, I think we have to sit down with the corporate sector, figure out what is it that's required for getting them to start investing in a big way again. And it ultimately will boil down to growth and innovation. Alongside small things like, this equity taxation for FPIs, getting a better asset agnostic taxation for domestic investors. All these will catalyze what will hopefully be the capital formation story for us.
Okay. Thank you very much, Naren and Anant. Many positive takeaways. The markets itself are in correction territory, but as our experts see it, this boring markets are the time that long-term investors should get in. The earnings story seems to be turning if we look at the 3rd and the 4th quarters. And of course, while there is the challenge of oil taking away a lot from our GVA, it's still something that we are hoping will not be the story of the full year. And the tax corrections that the government has brought about, the deposit SOPs that RBI has thrown, looks like the correction should end sometime soon. Thank you very much.
I request you all to remain on stage for a minute, my dignitaries, because we want to do a Q&A session. We'll just take one question from the audience. I hope that's fine. Because of lack of time, we'd love to do more questions, ladies and
Actually, if you had
gentlemen.
told me, I would have ended it early. I wasn't aware that there is a Q&A session.
No problem, ma'am. I'm sure we'll do well with this one too. So we have volunteers. Sir's there.
Hi, right here, Prashant here. Fantastically moderated, Lata. Anand forcefully put forward points. I think you're talking about the bond taxation issue for a while, and I think you once again forcefully made the point very clearly about the equities taxation bit as well. And Naren, congratulations, I should say. I read that you are, in terms of the equity AUM, the largest, CIO in the country now, 1.6 lakh crores. So top of the league there. My question, Naren, is to you. You did say in a response to Lata that this is a healthy reset with what's happening in the US. So two questions. One, do you have all these big equity issuances coming through in the US towards the end of the year? You talk about SpaceX, there's Anthropic, there's OpenAI. You've many times talked about how previous big bull markets, bull cycles in India, the 94 one has been ended by too much equity supply. Do you think the same could happen? Because this is a global story. Do you think it could, the amount of equity issuance later this year in the US could tip things over?
It looks like, but I can go wrong. Valuations in these technology, everything is $1 trillion. So, but it's quite likely that you have so many IPOs raised. We have seen in India also. Once you had too much of fundraising, after that the market found it difficult to go up. And maybe here also you have this combination of SpaceX, OpenAI, Anthropic, Google, and Meta, all of them raising money that can lead to this situation what happened in India also. So it's quite possible, because as it is, valuations are not cheap. Then you've got so much IPOs. So the combination may work on a negative basis.
And what does that mean for India? From a foreign flow perspective, if that were to happen, the almost consensus belief now that this entire, North Asia memory kind of trade has to cool off for foreigners to be interested in India. Do you agree with that? And also, if later this year things start to cool off in the US as well, what does it mean for flows here?
See, in a framework-based of view, it looks like India will be an outperformer. The question is, what is the absolute return? That part we don't have clear answers because of war, because of El Nino, because of valuations can go down everywhere in the world. So I think outperformer over a long period of time from here looks more logical. With what absolute return, I do not know.
Thank you.
Thank you for your question, sir. I'd request you to remain here because we have a small memento to be given to all of you as well. Thank you, Mr. Sankaran Narain, Mr. Anant Narayan and Ms. Lata Venkatesh, ma'am, for guiding us through such an engaging and thought-provoking conversation. Your perspectives have truly provided valuable insights into the forces shaping India's economic future. As a token of appreciation for you to spare your precious time with each one of us, may I invite Mr. Ajay Saraf, Executive Director, ICICI Securities, to join us on stage to present a memento to our three dignitaries, please. You can clap, ladies and gentlemen. Please join me in thanking Mr. Sankaran Narain, Executive Director and Chief Investment Officer of ICICI Prudential AMC, Mr. Anant Narayan, Professor of Practice at IIT Bombay School of Management and former whole-time EV18. And now, ladies and gentlemen, we have reached the end of Slot 1 session. I am Siddharth Kannan, your YouTube podcaster, thanking you for your participation. It's now time for a short mid-morning break. Refreshments are being served at the pre-function area outside the hall. We request only those participating in the next session. I repeat, we request only those who are participating in the next session to come back in 10 minutes. Thank you, ladies and gentlemen. See you on the other side. I am your YouTube podcaster, Siddharth Kannan. A round of applause for all our dignitaries in the audience. Come on, ladies and gentlemen. You can clap for yourselves. What a turnout, and we appreciate each one of you being a part of this mega event. India's growth ambitions are visible in new cities, highways, factories, logistic networks, and infrastructure projects across the country. Behind all of them lies a sector that is often considered one of the most important indicators of economic activity itself, which is cement. The industry is currently witnessing a significant capacity expansion cycle, creating important questions around demand, utilization, competition, and long-term growth. To help us better understand the road ahead, we are joined by one of the most respected leaders in this sector. Under his leadership, Shree Cement has transformed into one of India's largest and most efficient cement manufacturers. His contributions have reshaped the Indian cement industry and set new benchmarks in technology, alternative fuels, and raw material usage. Ladies and gentlemen, please join me in welcoming Mr. Hari Mohan Bangur, Chairman, Shree Cement, on stage. Round of applause for him. May I also invite Mr. Ajay Saraf, Executive Director, ICICI Securities, to kindly join us on stage and present a bouquet to Mr. Hari Mohan Bangur. Lovely to have you with us, sir. And now, I leave Mr. Hari Mohan Bangur with the people, so it's yours. We are looking forward to hearing from you. Can we have a round of applause for this iconic personality, please? Over to you, sir.
Thanks, ICICI Securities, the whole team, to call me here and let me talk about cement. I have a 50-year experience in cement, but what I have gathered in 50 years, you all are researching quite a lot and might have achieved it in 10 to 15 years, all the problems, all the opportunities of cement industry. Still, I will like to add some new things. First of all, about the industry, it is supposed to be highly polluting. When the product is very low cost, dust, then if anybody has seen the industry about 30 years back, all dusty everywhere, pollution, but the recent government notification, recent means since last 20 years, it is continuously tightening. The cement industry is one of the cleanest. We are using the air, processing it, and then leaving the air cleaner than what it is there in Bombay. Our output norms of anything, whether it is dust emission, gaseous, NOx and SOx, it will be better than, or it is better than what it is in Bombay today. So it is not polluting anything. It is, in fact, cleaning the air and leaving it. It is being continuously monitored by agencies and online they have the connection to see what is the dust emission, what is the other emissions. So this is one thing. Every cement industry model in India at least is very clean. Rose gardens and fish ponds, which are very sensitive to dust and other atmosphere, are flourishing in all the facilities. Secondly, earlier it was said that so many million tons of fly ash is being generated every year. Where we will be putting the fly ash? ash ponds were a reality which were continuously expanding. Now, cement industry is the scavenger of India. Whatever is pollutant, ash from the power plants, slag from the steel plants, they are being used extensively. And now, since about 10 years back, 5 years back, our present Prime Minister Modi ji said that you have to use the municipal waste. We thought it is a very big drain. Cement industry registered it, but now find that refuse-derived fuel, RDF, is the real cost saver. And everybody is now, which was negative cost, wanted it at negative cost, are ready to pay something for RDF, putting their plants to use RDF. So now one more thing. She has also started, apart from RDF, agro waste parali and waste from every produce extensively. Right now, about 1,500 tons of agro waste is being collected and used every day in cement units, power plants. So, new type of fuel which are waste are gaining value. So, cement industry like eagle and crow, which are scavenger, is ready to use whatever material is available to them. These are the fuel-added things. Otherwise, many a times when surgical waste or stale food, which is expired, it has to be burnt at a very high temperature. Cement kilns are running at 1400 degree, and they are allowed to use it. Pollutant water sometimes. So all these things gives a lot of value to the industry. The newspapers and the news normally gives an impression that cement prices have suddenly increased. Nowhere in last 10 years I have seen a single news where they say that cement prices have decreased. And going by the newspaper, cement price must have increased many folds in last 5 years. But the price rise of cement is only 3% CAGR, whether it is a 5-year horizon, 10-year, 20-year. So cement prices are not increasing. In fact, cement is the cheapest material available in the world. It is around 7 rupees a kg delivered to the customer's place and 3.5 rupees a kg at the factory site. From 3.5 to 7, the journey is because of the transport cost, dealers and distributors margin, and 18% GST. So with this GST margins, the manufacturer is getting only 3.5 rupees a kg. So we have to do our costing in paisa per kg. That is the tight control we are having. So when we see the cement balance sheet, it is around 20-25% of the top line. But the real economy, you have to see it in a different way. And the people feel that cement industry, the politicians, that cement is charging very high because they see the balance sheet where the profits will be around 20-25% of the sale value. But the real economy is that 3,000 crore will be spent for a 3 million ton unit. And from that 3 million ton unit, average utilization is 65%. So 2 million ton will be sold. Now 2 million ton on 7 rupees a kg will be around 1,400 crore for the whole year. Even with 20% margin,
it will be 280 crore. That is, on a 3,000 crore investment, EBITDA will be 280 crore. This is unsustainable. So new plants will require 3 to 4 years nurturing. Their debt and has to come down, repayment has to be done. This can be done only from the old units. So any new unit stand alone cannot survive. It has to survive by outside means. After 5 to 7 years, the present plant will become mature and start giving profit. So return on capital as a industry is low. But politicians feel that 25% is the profit, it is too high. We can hit them. That is not the case. Everybody talks of few things about cement industry. One of them is consolidation. And we think that consolidation has to come very fast. In last 10 years, 10 years back it was that 5 top companies were having 55% market share. In 10 years, at the rate of 1% per year, now it has become 65%, definitely on a much bigger base. That 65% of the capacity is by 10 people, 5 people. This is because India is so big compared to Germany, France, European countries, where 80% will be held by 4 or 5 people, 65% looks weak. But they are smaller than a state of India. The consolidation of 80% in one state is there. Now, India for cement industry has to be divided into 5 different countries mentally: north, west, south, east, and northeast. If you see any region as such, it will be around 80% by top 5 people. So consolidation levels are good. Continuous more consolidation will be taking place because return on capital, as I have just said, is low. So this will be there. In the past, our cement industry was growing at the rate of 1.4 times, 1.3 times the GDP growth. Cement is a basic raw material. Needs in India is unlimited. Needs will be converted into demand only when money is available. Fortunately, in last 5 years, money availability has been good. Cement capacity or need is converting into demand really. So, at present, even after saying this, we see that instead of 1.4%, 1.4 times, our cement demand is increasing at the rate of 1 times the GDP growth. Demand has come down, maybe because our share of various manufacturing has come down, services has increased, or whatever reason, the present demand growth is not as high as was being expected. So, why then we are putting so much capacity? The prospect is much better. So much announcements are coming every day that 15,000, 25,000 or lakhs of crores of rupees will be spent on infrastructure. And infrastructure is the lifeline. Whichever government comes, it cannot be neglected. India needs a lot of them: connectivity, ports, airports, roads, railways. So cement demand growth is to be there. Now, we see the road. in road, still we are having tar roads as the standard for the highways and others. Bombay has seen the value of cement road, that it is coming and being continuously improving since last about 40 years. And every year more cement roads are being made. Cement road at present is costing only 40% or 50% more than the tar road. But the lifetime expense, if we see, it will be half, as it has a life of 20 years compared to 4 to 5 years, and then continuous repairing for the tar road. So this is the way now India has money. India has to spend on cement road. The other thing is, in tar road, if I see the import component, the tar is the thing which is basically can be exported or it is an import substitute. In cement, 80 to 90% value is all Indian. So if I see the cost of road and Indian part of the road or imported part of the road, then as a cement, as a import substitution, cement will be the much cheaper. It will be having less imported component compared to tar road. Secondly, cement is so much cheaper that for the job creation, cement will be the key for job creation in India. One mason uses around 20 tons of cement per month, or 250 tons of cement per year. 250 tons into 7,000, that is about 15 lakh rupees. One man can be utilized for the whole year. The job can be given gainfully. Any other capital job creation will require much more capital expenditure. So for job creation also, cement can be used and millions of jobs can be created. Other thing we are talking about is capacity utilization. Cement industry capacity utilization is around 65 to 70%. 730 million ton is the present capacity, and production will be 430 tons or so, 60%, 65%. So it seems that very low capacity utilization is there. But we have to see from the clinker point of view. What we are counting is the cement capacity, which depends on the basic raw material clinker. When we see compared to clinker, our 65 to 70% capacity utilization will become 85%. Because everybody is putting about 30%, 25% extra cement grinding capacity. This is not a waste. Cement is a seasonal product. We don't want to be out of market any time. So everybody is keeping little more cement capacity than he can really use. The other thing is, when grinding units are there with one mother unit, then every grinding unit will have 30% more capacity. Overall, the cement capacity utilization has to remain low. So when it comes to 80%, you can think that 100% cement capacity has been used. So the capacity utilization, only 80% is 100%. That we have to feel. Now, cement industry's success is dependent on three things. One is the managing energy cost. Energy, both thermal and electrical put together, is 70% of the manufacturing cost. Raw material, manpower, stores, all are, they are important, but a small cost. So if you can concentrate on energy cost, 70% of the job is done with only one or two things. The second success depends on post-manufacturing expense, that is logistic cost. That is really big. It may be around 15% to 20% of the selling cost. So the people who have more number of units, the logistic cost will be lower as they can deliver from the nearer plant. Their average distance travel will be lower. So that is the second thing, logistic cost. The third important thing will be the balance sheet strength. Many of the people, new entrants, they had both the cost controlled, but they were treating it as normal industry where repayment will be done after earning. First 3 years, there is no profit because capacity utilization lower than they have to enter the market, they have to penetrate it. So people had to sell their units, though they were running it well with all respects. So the third is balance sheet strength. These are the few things. And now, earlier, there is a talk we have been doing for many years, whether cement is a commodity or cement is a brand. Even everywhere, the brand concept has to be there, very important brand concept. Even for a tea shop or a coffee shop, a normal tea shop or a branded tea shop, coffee shop, Starbucks or the other. So in everywhere, branding is very important. Earlier, when the cement was in shortage, controller of cement was supplying or allowing us cement that you can use it only on allocation. We were not allowed to sell cement. I have been working in the cement industry from that time. Total control was there, from that to partial decontrol, then to now total decontrol. So basically now when things are surplus, it is a developed economy as that consumers have the choice what to take, what not to take. So brand will always be important. This is what I think. Now, though I have a long session, I don't know what you will like to hear, what you will, or it is a monologue, whether I am going on the right track or not. So I thought I will cut short the talking part first, only address you for about 25 minutes, 30 minutes, and then invite questions, because whatever is there in mind, the question answer will be a dialogue which will be useful. So I ask everybody of you or the organizers to ask, allow me to take questions. That will clear many doubts. Thank you.
Yes, sir. So as sir said, we're going to open the floor now. You just have to raise your hand. We've got volunteers who will come. So all yours.
Thank you. Thank you for the opportunity, sir. So my first question was on industry consolidation. So you mentioned that the share of top 5 players has increased now to almost 65%. But yet, on the ground, we don't really see pricing power or any this consolidation transpiring into increased margins for the industry. So how should one look at it in current context? And in your opinion, what level then of consolidation is required to really get the industry some pricing power?
Consolidation is one thing. We talk about consolidation only because of pricing power, but pricing power is totally absent. In fact, the price increase, as I said, is 2 to 3%. Then why, when the inflation is 6%, 7%, this is because continuously cement industry is upgrading itself and cost control is better. But pricing power, we are far away from it. It may take few more years. even with 80%, now people are not talking to each other to increase prices. So price increase will be totally dependent on demand and supply. Nobody wants to lose market share even 0.5%. So even with 80%, with 5 people, even if it is 3 people at some places, some states, still the price rise is not taking place because we are unsure of what is the future and the price will not be there. Price rise will come seriously after 3 to 5 years when the new mines will be operating. New mines are being purchased at significant premium to the old existing mines. About 100% premium on the limestone cost will be there. So the old units whose mines are there for a long time will be really benefited when the competition will become uneven for 5 to 10 years. After that, the old units have also to be coming into that. So real serious price rise will take place only when such competition will be there. We are far away from it at present.
Thank you. Sir, you also mentioned about the importance of branding. You gave an example of a normal tea versus a branded tea. But with the increase of RMC as an industry in India and in general in the last 1 or 2 years, the share of non-trade segment is going.
Little louder, I am not able to hear clearly.
Sorry, I'll just repeat my question again. So you mentioned about the branding that how it will continue, and you also gave an example of a normal tea versus a branded tea and how it makes a difference. But with the increase of RMC industry in India, the share of non-trade or the bulk segment or the non-branded cement is increasing. So how do these two combine? Because globally, cement is largely sold as a bulk commodity or through RMC. So if we are going the Western way, should then the importance of brand still prevail? Thank you.
A good question. I had to say something about RMC. That is the future of cement. I missed it in my speech. Good you asked. So RMC in India is only 15%. Most of the cement is consumed as RMC, and as soon as the concrete is made, the brand value becomes zero because then we are selling the concrete. But deep-rooted specifications are there from the consumer. They say this chemical to use, this cement to use. So the branding power of cement companies are so high that they, in the area specific, whichever is stronger at one place, they feel they have to specify the cement. So that when specification of cement is there, so RMC has to use it. But gradually, the concrete strength is all important, and there the brand value of, instead of cement, the brand value of concrete will come, whether it is brand A concrete or brand B concrete. So brand value will still remain. Whether it is cement, it will shift to concrete. And concrete, India is now 15%. Very soon, in 5 to 10 years, we feel that most of the cement will be used as concrete. It gives the power, that right kind of quality is there, individual mixing is not there. We have entered the cement, concrete business quite late, only 2 years back. And what we have achieved in 2 years is 35 to 40 new concrete units, RMC units have been put. We want to be aggressively Sri Cement as such, and the industry also is pursuing RMC in a big way. That is the right way. In Bombay, if you take cement, where you will mix it, it will all be dusty. So concrete is the thing which is produced a little away, transported to the city. Thank you. Suddenly the demand, whether it was Egypt or so many countries, the demand has suddenly come up. So India is in, I have been waiting, but when it will happen, we don't know. Suddenly the demand surge will be coming. India's per capita consumption is around 280 tons, 290 tons, 290 kg per capita. World consumption is 540 kgs. And China, forget it, it is about 1500 kg. So we have to catch up with the world average, where Asia, African nations and everybody is there. So it is a potential is there to double the cement demand. When it will happen, we don't know.
Thank you. And my second question, so there is a lot of consolidation which has happened and you referred to that. In fact, a lot of inefficient capacities have gone out of the system, and with stronger players, with more branding, ideally the industry should have seen better ROCs, but it's still not happening. And in fact, last week, I think one of the top 5 players made a comment that cement should not be sold as a brand, but as a commodity, and therefore the prices should come down. Your views on that, sir? When will we see a better ROCE?
Better ROC, just I replied. I don't see in very recently. As far as individuals, the world is colorful, meaningful, vibrant, because people have different views. Everybody is right to have different views. Only time will tell who is right, who is wrong. So I appreciate other players also, but my view is branding will remain. That's all.
And can we see ROCs in the range of 14-15% for this industry on a sustainable basis? Would you have a view on that?
You are putting the same question again. I say not even sustainable basis, not even on unsustainable basis, it will be there recently.
Okay, sir. Thank you.
Thank you.
Hello. Yeah, hi, sir. So, in terms of the M&A, what is your ideology? Organic versus inorganic expansion?
India needs more capacity. If only M&A is there, how the new capacities will come? So everything has role. M&A is important, but new capacity creation is a must for India. at 7% growth, India will be requiring about 30 to 40 million ton, because at 70% utilization on 400 billion, 40 million ton will be required to be put every year. Somebody has to do this very continuously. So both are important. Shree Cement is planning early, having purchasing the limestone, and for future growth, whatever limestone you are using, it is a raw material age, non-new generation. It is a mining industry. The raw material will be finished at some point of time. So for the future growth, about 5 times the whatever you are consuming today, every year, you have to add 5 times the raw material kitty in your bank. So new capacity will be there. People are also buying out inefficient players. That also will be a reality. So both will survive.
Sir, I am Arun Daga, just retired from Ultratech Cement. My question is about growth strategy. We have 3 players. Adani, which is mainly focusing on growth through acquisitions. Ultratech, which is focusing on growth through greenfield plants as well as acquisitions. And Shree Cement focusing growth through greenfield cement plants only. So why 3 different players are having 3 different strategies?
As I said, everybody is right. You have to take a view. Now, Adani had taken one view, but they are very recent in the industry. Success or failure in an industry comes after 10 to 15 years of working. In 3 years, 5 years times, you have not even seen one cycle. So I will not comment about their position, their future, their strength. They are only about 5 years old. Ultratech has done very well for themselves. Everybody can see it. So a story of acquisition and greenfield acquisition, that is also very good. But for acquisition, the generation has to be much bigger. That can be absorbed by greenfields or brownfields. So Ultratech is in that position that they can have greenfield, brownfield, as well as little costlier, because otherwise so much opportunity in new plants will not be there. They have to increase at a much higher pace, and so much new capacity cannot be put in a year. So someday, even we will have to follow the Ultratech route. When we finish and we see that our capacity utilization is better, we cannot take so much new greenfield or brownfield, then it will be the time. That is a natural, you don't have to force yourself. It is a natural growth plan.
Sir, my second question is that about the greenfield cement plants, we need land acquisition for that, and which is becoming very, very challenging in India. So how Shree Cement is targeting this challenge, addressing this challenge?
Money is where the higher challenges are there. If it is not challenging, then money will not be made. So you have to try the harder route where the cost of acquisition will be cheaper, cost of acquisition will be costlier, greenfield will be cheaper. So everything comes with a cost. Uncertainty is a little cost. If you try 5 places, at 3 or 4 you are successful, at 1 or 2, even after 10 years, it is not there. Our last plant, Navalgarh, is one of that. Few companies, 3 or 4 companies tried there. Only Shree Cement succeeded, others had to drop. Similarly, I am not saying that many a places we tried, we failed, somebody else has succeeded. So it will be going on. But overall, when we see, even after 2 or 3 failures, getting a greenfield or brownfield expansion or a mix of them will be the cheaper way. But cheap is not the only thing. Sometimes you have to grow faster also.
Ladies and gentlemen, we have time for only 2 more questions.
Good morning, sir. For somebody who is not from the cement industry, I must compliment the way you have made the understanding of the industry so simple, so lucid. Thank you very much for that. My question is little paradoxical and it's little controversial also. The cement industry is always been at the, the flag of MRTP and MRTP. And people talk of cartelization and price fixation. On the other hand, you mentioned that the price rise has not been so substantial. So isn't this paradoxical? And you being an industry leader can throw more light on this. Thank you, sir.
Yes, what you say, both things are correct. When we see the building material, whether it is bricks, sand, steel, or even what you say, aggregates, everything last 5 years, 7 years, CAGR, its cost increase is much higher. So, compared to that, as I say, cement industry CAGR is 3%. Now, somehow the builders feel that their cost increase, their price increase is much higher than cement industry or anything. They feel that all others are, whether it is bricks or sand or aggregates, they are unorganized industry. So they find that cement is the thing, and suddenly you will find that in cement industry, delay is not allowed. Everybody wants that work should not stop. So always in a year, in one region or another, sudden price increase is there because rakes are not available there, some logistic problem. So sudden price rise is there. And that is the time hue and cry is there. So that is natural. If the material is not available for 1 week, the price will increase. And suddenly they say no cost increase is there, but price increase is there. So their acquisition is there. The cases goes on, but that's all I can say. But when you see the yearly average realization, it is not going at higher speed than this, which is less than the inflation.
Thank you, sir. Thank you very much.
Hi, sir. There is an assumption that cement industry will grow at 8% in FY 2027. Am I audible?
No.
There is an assumption that cement industry will grow at 8% in FY 2027. Keeping in mind there is a El Nino and the rural demand is one of the largest contributor for the cement demand, and the fact that there is a problem with the government in terms of spending money because they have given a lot of subsidy and other stuff, even the capex may take a beating. Do you see this 8% assumption is coming under scrutiny?
8% is the right assumption because, as I said, if our growth is expected at 7%, plus minus 0.5, if 7% is the growth expectation, then 8% cement consumption growth is very natural to assume. What will happen, that will be known only after the event. But 8% is what we also assume and work on this assumption.
Thank you.
Ladies and gentlemen, This will be our last question. After that, we have our next stellar speaker also lined up. All right. Thank you so much, sir. Thank you for sharing your views with us. May I request you to please remain on stage as a token of our appreciation and for taking the time to share your thoughts and perspectives with us today. May I invite Mr. Prasanna Balachandar, Executive Director and Head of Investment Banking and Institutional Equities at ICICI Securities, to join us on stage and present a memento to Mr. Hari Mohan Bangur. The cement sector provides an important lens through which one can understand the broader economy, and your perspectives on the industry have offered valuable insights to everyone gathered here today. Ladies and gentlemen, please join me in thanking Mr. Hari Mohan Bangur, Chairman, Shree Cement. Now, if entrepreneurs build businesses, capital helps accelerate their growth. Over the last 2 decades, private capital has played an increasingly important role in helping Indian companies scale, innovate, and create long-term value. Our next speaker has been one of the pioneers of that journey. She is widely recognized as one of India's leading private equity investors, with a career of nearly 4 decades in financial services across private equity, investment banking, and structured finance. She started a career with ICICI Group, which culminated in becoming the MD and CEO of ICICI Venture. She has partnered with entrepreneurs across sectors, supported businesses through multiple economic cycles. Through multiples, she has played an important role in shaping India's private capital landscape and advancing the conversation across long-term value creation. Please welcome, ladies and gentlemen, Ms. Renuka Ramnath, Founder, Managing Director and CEO, Multiples Alternate Asset Management. Round of applause for her, ladies and gentlemen. And may I invite Mr. Ajay Saraf, Executive Director, ICICI Securities, to kindly join us on stage and present a bouquet to Ms. Renuka Ramnath. Such a privilege to have you with us, ma'am. Thank you for joining us. Please make it louder for her. Ma'am, I leave you with our people. We're looking forward to hearing you talk. And thank you for being with us, ma'am.
Good afternoon. It's very, very special for me to be in this forum because I cut my teeth in financial services in this very company, ICICI Securities. I was part of the founding team of ICICI Securities when the merchant banking division was spun out to become a joint venture at that time with JP Morgan. So it's a very, very special company for me and a very special moment. I'm also a bird with a different feather. I'm not a public market investor. So I hope what I'm going to say is relevant. I'll keep that brief so that we can do more Q&A. This morning, I thought I'll organize my presentation in 3 parts. First, a little bit of a description of where the economy is, where the middle of corporate India is, and 2, what is alternate asset managers like us really do. It's quite interesting. I've been doing this business for 25 years in this country. And even today, I'm left with a feeling that beyond provider of capital, I feel the entire understanding around what alternate asset managers do to build wealth in companies probably is not as widely understood as I would like it to be. So maybe I'll share a few examples from our stable. And lastly, talk about, for this asset class to make a meaningful difference to corporate India, how many things have to come together? How does that become a national mission to take our economy to our collective national ambition? So let me begin by, so before that, can these prompters be removed? Because it's a bit distracting and coming in the way. Yeah. No problem. Yeah. So all of us know that there is a national ambition to make India a $7 trillion economy. We are around the $4 trillion number today. And this journey from 4 to 7 trillion requires a minimum of $1 trillion of investments that have to happen in this economy to achieve that ambition. Along with that, many other things have to happen in the economy. To give a little bit of color around our GDP composition today, we are 61% of our GDP is driven by our consumption in the last year, which is significantly higher than what it has ever been in the past. And all of us will very easily concur that we cannot take our economy from a 4 trillion to 7 trillion on the back of consumption alone. The pie of our GDP itself has to change if we have to become a $7 trillion economy. Manufacturing, which is just 15 to 18% of our GDP, refuses to budge from there, has to reach at least our national ambition of 25%, if not 30%, for us to reach those numbers. Combined with AI disruption and all the other global disruptions which are going to be the way the world will go forward, a consumption-led economy for an emerging economy like India, where consumers who have limited ability to pay down their debt are keeping the economy going through higher borrowings. Our savings rate has come down. Around 2008, 2010, we used to save 38%, and now we save 30%. Our consumption has increased, which means our borrowing at personal levels has gone up as well. The picture of the economy of India is far less pretty than what we would like to be. You stack that to an aspiration of almost doubling your size. The challenge in front of the Indian economy and corporate India is order of magnitude. Business as usual approach will definitely not get there. It will only lead to disappointment. The question, therefore, is how do we fix this? Let us look at the structure of corporate India. For my presentation, I really want to exclude both government and large cap companies, companies in the top 200 listed companies out of my conversation. I believe both these constituencies have a very clear plan to get to their own destination because they have the necessary wherewithal. Wherewithal in terms of putting the right amount of capital to work. As far as the government is concerned, it will be pretty much just the infrastructure part. And the top 200 companies will be around making the capexes for technology to cope with AI disruptions or opportunities, whichever lens we look at it, and attract the right kind of talent and global partnership. But when it comes to the belly of Indian corporate, the story is not pretty at all. In India, we have close to 4,000 companies whose revenues are circa 100 million or less. And their profits proportionately are very small. Their ability, therefore, to make the necessary investments to combat with the challenges of tomorrow is either absent or negligible. Let us compare ourselves not with the United States of America, but let's compare ourselves with other economies of equivalent size. If we look at Japan, as contrasted to about 4,000 companies at less than $100 million, Japan would have less than 700 companies in that space. If you look at sizes of companies in that economy, they would be roughly 5 to 10 times the size of our companies. This speaks, therefore, for a very precarious middle, the belly of corporate India. I also very firmly believe that if we do not fix the middle of India, the corporate belly of India, our aspiration for becoming a $7 trillion economy will be even more challenged, if not impossible. The challenges with the belly corporate of India is not just their own small profits, but it has all-round challenges. It starts right from the top in terms of ownership. The ownership could be largely family-oriented, but it is not one family or one person. So there is tremendous fragmentation in that ownership. Because of that, and because of low profits, and a very deep aversion to dilution and losing control, they almost have no access to risk capital. You could only grow your company so much with leverage. They also, because of all of these factors, have severe disadvantages in terms of attracting professional talent, in terms of bringing the best technology, having the access at a global level either to the marketplace or to talent or technology. And therefore, if these companies are not looked at carefully and built to be future ready, they are going to be a big burden, a big drag on the Indian corporate scene and therefore on Indian economy. I, for one, firmly believe that there is nothing called standstill, whether it is to a human being, one person, you, me, or to a corporate or to a nation. If you are not growing at an individual level or at a company level or at a national level, you are decaying, whether you recognize it or not. And therefore, I would say that if the challenges of the middle-sized corporate India, which is 4,000 plus listed companies, and there would be at least an equal number of unlisted companies, if not more, if they are not addressed, we are looking at an economy where very few companies at the top and the government are trying to pull the entire weight of the economy, which is going to be a near impossible task. And therefore, what really is the solution and how do we pay attention to this? I believe that alternative asset capital, which is the private capital, is a very important solution provider to the small and mid-cap companies in India, which are in plenty. First, let me demystify alternate asset capital. Most people think that alternative assets is all about bringing private money and taking stakes in either public or mostly private companies. And even more so, there is a strong belief that these are for new age companies who would use a technology disruption or a business model disruption to go and build recklessly companies which some of them may get listed and become tremendously valuable. Alternative assets is far from this. There is a lot of active involvement by alternate asset managers. We, in multiples, is one such example. There are 180 local alternate asset managers and many, many more global funds who are operating in India. Let me take a few examples to bring forth what we have done in our limited life cycle as multiples in the last 15 years. One of the examples that I find it easy to share with an audience is an example that we all experience, which is movie theaters. In case of PVR, I personally have been associated with this company for over 20 years. I first invested in PVR when the company had all of 11 screens, and it was valued around 100 crores in 2003, all the way today to about 1,800 screens across the country through both aggressive organic growth and also a lot of strategic inorganic consolidation. PVR consolidated Satyam Cinemas in the south, DT Cinemas in the north, Cinemax in the west, and then the mother of consolidation, which was PVR and Inox coming together to become the largest exhibition company by a huge mile. It is absolutely an unusual transaction where two family-run businesses were put together and one family was allowed to run the company with certain understanding and arrangements with the other family, for the simple reason that that consolidation, that scale, size, which allows for a very comfortable capital structure with very low leverage in the business, significant cash flows for future investments, both in technology and footprint expansion, was absolutely considered necessary for the future of that industry and for both businesses. The question is, can this kind of transactions become more commonplace? How do we carry the message to many, many more mid-sized companies, listed and unlisted, that it is very important to think of the future, not just as an extension of the present or the past, but radically differently in terms of what would give you the strength to stand and be alive and build a bold, differentiated company for the future. I'll take another example from our portfolio, which is in the financial services sector. We incubated an affordable housing finance company on the back of two individuals who showed enormous passion and conviction in building affordable housing finance company in the country. This was the first term of our Prime Minister, Mr. Modi, where there was a very clear articulation that India needs 55 million homes in the affordable segment, which meant a $200 billion investment opportunity. And there were many fragmented housing finance companies, and in multiples we chose to back these two outstanding professionals who wanted to become entrepreneur and build a company which was differentiated on technology, which not only brought much better intelligence to their credit process, but also kept their operating costs low and built a large affordable housing finance company. And along the way, they have also diversified their financing solutions to Indian customers. Today, this company has an asset book in excess of 15,000 crores, looking at also building a prolific book in other business lines such as vehicle finance and other products for consumers. An alternate asset manager like Multiples and several others can bring forth appropriate companies which are future ready for the larger benefit of Indian consumers and society. The third example I would take, another very differentiated story, is a carve-out. We purchased the animal health business from one of the finest pharmaceutical company in the country called Zydus. Zydus is run extremely well by Pankaj Bhai and his son. So arguably a very well-run company with the best of governance, best of financial discipline, and best of capability. But they had both human pharma and animal pharma, and a time came in their journey when they said, let us pick one and focus on the same and double down on investments and management bandwidth. And they took a decision that let us give up the animal health business and double down on the human health business. That led to the carve-out in a publicly listed company of one of their important divisions. And we, as a private equity institution, won that transaction, while there were bids from other global players and other strategics as well. Post our acquisition, it was not just about growing their core businesses, which was largely therapeutics for livestock and vaccines for poultry. Subsequent to our acquisition, we have expanded the product canvas for this business. We have brought in herbals as a very important portfolio in our set of offering. We acquired a company from the Burmans, Ayurved, and integrated that with our company. Later, we also acquired a company in Netherlands to enhance our footprint in Europe for herbal products. We also brought to life the dormant pet care business, and we are looking to consolidate further in the pet care business. By the time we sell this company, the product portfolio of this company would have substantively changed from being a therapeutics company to be one where therapeutics, farm care, which is nutritive products for the farm, herbals, exports, and pet care would be the composition of the product basket, thereby making this company the numero uno company in animal health in India, not only catering to the demands of India, but also having a meaningful footprint in the developed markets. These kind of transitions for creating value in mid-market company cannot be episodic. It has to be a regular feature. We are talking about 4,000 listed companies with very fragile revenues, profits, and capability. And as I said, probably another 4,000 to 5,000 companies with the same amount of fragility, which are in the private domain. How do we energize corporate India through appropriate steps taken by public market investors, by the government, and by private investors like us to make them future-proof and create extraordinary value for all stakeholders, not just shareholders? Because if we don't take that action, that many jobs are at stake. And in the entire supply chain, that many suppliers are vulnerable, right? And so we can go compound this problem if you really look at the supply chain on either side. As many distributors of these products are vulnerable. And we cannot build a $7 trillion economy with that level of fragility in the mid-size corporate India, which is how India has got created. Equally, I will take this opportunity to salute entrepreneurship. People ask me, Renu, what motivates you to go to work at this age and stage? It is just working with these extraordinary entrepreneurs that India has produced in large measure, who are passionately committed to their cause. They do not ask the questions about who will work with me or where is the capital, but are willing to take that first step and build the momentum which brings all other factors of production together. But the mindset change that is required, that I cannot continue with such fragility in my P&L and balance sheet, is still a very important mission that all of us as stakeholders in the financial ecosystem have to deliver to the country. Now coming to some of my woes. Did it move? Yeah. To fix the challenge that I described about the middle of India, this is not going to be fixed either by capital markets, because it is not their business to fix it, nor is it going to be fixed by Government of India, because it's not their business to fix it, nor is it going to be fixed by large global investors who are bringing tens of billion dollars into India every year for investments, because it's also not their business. It doesn't meet their size criteria. If we have to convert this drag into a mega opportunity, it has to be fixed by local managers. Local managers need to build scale besides capability, and the scale, we cannot depend on scale entirely on foreign capital. Even as I speak, even in a firm like Multiples, which is completely India-born and India-managed, where I have been in this ecosystem for 40 years in financial services, 25 years in the investing world, a large majority of the capital we manage is still international capital and not local capital. But to solve the challenges of India at speed and with a national mission, we need local savings to flow into the hands of local managers who would then take on the mantle of consolidating, re-engineering, investing, bringing the right governance talent into these companies, thereby making them sustainable, scalable, valuable for future. It's not that we don't have money for this product. We have approximately $1.2 trillion in the hands of highly capable and educated investors like LIC, like EPFO, like NPS. But the amount of this money that comes into alternative assets is next to nothing. Even if I say it's zero, it'll probably not be entirely incorrect. This apathy has to be fixed. There are two aspects to it. One, I have spoken a lot about the imperative of fixing it. There is also another dimension to it, which is how much of the value creation that is coming from corporate India, from the blood and sweat of Indians, Indian entrepreneurs, Indian workers, from the potential of Indian market, the Indian consumers, we want to reappropriate for Indian savers? Or do we want to export away all of this capital that we are generating into the hands of foreign investors? In as much as making India a 7 trillion economy is a national mission, the fact that a large portion of this wealth has to be distributed within Indian savers and Indian investors, and we have to accelerate this motion by encouraging large Indian institutions with large investable surplus to allocate capital into this industry. It has to be a national imperative. Here, we need appropriate guidelines, either from all the regulators, be it Reserve Bank of India, be it SEBI, be it Government of India's encouragement to large public institutions. As of now, there is a 3% allocation, but the investment in alternate assets would be a fraction of 1%. So just making an allocation and not changing all the regulations and the indemnity that officers in these institutions will need to make investment into arguably a risky asset class is an absolute must. And if billions of dollars don't flow into fixing mid-corporate India, which is at least 50% of it has to be domestically generated. I estimate that the propensity to deploy in this sector would be $20 to $30 billion per annum, and at least 50% has to be generated from India through the Indian savings. Then the mission to the $7 trillion economy is an absolutely feasible one. And, I would just wrap up my presentation. We'd be happy to take questions to say that alternate asset managers are integral to our capital market economy. Many of you will know many public companies in which alternate asset managers like multiples have invested and how they have re-engineered those companies to create value. We ourselves have taken controlling stakes in public companies fairly recently. Many of them are severely undermanaged, if not mismanaged, seriously underinvested, and underprovided by way of talent, compliance, and governance. And public market and private market will go hand in hand to create an India where you could have at least 1,000 to 1,500 exciting stories and not 50 to 100 exciting stories. So we are very much part of the ecosystem, and the development of both ecosystems hand in hand will speak for a very accelerated and vibrant and highly desirable Indian economy. Thank you, ICICI, for having me, and happy to take questions.
Yes, ladies and gentlemen, I request you to raise your hand, and our volunteers will be there where you can ask ma'am your questions. So ladies and gentlemen, please raise your hands, and our volunteers will come with the mic. In the meanwhile, ma'am, I request you to take your seat as well in the center stage, and looking forward to this one-on-one interaction with our dignitaries from the audience.
Yeah, hi. Towards your left.
Sorry?
Towards your left.
I have to. Oh.
Yeah, hi, ma'am. Thanks for the presentation. You can straight.
Okay. Hi.
Great, thank you. So would you say that, like in a very vibrant early stage ecosystem that we have today, where you have many promising founders addressing problems in a completely different way, like for example, say, look at Atomberg as a company, which didn't exist, and you have people really create something in a very traditional industry, which incumbents didn't do much about. So would you say that it is better off betting on those guys versus trying to fix, say, some family equation in a listed company where there's a lot of legacy, there's a lot of, in terms of resistance to change, et cetera, et cetera. So how would you, in terms of when you make investment decisions and when you think about solving for long-term business solutions, would you back these new guys or would you back existing change? Thank you.
So I do not see it as a either or. I think we need both. The reason why I like some of the new age companies which are technology led, which don't have legacy hang-ups, at least I see those companies as someone who solves for building an inclusive India. And that, both professionally and personally gives me immense satisfaction. So when I look at some of the micro SME companies, we have financed through the NBFCs, we have backed. Or when you back consumer companies which bring affordable products and speak for deep penetration into India because of the way they think about supply chain, the way they think about logistics, the way they build their entire distribution network, it addresses a very important need of the economy. I would argue that fixing the problems of small size Indian companies which have huge legacy assets, these assets could be brands, distribution networks, manufacturing capability, consumer insight. There is a whole host of assets that have been built. But unfortunately, the market has changed, the Indian economy has changed, the addressable market is 10 times what they may have imagined 20, 30, 50 years back. Technology capabilities have to be integrated. Leaving them unattended would mean enormous wastage for the economy. And when we are trying to double our economy size, I don't think we can afford to ignore them. And change is already happening. So if you look at our business in the alternative asset, in the last 3 to 5 years, close to 50% of the capital has gone towards buyouts. And I would like to believe that most of those buyouts are changing hands from family ownership into institutional ownership, which is the ownership by financial sponsors. So I don't see the world as either or. I only see them as both are very important, but both require very different capabilities. Whether the same firm can build both capabilities or they can build only one capability is for each manager to address. And by the way, while early stage companies do not have legacy problems, they also have problems of inexperience. They have problems of overconfidence. They have problems of burning capital. So nothing comes without risks and problems. These are two different sections of the economy requiring different skill sets.
Thank you, ma'am. Just one follow-up, if I can have, over here, just again. So what is, when things go wrong in this segment, what are the top 2 or 3 things which in general you can attribute to in your experience that if the investment has to go wrong in your space of investments, what really is the key reason many times? Thank you.
A large part of it is around financial discipline. So I would say first, is the value proposition of this new business strong enough? Or, it appears on the face of it very exciting, but does not develop deep enough legs for it to stand on its own. So you kind of have a natural sunset. Second is, how do you think about your fundraisers and your financial discipline? So how much do you raise? How much do you burn? How do you keep a very tight control on some of the metrics around cost of customer acquisition, how much you are spending on your marketing dollars before the market is ready to buy your product or service? How do you align your expenditure with the evolution of the market? And how do you raise money before you absolutely have to raise money so that you have a ticket to dream for another day? And how do you build a very good set of talent, compliance, and governance right at the inception and not allow excessive exuberance and overconfidence to get the better of you? These are my experiences investing in this space. Yeah, any of you,
Hi,
whoever
ma'am.
is handling the mic.
Yeah.
Yeah.
Hi. So my question was more on terms of, you talked about these legacy family-oriented businesses and how there's resistance in them. So my question was, is there change happening and how fast-paced is the change? Especially if we look at India trying to be a 7 trillion economy, is change happening at a pace that will allow India to grow that much?
Yeah. No, great question. I think that change is definitely happening. And I would see that to accelerate very fast for a few reasons. One, of course, technology disruption and the fear that I will lose everything I have built has become very real with many, many families. There are multiple other things extraneous to the business. One is the mere availability of capital to buy your business has triggered the thought process in many families. Even if they had had that thought 10 years back, the question would have been, who do I sell to, right? So the active alternate asset management play in India has also aided that thought. And the third is very internal to the families because subsequent generations have their own passion and they don't necessarily want to remain committed to a business that was started by their grandfather or father or whatever. So if there is a monetization possibility and I can go out and do what I want to do, and there is an ability to discover fair value, the ecosystem moves with its own catalytic forces. And that is what I see happening currently.
Hello.
Also, I would say that families realize that if you have to be around 10 years from now, you have to make investments, be it in technology, people and other capability, which means dilution. So you may not have that 51% plus control that you enjoyed for several decades in the past. So if you have to get into minority, are you better off getting out and allowing the industry to consolidate through financial sponsors, or do you want to still hang in there with a much diluted stake? Is also another trigger for families exiting legacy businesses.
Hello. Thank you very much for your insight on the private capital. I have two questions. One is that, which you said, the belly of the corporate India, where there are very small companies, and when we compare with Japan and US. Madam, I have been also in the industry, and what is your view on the corporate governance? You see, the corporate governance structure in India vis-a-vis Japan or vis-a-vis Singapore. We have just heard Prime Minister of Singapore addressing the citizens that how well they were prepared for this catastrophe of West Asia war. And how do you think that we are building towards that? Because that's a thing which will allow the small companies not to vanish and become the big companies. And my second question is that why corporate India is not spending on the innovation? If we see the research, the spend of a corporate India vis-a-vis the developed world, what are the triggers that will help us to invest there and attract private capital? Thank you.
Yeah, no, great question. So one, I think India's made a leapfrog in terms of corporate governance. Now, if we look at the regulations that come from our listing guidelines or from SEBI, even as alternate fund managers, arguably a very private business, the kind of stipulations that are there in terms of how do we exit our assets within the fund life and so on and so forth. There are in many different directions. I think Indian regulators very correctly have pushed governance. And companies which either do not have the right level of governance and are not amenable to incorporating the right kind of governance will not get any capital from our industry. That I can say on behalf of every participant of our industry. As far as young companies are concerned, our thesis with them has been, it's not that you will look at compliance and governance when you become big. It has to be at the very seed of your company. So even if you are a 10 crore company, you need to have appropriate governance in terms of how do you use capital, how do you make your plans in terms of where you will deploy, and so on and so forth. So I think only companies with that threshold of governance will see the light of day. Others will extinguish, whether we see it or not. That I can say with 100% confidence. To your second question, I think because Indian capital markets were very benign, they allowed very small companies to list with very minimal floating stock. They could arguably be listed and raise small amounts of capital. Competition was not that aggressive. Technology was not at the center of everything that you could do. Many companies could continue with small amounts of cash. They may generate 40, 50, 100 crores of cash, which for a family is very substantive, and you could continue. So the threat of extinction was not there. Today, people know that I may make 100 crores of cash flow today. Maybe I'll do it for another 3-4 years in a dwindling scale. But if I don't do something substantive, I might not be around 5 years, 10 years. So that fear is for me the biggest reason for change. And that is led by both new businesses who are disrupting incumbents and technology which calls for investment. And you have to think of your business at scale. Global or local, you've got to be at scale and globally competitive. So all of these factors are coming together for the middle of corporate India.
Yeah. Ma'am, thank you very much for your presentation and the inputs, very helpful. My question is more to do with technology disruption, and it's predominantly regarding artificial intelligence, AI, and digital transformation. Whether we like it or not, AI is here, and it's really disrupting all the jobs at the very bottom level of the pyramid. And even if we get our workforce AI ready, the number of jobs that are there at the middle level are far and few. So there is a possibility that a whole number of people are likely to lose a number of jobs. But on the other side, you have the GCCs also increasing. So there are a whole lot of GCCs that are coming up in Karnataka, Hyderabad, and a number of places. So I just want to understand, when you are investing today, given that in the next 3, 4, 5 years, you're going to see a whole lot of disruption because of AI and conversational intelligence and talking chatbots, how do you go about evaluating all of this? And, do you really see it sort of becoming a big demon in terms of, how jobs and employment would be made available to our youth and workforce in the country?
No, I don't. I definitely don't see this as a demon. I see this as a great opportunity. As an investor, I love and I long for disruption. It is in disruption that, if you play your cards well, that you can create disproportionate value. First, I would say that from whatever I'm able to see, whether with my portfolio companies or otherwise, corporate leaders are behaving very responsibly. The first approach that I'm seeing with corporate leaders and board is, hey, what does AI mean to our business? How deep do we want to go with AI? Do we want to, I know of companies in my own portfolio which are completely changing the organization inside out, where AI will be pretty much the first port of call for any interaction that is coming triggered from outside to inside, and the human will come at the third point, right? So there are opportunities to fundamentally reinvent yourself. There are opportunities in certain elements of your value chain where you can reinvent. There are definitely opportunities in enhancing the productivity of your team. But all of this will allow for India to bring the change at speed. We should not resist it. And given the generation I come from, I have experienced banks going on strikes because they did not want computerization. In my lifetime, I have seen it. And today it feels laughable that some banks thought that they could live without computerization, right? So we have got perturbed by many technology and business model disruptions, but almost inevitably we have landed in a better orbit, in a better place than before the disruption. So I would say that corporate India will not buckle under this. It will embrace with both its arms. It will make it a big virtue. If a few companies lag behind and they get extinguished, it's only good, because it will clear up the ground for the better companies to go and get a better share and build a more robust company. I don't see this one bit as a demon at all. It's a very exciting thing. We all should embrace it. It enables us to do more. We can become a bigger, better country and enable every citizen of India much faster.
Hello. I have from an investor point of view. In private capital, the problem as an investor I have is in terms of transparency, right benchmarks, because unlike in mutual fund, or you have a benchmark which comes and now a little bit in PMS. The third area is change of rules, like what has happened, change of rules, like what has happened in US private credit market. They have just changed the liquidity thing. I mean, you cannot withdraw suddenly or something like that, because the market as an whole is facing a problem. So these are the three basic problems which you don't have in public market or probably other investment. So how do you really address this for an investor community so that they can have a higher trust in private capital? That was my point. Thank you.
Yeah. I don't think there has been any issue of lack of transparency or governance as far as Indian alternate asset managers are concerned.
Just about the fees and all that, which keeps on changing or it might change. That's the transparency part and the performance part. That's it.
So one, of course, you know, SEBI has been very, very conscientious about alternate asset managers going out and raising money from retail. And they have been continuously tightening the disclosures in the offer document about whether you have placement agents, if so, what is the fees you're paying them, and it has been made very transparent to the investor. I would say that there is as much responsibility on the hands of investors as well to ask as many questions. With respect to what is happening now with some of the global firms where they have said, it's a bit like our old, it was Templeton, right, who had this problem of asset liability mismatch. A very similar problem probably that is facing some of the funds abroad. For Indian funds, it can never happen because our funds are absolutely long tenured funds. These are very strictly documented. It could be an 8-year fund or a 10-year fund. And then extension of these funds are also absolutely clearly documented. And there is a process which could be either through the Investors Advisory Council or certain matters have to go in the hands of the investors themselves. And more than 75% investors have to vote in favor of those changes. So I don't think one should worry about lack of transparency or changing rules because the Indian regulators have done an outstanding job. Having said all of this, when you are in markets, public or private, you would have occasional mismanagement and blow-ups, which we cannot anticipate and plan for. I would say that if you are all first-time investors in a private fund, please go with proven managers with long track record, learn through that experience, and then decide whether you want to experiment with newer managers who are yet to build a track record. And so you have to do a bit of journey to experience the product with experienced managers and then increase your risk appetite. There are no more questions.
Well, ma'am, we have time for 2 more questions. If you may permit, can I request our dignitaries in the audience to raise their hands so that you can address your question to ma'am directly?
Ma'am, in your association with the industry for over 3 decades, while you don't look like that at all, you've had successes across sectors. Just to take example, PVR to delivery are very different place. So I have 2 questions. One is, how do you assess whether a promoter who's at 500 crore can scale up to 5,000 crore? And the second question is there any trait that you cannot do diligence on, but you have to take go with your gut feel?
Yeah, sure. I'm reminded, when I went for a surgery, my anesthetist, out of sheer courtesy, he said, "Oh, do you have any question before I inject the anesthesia," right? So I asked him, how do you decide what medicine and in what quantity? So he said, if you enroll yourself to a medical program and then go through my life experience, you will get there. So I would say that investing in India continues to be a lot of, diligence, analysis, and all of that, but a fair shot of gut and intuition as well. I don't think by just asking more and more and more questions, you can really get there. But typically, I like people who have had a few slaps or who have suffered. Let me put it that way. Because, that suffering, that difficult experience that you go through matures you, and your perspective around everything changes. So that maturity is something I overweigh on. The second is it all about me, or is it about gathering a high quality set of professionals around you? Because again, if you don't show jhalak of that very early on, you are unlikely to suffer later. Because if you can't add one CFO, one CMO, one senior person at least, however young a company you are likely to suffer that it'll only be how far that entrepreneur can take. And by the way, entrepreneurs in the beginning of the journey do 10 people's job. They are God, but they can take a company up to a level, maybe 200 crores, 250 crores. Then everything has to get institutionalized and professionalized for the next set of journey. And also, how do you surround yourself with people who are wiser, who will tell you, when you have a emperor's new clothes moment, and not just essayers around you. So these are all things that we look. How do you respect capital? How do you treat people? I continue to believe that reading between lines, softer side. So now I don't do so much. Earlier, I would insist that I will visit their offices just to see, when I get served pizza, when I go to Chennai for a meeting, my antenna goes up as to, what's your attention, right? Or how do you treat your support staff? How do you keep your toilets? Everything speaks about the value system of an entrepreneur, how they conduct themselves, and how long is a journey that they are, really prepared for. So I'll tell you, in case of delivery, Sahil, such a young entrepreneur. When I met him, he must have been 26 or 27, but literally a man with a mission. You cannot take his black T-shirt and thin, figure to kind of underestimate him. But he had several co-founders with him. And one of the big worry that I had was, will he be so indebted to the co-founders that even when some of them outgrow the company, when the company outgrows them, will the necessary change be done? And as our deals take anywhere from 3 to 9 months, a situation happened where he had to take a fairly difficult decision with one of his co-founders, which he did with such dexterity, keeping the respect of everybody, not bringing disruption into the company, which gave huge assurance that he will always do the right thing by the company. So you get many, many small anecdotes and episodes, even as you're evaluating, to see how is the brain wired, how is the value system wired, and can this company really scale? The other thing is, of course, respect for capital, respect for governance. When you're negotiating the document, what are the points that they are really hunkering down on? Also tells you, the mindset of the entrepreneur, and you have an opportunity to back out. Yeah. So it's a very high involvement, very highly nuanced, very intricate combination of intuition and analysis that go to build, make any of these decisions and build great companies. Yeah. Thank you. Thank you all. Pleasure to have had this opportunity.
Thank you, ma'am. We have a small memento to give you as well, but make it louder for ma'am, please, ladies and gentlemen. Ma'am has truly been an icon in our field as well. Ladies and gentlemen, we will be getting into lunch right now, but before that, let me tell you, it's just going to be a 55-minute break. Do not delay beyond that. Ladies and gentlemen, can I request Prasanna sir to please come up on stage to give ma'am a memento as well, please. Thank you so much, ma'am. Truly invaluable hearing you. There you go. Thank you so much. Here you go. Thank you, Prasanna, sir. And give it up for ma'am, ladies and gentlemen. This is going to be a very short break, 55 minutes. Please come back soon for our next session post-lunch. Ladies and gentlemen, thank you so much. I am Siddharth Kannan. It's truly a privilege having an audience like this.
India is at a defining moment. Policy ambition, corporate execution, and global capital are all converging at once. Join us for India Rising, the next chapter. The conversations that shape long-term capital decisions all in one place. So this is not a single sector story. Energy transition, defense indigenization, AI infrastructure, electronics manufacturing. The themes span the full breadth of India's next growth chapter.
125 CXOs, 300 plus investors, policymakers, technologists, market leaders, all under one roof. For 2 days of conversations that will shape portfolio decisions for the years ahead.
This is where the people who build India and the people who back India sit in the same room and have the conversations that move capital.
And behind every corporate interaction is the ICICI Securities team, connecting the right investors with the right managements at the right moment.
June 8th and 9th, 2026, Mumbai.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Just wanted to start off with one thing which, we actually, when we were working on the report, etc., was actually wondering that from a private equity ecosystem point of view, and by this is to both of you, right? I mean, so feel free to, pick it up as it's appropriate. Which are the sectors in the tech ecosystem which you think is still underrepresented? Let's say the number of deals, let's say which you get in a month or a quarter. But sometimes you wonder, okay, you wish certain sub-segments, opportunities are over-indexed, right? Which are sub-segments which I think is underrepresented currently?
I'll just answer from the top of my head, at least, from what I see, in public markets versus pipeline and, where I think big market caps can be created. I'll start with like the obvious, right? Like, we at least, at Axel and even your firm, morning to night, we're trying to find, good AI companies out of India. Right. And I would say that in spite of all the work that has gone in, it's still slim pickings. We just have like a few companies now that are breaking out at, the $10-12 million range. And, interestingly, they're both NCR based companies, right? Like Ripik that is doing something in vision tech, Spine, which is doing it for auto dealerships. So I think one, we need a lot more, good big AI companies coming out of India. So that I would say is one. The second, I would say, just from, like a market cap and again, opportunity standpoint, construction tech, right? I don't think there is much of that in India, given it's like, $600 billion market that is there is still very, very much old school. And then third, like, my personal favorite is value retail. So right now, we are seeing, this whole top of the pyramid, the Swiggy's, the Zomato, the Blinkits, 10-minute food, 10-minute everything delivery that is being doubled down by investors, but not too much for, Indians from 30 million to 200 million, those making between 10 to 40,000 rupees. So we have two portfolio companies, Apna Mart and City Mall, right, which is catering to this very large market. And I feel, give it like 4-5 years, 50 million ka market khada ho sakta hai. And there aren't a lot of people chasing these areas. So this is again, not that I've done it scientifically, but
just one double clicking on your AI comment, right? Are you finding companies which are using AI and coming and telling you this is how we'll differentiate, or you're still kind of, let's say, saying the old school word of, are you the provider or the user? Are you finding companies coming and telling you that we are using AI to do this?
No, it's a mix of both, right? Like, so, not to get too technical, but, something like a Ripik and Emma, which we have in our portfolio, right? They are doing like stuff around, vision models, right? So that is actual, getting into the, model layer and, kind of with open source and tweaking it and, making it, adding value to enterprises, right? So one is that. And then see, second, even on using AI, right? I feel, that alone of organizing, what I say, atoms and cells, using AI, companies that is, be able to do it efficiently. I'm sure, we have a portfolio company in the audience, urban company, right? I'm sure they use AI very effectively and, doing what they are doing and creating a lot of value for shareholders. So even though it's not like specifically an AI company, but it will be one of the huge beneficiaries of AI.
Yeah, first of all, Manoj, thank you very much. Big congratulations to you and your team for this report. And feels a bit overwhelming after 5,000 hours of research. I'm not sure how much we can add here. Just to put things in context, right? India tech market cap is about 2.7% of total market cap in India. US is 31%, right? So you can just see how much headroom for growth still is there in the public markets as far as tech, value creation is concerned. And just to put things a little bit more historically into context in terms of opportunities, right? I think broadly we've had three large waves of investment. Starting in the year, say 2000, for the first decade or so, when Sanjeev started, right? A lot of the models were actually largely global replicas into India, focusing on high consequence, high trust, high AOV categories, matrimonials, jobs, travel. And then the next, 15, 20 years was largely based on basically local adaptations and putting the rails in motion, whether it was UPI, digital stacks, along with, companies like Flipkart and Swiggy and Zomato, which were largely still global models, but adapted for the local market.
Understood.
The last 5 years or so have been very India-first models, right? Whether it's a company like Snabit we have in our portfolio, or a Seco or a Zepto, a bite-sized consumption, very, very locally driven. I think now we are entering to, as what you were saying, is around AI. We all know India is consuming AI faster than any other country in the world. What we would see is a lot more vertical AI applications. We have a bunch in our portfolio: Pocket FM, Seco, Kavana, Ulka, and all of these are very vertically led AI kind of applications. The difference will be, I think, is that for, say, in the US, AI is actually intended to give answers. Here, AI is actually an assistant. AI becomes your doctor. It fills a government form out. It sends a complaint to a bank. So the entire mechanism, if it changes from giving answers to assistance, creates a lot of vertical AI applications. That's one. The second is, I think digitization in India has largely been on the consumer side. I think our factories, warehouses, supply chain, small manufacturers, they will now go onto the bandwagon. So I feel very excited about, B2B technology for India's physical economy. The third is, I think you will start seeing, opportunities in full stack physical and digital solutions. And a couple of others which excite me. One is deep tech in space and defense, I think. And finally, climate and energy transformation. These, I think, are 5 areas which I think are underpenetrated. Over the next 10 to 20 years, you should see plenty of opportunities here.
Thank you, Vivek. That is, in fact, I just want to double click on one statistic you told us, right? 2.7% versus 31%. If I just may ask you, if I exclude, let's say, out of this market cap, the ones which is, let's say, US domestic versus, right? Yeah, correct.
Right.
I think, are we too far off? Have we get off it or so?
I haven't done the math yet. We'll still be far off, I think. Yeah, I think so, yeah.
But I just will want to just check on that aspect a little more with clarity, because it might be insightful for many in the audience actually. Are you really finding entrepreneurs, building with a thought process, not just India, beyond as well? Because Vivek, we just mentioned it earlier about you're actually finding many more such India-specific opportunities coming in, which might actually maybe find an opportunity elsewhere in, let's say, for example, what a Lenskart has done, right? Kind of Southeast Asia as an opportunity, or let's say going out of India as an opportunity. The context I'm asking is because at least when I think from an old school, if I can use that word, by the way, no offense to any, let's say, old businesses, right? Kind of, been around for less than 50 years. The Indian experience of deploying capital outside India has not necessarily created material economic value. I can go across industries: autos, consumer, telecom. right? I mean, not necessarily you have generated EVA by putting dollar outside India. That doesn't mean that that's the same template today, right? And so are you really finding opportunities, entrepreneurs thinking of doing something they can take outside India?
So I think it's a like a mix of both, right? So on one end, I'll give you one extreme. So on our enterprise tech side, one of our partners who's kind of led many of our investments, he almost has an unsaid rule that if you came in and said that you were building an enterprise tech product just for India, till today Axel has not funded you. We'll be wrong someday, right? But it has almost been a rule of thumb. So you look at something like a Browser Stack, Zenoti, ChargeBee. These are some of our successful enterprise tech companies, around $200 million of revenue, all built out of India. In fact, the Zenoti founder who was, started out doing something in India, funding them was conditional to them moving back to Washington. So that is on one end, on the enterprise side, right? To answer your question. And secondly, I would say on the India side, we're seeing more and more, right? Like again, Urban Company has a, pretty good, business that they have set up overseas. One more company of ours, again, out of NCR, Mooglix, is in 4 countries. So I think Indian founders are getting better and better at those capital allocation decisions and are finding success as well.
Well, the reason I asked Kiran, I'll look at Vivek to give you a perspective. In certain parts of consumption in general, or internet tech in general, right? What I'm actually finding is that the India TAM is not necessarily as big as it is assumed to be. So it's very critical to actually have, because I had a follow-up question also to ask you, right? Because, for example, I have noted that in many businesses, going beyond 5 billion rupees, 500 crores, right? Kind of something which probably entrepreneurs are not thinking at the time of, let's say, when you're 200, 300, probably you're thinking when you're 400, right? There is something about India TAM, which there is a statistic that, let's say, if you take active credit card users, debit card users, it's only so much, right? And that's the only context I was asking, right? I mean, so that, in my opinion, it probably become imperative that you actually have a global template and not just an Indian template if you truly want to be big.
And Manoj, if you go back to the history again here, right? You see the emergence of the IT companies, right? Whether it's Infosys, Wipro, HCL, these have been largely very successful global B2B companies. And on the back of it, as Alok was saying, if you look at the enterprise and SaaS side, whether it was, ChargeBee, Darwinbox, Freshworks, Soho, you've seen enough examples of companies who've done reasonably well globalizing on the enterprise SaaS side as B2B models. Where the challenge has come has been more on the B2C side. Now, there are a couple of things that one can say. One is India growth has been very attractive for a lot of these players. And so when there's enough growth in India, why go outside? Second of all, I do feel like historically, Indian founders have lacked the boldness and ambition. They've played fairly to their comfort zone because the market was quite big here, right? So then why take that unnecessary risk and because of the ROC expectations, a lot of them were not really focused on in public markets, looking at 10, 20-year kinds of investments, right? And that's what was holding them back. We're beginning to start some changes happen. You talked about Lenskart. I'm seeing through technology and AI, a new wave of companies who are coming in who are getting more global. To give you a couple of examples in our portfolio, Pocket FM, right? AI-enabled, serialized audio, internet, disruption happening there. Another company, MStack. It's actually a specialty chemicals company, which has now, through AI, it's an AI native formulation and manufacturing company. And through AI now, they've collapsed time to market and time to development from 4 or 5 months for a molecule to weeks. As that happens, you will start seeing more and more companies actually going global. And I think my prediction is that you will hopefully see a significant amount of AI-enabled companies now allowing a lot of local companies to actually go global. How many of these become true global brands? I think the jury is out there. As you know, in my previous avatar, about half our business at Godrej was, international, but it was local acquisitions. We never really took the Godrej brand globally, but at least with firms like Lenskart, I'm starting to see the first wave of globalization happen. Over the next 20 years, I do expect at least consumer AI companies to actually go a lot more global.
And I think China Plus One is finally here. We are seeing some green shoots of that. at least, friends in industry. I'm sure some of the analysts who cover manufacturing, that cost disparity, catch up in catch up in power cost, manpower cost, the differential. All these things are beginning to play out, I feel.
Let's just move from revenue to the profit part of it, right? So in real life, again, in what you're actually, say, in your investment committee, that your internal thought processes versus what you find in your ecosystem. Is the funding side of the private equity side of the ecosystem now asking for, let's say, profitability to be absolutely loud and clear versus winner takes most models which got created earlier? Where are we now in that journey, actually?
I think some of these things are in hindsight, it depends on capital availability. But I would say I'll push back and say it's a little bit more nuanced, right? So, and I'll again talk about specifics and companies because it is more illustrative of how these things work. So, for example, you have this portfolio company, City Mall, which I said in the value retail space, right? This company has grown 3x in the last 2 years, right? Margins have improved by 400 basis points. It is profitable in 4 cities now. Yes, now at a corporate level, it's still not profitable. But now I have enough proof points, right? That there's no business risk. Now I just need growth capital to go from 4 to 20 cities and create a very large outcome over here. So I think it's a bit of both. I don't think it is one side. It's not like one extreme end of the spectrum.
I think, look, again, if you step back and look at the last 5 years or so, in 2021, when we saw a huge amount of froth in the market with crazy valuations. Now, a lot of the crazy valuations were driven by a lot of money being pumped into India at almost 0% interest rates, right? When interest rates climbed up, a lot of these investors began pulling money out of India, right? Which basically meant, Manoj, that we always know the domestic cost of capital is so much higher than other parts of the world. When the domestic cost of capital is higher, then it forces you to start asking the tougher questions sooner. So as a result of that, I think over the last 3 or 4 years, in a very healthy manner, investors are asking questions which are more difficult much earlier on in terms of your customer acquisition costs, what your unit economics are. So definitely the onus and profitability is a lot more, right? And the right kind of questions are being asked. I think it is far more about the quality of growth, as Alok is saying. Growth for growth's sake no longer gets rewarded. So GMV, we all know, is the biggest vanity metric. So people are actually asking far deeper questions about the quality of growth. And if the quality of growth backed by the right economics is available, I don't think capital is actually a constraint. But definitely, I think investment committees are asking a lot more questions a lot sooner about unit economics and profitability metrics than they had been before, simply because of the cost of capital and the return that's required.
Today you have you pick up any sub-segment which, out of this 20 sub-segment, this report, right? So there is at least some representation. Maybe that's one reason you think, that the public markets, because public markets probably have far lesser patience when it comes to, because probably one aspect that public markets are not used to it in India, right? Because and a lot of these companies, I would call it as single stock sectors, right? There are no true peers also, right? So public market investors are not necessarily wired at this point to. I won't tell you a real life example. So, 2010 Domino's India IPO, right? So I was an FMCG analyst in those days. All my entire counterparts are also consumer staples analysts, right? So when Domino's IPO happened, it was just about breaking even, 300 crores revenue. Next 3 years, by the way, they grew same store growth 30%, which means do the max, right? Kind of, so 50%. So everything doubling every 6 months. Honestly, hand on heart, myself and a lot of the buy side community actually had no clue how to value this company. It took 3 years for us to learn. Whereas I remember meeting foreign institutional investors, the guys who are outside India, who have seen cycles in Brazil or Japan, kind of had a better. So looking at the last cycle, right, and we have seen few cycles in a new age tech investing. In your opinion, what are the biggest mistake which has actually happened? Is it overestimating demand or underestimating competition?
You know that funding winters will come, right? Like every 3-4 years. Right. So I think as founders and investors, we have to kind of, plan for that, right? Like plan A, plan B, plan C. And, if you have a sustainable business, you'll get by. We have enough companies in our portfolio that have raised almost like Browser Stack, right? One of our companies, which is very successful companies, has raised zero primary capital in their entire journey, profitable from day one, right? Like even outside our portfolio company, right? Like what comes to Ixigo comes to mind, right? The Ixigo has only raised $22 million of primary capital in their lifetime.
I think what Alok said complete. I think it's a very valid point. Ultimately, I think, there was a certain amount of frothiness, I think, in terms of valuations, with a lot of money chasing too few interesting assets. The market had been fairly shallow 5 years ago. And there was also, I think, Manoj, to your point here, there was also some underestimation of competition and overestimation of demand. So I think in the edtech sector, clearly there was overestimation of demand, right? People actually overestimated people's willingness to pay. I think definitely that was overestimation. Underestimation happened, I think, in D2C brands and in FMCG. People thought that the marketplaces and the incumbent brands would just completely cede ground. And while a couple of, FMCG players have done well, insurgents, but the incumbents have done reasonably okay as well, along with the marketplaces, right? The marketplaces also ended up fighting back. And so I think we probably underestimated that incumbent competition will not just quickly, while the impact was there, they just didn't completely wilt away also, I think. So we've seen both of these scenarios play out, I think, in different sectors, I think, yeah.
Just moving on to a couple of qualitative aspects from your experience stroke wisdom. What's that one red flag in founders today, which you find versus, I'm sure you would have found enough red flags, right, in your career, at least from an observational point of view, hopefully not in investing. What's that one red flag we should call out actually?
Two or three things, right? One is it's so important for founders to know when to zoom in and zoom out, right? I think that's a critical quality required, and it's getting even more and more important. The second is, as we were talking about it, at this stage, we have to worry about AI durability. So is every single founder actually paranoid about the true impact of AI? Everyone says we are AI native, we're AI enabled. What does it actually mean? But to me, I think a big asset test today is, are people truly considering what the true impact of AI potentially could be, and are they planning and preparing for that? Those are, I think, two important. The third is, 4 or 5 years ago, the market was very focused on single founder stories. As the founder, it was all very founder centric. I think the ability now to look at teams beyond founders is something also very important, right? Our founders being able to actually build high quality teams, are they being able to attract talent? Those are, I think, very important questions that are being asked, as opposed to a few years ago, I think, where we were actually far more focused on just, only the founder. I think the founder is critical, but the surround sound around the founder with the team also is getting more important.
I think, for me, I would say, what is that first principles person focused on, right? Are they things, prioritization, which matters for endurance more than, I would say, the near term. So is he or she optimizing for valuation over the right investor? Is, he or she, trying to fit business to a metric just because they get a better valuation versus vice versa, right? Because these things catch up in the end, right? And then when somebody is asking you these questions or is focused on that direction, you sniff it, right?
Super insightful. So just on the last lap, maybe a couple of minutes, moving to a rapid fire, to both of you. So investing into a business model versus investing in the right team.
Team, always, right? Team
always, right?
Yeah.
Trust the P&L or focus on the cash flow?
Cash flow, no exceptions.
Yeah.
Right.
Okay. How do you like capital to be returned to you? Dividend, buyback, or not for the next 10 years?
If you're giving me money, you have not enough ideas.
I think reinvest if the runway is attractive, right? But return it via buyback if isn't.
In fact, one company which I covered, which comes to my mind, which has actually done that brilliantly, is Titan.
Yeah.
It's got a payout ratio of 25% only, right? It has compounded X because same reinvestment philosophy. Asian Paints was like that till a few years back until proven otherwise, right? So what's the most important trait in a founder you choose to back? Strategy or execution?
I think strategy, as Sanjeev was saying, strategy in startups is discovered through execution, right? So as long as it comes with the learning velocity, I think it's execution. Yeah.
Execution. India mein gyan bahut hai.
The last one, timing of the IPO. list early and build in public versus build in private and make a splash later?
List when you're ready.
Contextual, right?
It contextual, right? Like, is your business model predictable? Like, do you have any big experimentations that are left? Those kind of things are like more important. That could be, at a 3,000 crore valuation, or that couldn't even be ready at 2 billion. And I think the critical point is sometimes we misunderstand the word ready. Ready is not just about getting to IPO. Ready is about learning how to live life post an IPO, which actually means, can you deliver consistent, predictable, quarter-over-quarter performance for 3, 4, 5 years after an IPO? So a lot of people say, I'm ready. But to me, readiness is actually 5 years post an IPO. Are you actually ready to, not just get married, but, live happily ever after, right? So,
thank you so much, Vivek Alok, actually, for the candid response.
Thank you.
It's super learning, actually. I really enjoyed it. Same to you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Behind every company that reaches the public markets is a long period of uncertainty nobody really sees. The wrong hires, the pivots, the near misses, the moments where conviction is tested. And in the world of new age tech, understanding the business often means understanding the founder behind it. Welcome to the New Age Playbook. From incubation to public listing, a conversation series with the founders, builders, and investors shaping India's next generation of companies. Through these conversations, we go beyond headlines and valuations into the thinking behind the business, the choices that shaped the company, the lessons from scaling, and the realities of building through changing market cycles. But also, what transforms a growing company into one that is truly ready for long-term capital, institutional trust, and eventually the public markets. And there could be no better guest to begin this journey than Mr. Sanjeev Bikhchandani. Long before India's startup ecosystem became mainstream, he was building for the internet economy. At a time when digital businesses were still unproven, he built one of India's earliest and most enduring internet companies and helped take it to the public markets. But his journey didn't stop there. As an early backer of companies like Zomato and Policybazaar, he also witnessed India's new age ecosystem evolve from the other side of the table as an investor, identifying businesses, founders, and models that could endure through cycles. Few people have had a front row seat to the evolution of India's digital economy quite like he has. And that's what makes him the perfect first guest for the series. Today we talk about billions of dollars. We talk about listings of IPOs which are happening dime a dozen. We're talking about unicorns and soonicorns. But back in late 1980s, none of this was even thought of. You had actually done your IIM Ahmedabad, you had passed out of, and you were in a corporate cushy job in HMM, the whole owner of the Horlicks brand at that time. And you quit that cushy job and walked away from a corporate life. And you started working out of your father's house or room, and with no capital. And internet and household was not even a household name at that particular point of time. So my question to you right now, sir, is that did you get some kind of a specific signal at that time that there was a noise from the old economy, that you were not very comfortable and you thought that the future lies in info edge? Because there was no playbook, there was no precedence, you didn't have anybody to follow. What went through your mind, sir?
No, I think, look, I have always had a dream to be an entrepreneur, to be independent, to be on my own. And having worked for 5 years in the corporate sector, 3 years before going to business school in advertising, and 2 years afterwards, and after 5 years in 2 multinationals, I had figured it was time. And I quit with no big ideas. Just said, I'll try something. Let's see what happens. And for 7 years, I drifted doing a whole bunch of small things. There was no big idea. There was no great big ambition. It was just to be independent, and I was having fun, right? In 96, I saw the internet for the first time. It had just come into India. And I thought, let me try something. Let us try something on the internet. And we used to get 29 newspapers and magazines from around the country, those that carried appointment ads. And we would take the appointment ads and put them in our own format, in our own words, and upload them on the internet, and we called it Naukri. As luck would have it, it began to get traffic. We had hit a hot button quite inadvertently, and we began to get traffic. Once we began to get traffic, people began to apply to those jobs. Once people applied to those jobs, we began to ask companies for money to list jobs that they had not advertised in the papers. And so gradually we got revenue. In year one, we got 2,35,000. Year two, it jumped 7x, 18 lakhs.
Okay.
And that's when I kind of figured that we may have stumbled upon a big idea, because I had never seen anything jump 7x in 1 year, even of a small base. And the next year it went to 36 lakhs. And that's when we were fortunate enough in April 2000 to raise venture capital from ICICI Venture. So, we have a long and old relationship with ICICI, the ICICI group. In fact, ISEC did our IPO in 2006. So we raised venture capital, and as luck would have it, the market melted down. The dot-com bubble burst in April 2000, within 2 weeks of raising money.
Okay.
So we got lucky. We got the money at a high valuation,
Right.
And we didn't have time to spend the money foolishly.
Right. So you had the cash to spend it, and you had the time.
We had the cash.
Not raising.
We had the cash in the bank. We didn't spend it.
Right.
Because the market melted down. We were very cautious,
Right.
and we just put it in fixed deposit in the bank,
Right.
and began to spend it slowly.
Right.
And we did some new products, moved into a new office, some technologies, some servers.
So, but I'm
some sales.
curious to understand, sir. Must have been one of the many ideas that struck you in the 90s or the late 80s as a business idea, and then this must have hit off.
Well, you see, when you are in your 20s and you are starting a business, and you have an entrepreneurial ambition, and you have some imagination, you get three new ideas every day, right? But if you get a few hundred ideas, then you're fortunate if you implement one. So in the 7 years from 1990, when I quit my job, till 97, when we got Naukri, I must have pursued about 15 or 20 small ideas.
Okay.
There was a salary survey, there was a trademarks database, there were some other reports, there was some teaching, there was training, there was writing, there were some small-time consulting projects. Maybe 15, 20 small things. And Naukri was the 21st small thing. And that happened to be a big thing, actually, quite by fluke.
I think that then we will probably now transition to when you started InfoEdge, you of course had Naukri.com as a part of the operating business of that particular company. But I think you made legendary bets on multiple other companies, which subsequently got listed and have become multi-baggers in its own right. I think when we look at your history of the way you've gone about doing it, it's an absolute masterclass in the way you allocate capital. So what I wanted to ask you is, was there a common thread in something that you saw, whether it was Zomato or whether it was PB FinTech? Was there a common thread in some of the successes that you managed by way of your investing? And was there an inflection point at some level where you thought that, okay, this is going to become a 100-bagger kind of a thing?
In hindsight, it looked like we were smart and we planned everything, but that's not how it actually happened. Okay. So we were not meant to invest in startups. What had happened was that when we were doing preparing for the IPO, there's the DRHP. In the DRHP, there is a section, a very important section called Objects of the Issue.
Yeah.
Now, we were hands-on on the DRHP. There were two bankers. There was Citibank and you guys, ISEC. So, there'll be 2-3 people from each of the bankers. There would be lawyers. There would be our finance team. There'd be us. We'd all sit in the conference room in our office, and we'd project the DRHP on the screen. And we went over it clause by clause. So actually, our CFO, Ambrish Raghuvanshi, and I and others, Sudhir Bhargav, our company secretary, Amit Gupta, we more or less knew the DRHP by heart because we had done every clause ourselves, and discussed it threadbare. So there was a section which said objects of the issue. So I told the team that, listen, I'll go home tonight. This section I will write because I know the objects of the issue and I know why we're doing an IPO. So I came back next day and I had 5 or 6 bullet points there. And, I said, why we're doing an IPO is because we want perpetual access to capital. We want to give the investor an exit. We want the ESOP to have value. We want our stock to have currency. We want to, put ourselves in a different strategic space as compared to other internet companies. So the bankers, that's Citibank and you, we were told that, listen, this won't do. Okay, this is why you want a listing. This is not what you'll do with the money. You have to tell SEBI what you will do with the money. So there's a standard cookie cutter, 5 bullet points, which we'll cut, paste, and put. Organic growth, inorganic growth, general corporate purposes, and there were 2 others. And I said, fine. So they put those. IPO went through. But the truth is, we didn't actually need the money for those things.
Because you started generating profits.
We were already profitable. We were making money every month. Cash was going up. And our auditors, Pricewaterhouse, would come in every quarter and present to the board use of IPO proceeds nil.
Okay.
So after 2 quarters, the board said, guys, this can't go on. You have to use the money because otherwise SEBI will get hassled. So please find a use for the money you raised. So we said, look, we don't need it for inorganic growth. We don't want it for general corporate purposes. We don't want to buy land and building. That's bad use of capital. So we said inorganic growth, but there was nothing to acquire of any good quality at any decent price in the internet space, back in 2007. So then we hit upon the idea that why don't we invest in startups? That's also a form of inorganic growth. And there are plenty of entrepreneurs trying. There's a shortage of venture capital. There wasn't too much venture capital in 2007. And the board said, okay. And so that's how we began to invest in startups. It was not a strategy. It was a need for compliance. Okay. Now, I was told you can invest about 150, 160 crores next 3-4 years. We began to invest in 2007. By 2012, we had done about 200 crores.
Okay.
And 11 companies, 8-9 companies perhaps. Of those 2 was Zomato and Policybazaar. But nothing looked like succeeding. So we put a brake on it and did not invest for the next 4 years in any new company.
That is from 2012 onwards.
2012 to 16.
Okay.
And by 2016, it was apparent that Zomato and Policybazaar are going to be successful. So then we got the confidence to start investing again.
Okay.
And we began to invest. By 2018, our CFO came and said, guys, we have a problem. I said, what? He said, we've probably hit a home run in Zomato and Policybazaar. And if we exit, we might get classified as a NBFC because our financial income will exceed operating income.
Okay.
Right. And therefore, and if you get classified as NBFC, the RBI regulations, licensing, you want to open a new sales office for Naukri, you have to take RBI permission. That's not a good idea. So it was decided we'll do a fund for all new investments. We'll do a fund.
So that was when your venture capital fund was.
That's right. So 2009 again. AIF. Because of regulatory reason, the need for compliance.
Okay.
We did the AIF.
So you actually had a problem of exit in that if you exited from your investing companies at a huge profit, you would be qualified.
Might. No, we've discovered since then that may not be the case. But
so I have a different question on the exit, sir. My question is just like how as important it is to determine the right time and right investment strategy to buy, you also need to have an exit strategy. So have you, I know that you have brought down your your stake in Zomato and Policybazaar to some extent, but in other companies, have you really thought about what is the kind of discipline that you would advise people to have from an exit perspective?
So we're not good at exits. Okay. We are builders. We believe in long-term future of companies, which is why we stay for a long time. We went into Policybazaar in 2008. It is 18 years. We are still there. We went to Zomato in 2010. 16 years, we're still there. But it's also worked for us because, if we had exited in like any fund by 2017, 18, in those 2 companies, we would have made a fraction of the money we made.
Absolutely.
So I think India made long-term, you have to, play the long game. I was talking once to the late Rakesh Jhanjhunwala. This is during COVID. And, we were on a Zoom call. We have both contributed to Ashoka University. So we are both co-founders of Ashoka University. So we were just having a chat on Zoom. And I asked him a question. And he said, Sanjeev, if you find a truly great company, why not stay forever? Okay. Now, I'm not saying I'm going to stay forever, but this was his advice. He said, that's what I've done at Titan. And it really worked for me. Okay. So you should think really long term.
Okay. So now I think we'll transit to a little bit on AI and its impact on India in the Indian context, of course.
So what AI is doing is actually, it is actually now creating a fascinating paradox, according to me, sir. There is, on one level, this valuation of platform companies and SaaS companies, which are actually, coming down in the international markets. But there is also an existential question about job losses, consumer stability, and what will happen to when productivity increase happens because of AI-led improvement. What will happen to job losses and all that? So, from your position, sir, you have seen everything. You've seen platform companies. You have been, there. So, what is your feeling about this challenges? Is India going to face some kind of a problem to face this challenge as we go ahead?
So look, there's a lot of talk, a lot of noise, a lot of apprehension, and even we are apprehensive, okay? Because the truth is we don't know. Even we don't know. So
nobody knows.
You can't say for sure. But, I take heart from history, okay? So in 1985, wasn't my first job. I was 21 or 22 years old, and it was the Rajiv Gandhi government, and that government had said, we are going to put computers into banks. Now that time most banks were public sector banks, and they're a very powerful union, the All India Bank Employees Association. It was one of the most powerful unions in the country, and immediately there was an uproar, and there were strikes, and there was also that we're going to lose jobs, and the government got in the computers. For a couple of years, nobody used them. The employees just refused to use them, but gradually they began to use them, and nobody lost jobs. They just improved the productivity. Now, of course, AI is spreading at a much faster pace than what happened in 85. I'm not saying that that people won't lose jobs. They might. And in the past also, when technology has changed, people have lost jobs. I mean, when I started my career, there were manual typewriters, there were secretaries.
They have reskilled later on.
I mean, those specific people may have reskilled, may not have reskilled. But new jobs are created.
Right, of course.
Right? Or the telex operator. What happened to telex operator?
Yeah.
There was a job there. Nobody uses telex. It's over. Okay, but new jobs have been created.
Right.
So I don't know. So my advice to young people who are worried that jobs will vanish. Look, you don't have to care whether jobs will vanish. You have to make sure your job does not vanish. And if you want your job to not vanish, just pick up AI skills. Learn to use AI platforms. Pick up 2 or 3 AI platforms every month. They're useful. And if you have mastered a few useful platforms, believe me, your job will be secure.
Yeah. So I think, sir, one similarity between the 90s and thing which I personally see is the fact that initially when internet happened, there was a lot of capital investments. And so a lot of computer companies and all that, India was never there as a part of that. But once internet was well and truly developed, Indians, started using it for the benefit of productivity and all that. Maybe something similar where in the period where AI infrastructure is being developed, India is not big in it. Neither is it in AI infra, nor is it in semiconductor, so on and so forth. But when it is done,
we may not be producing semiconductors to the extent that China does, Taiwan does, US does, but we will be consuming them.
That's the point I was going.
Okay. And that will likely increase our productivity. And will some people lose jobs? Possibly so, but many more new jobs will come up. So what will happen? I don't know. But in the past, whenever there's a new technology has come, there's been some disruption. Yes, there has been disruption, but there have been many, many more opportunities.
Okay. Right. Sure. Shifting on to the current new age companies and what is happening in the market right now. Sir, I don't want you to, of course, talk about any specific stocks. It's more about broad sectors and broad macro themes that I wanted you to address. So there has been a time when there has been very aggressive funding of new age companies, very aggressive valuations and all that. But over the last, say, 1 year, 1.5 years, I think some level of mediocrity has come to it. Some level of correction, I would say, has come to it. And today, would you advise promoters to go for minimalistic funding, build your business, grow, and then, take it? Or would you want to, tell them that go for aggressive?
See, there is no one size fits all. Okay. Now, having said that, it is also down these things are market cycles. When there's lots of money, as there was in 99, 2000, again in 2008 to 10. I mean, before the global financial crisis, and then with TARP, and then just before COVID, and then again a couple of years later, there will be abundant capital, right? And when there's abundant capital, it finds its way everywhere, all over the world. And it usually starts off in the US because that's where, the notes were being printed. And that's where the Fed was expanding balance sheet.
Yeah.
And it was the largest central bank in the world. And some of that money found its way to India also.
Yeah.
And therefore valuations went up. A huge tsunami of capital came in. Some companies raised a ton of money, others less so. And the truth also is that if a company gets too much money too soon and too easily, it very often tends to spend it suboptimally.
Makes mistakes.
Well, you assume that the money will not stop coming.
Right.
Okay. And then if it does stop coming, which it often does, but then you build high cost structures and not enough revenue and no profit. That's when you get into trouble.
Right.
So I think smart entrepreneurs will sort of raise the money that they need a little bit more and a little bit more, and possibly a little bit more than competition, or at least as much as competition, but then not spend it foolishly.
So you have been here for 30 years in this, 30, 35 years, or maybe 40 years in this market. And you have built, invested, shaped the entire internet boom right from the beginning. So what is it that you think still excites you at this point of time? And both from your perspective as a personal, as well as from a national.
I think young people, fresh ideas. When you meet a young startup and they're doing good work and they're talented and intelligent and hardworking, I find that I get a lot of energy. So when you meet young people doing good stuff, you get a lot of energy. Right? If I just met I'm 62. If I just met 65-year-olds only, I may not get that energy.
Okay. So move along with the younger set of people to get the ideas. And so any learnings over the last 30, 40 years that India can borrow from a country like US or a country like China, because they have had two very different types of regulations, different types of...
So I think India has benefited a great deal from investments in technology, some of it private sector, and a lot of it from the government. I mean, take the UPI.
Yes.
The India payment stack, right? That is largely a government endeavor. And that has been transformational. I think China and India have got the best payment stacks anywhere in the world. And if a lot of the West and other countries don't trust China so much, then India is a natural recipient of that competency that we built.
Right.
The benefit of that. I think the health stack, the digital stack, I think enabling regulations, I think Startup India, these are all things the government has done. And having created the right environment, right? All the regulation around, Digital India around mobile telephony, and then the private companies come in and build on that.
Right.
So a lot of that is something which I think India has benefited from in the last 20, 30 years. And we must continue to leverage. Of course, there's a whole areas where we are behind the US or behind China,
right?
And we need to work on.
Right.
But by and large, I think what's happened in India in the last 25, 30 years, has been good.
Okay, excellent, sir. So now we'll shift to the rapid fire section. So when you decide to invest in a company, obviously you search for what is the problem that company is trying to solve. While looking at that, do you rely on intuition or would you want to do a detailed market analysis?
I mean, both. You need, but not market. I mean, you have to understand the consumer and you have to look for indications that, this thing has got some natural traction, that customers are coming, they're coming repeatedly. The company doesn't have money, so it can't spend on advertising, but customers are coming anyway.
Okay.
And if that is happening, chances are the company is onto something.
Okay. While running a business, sir, you will go for hustle, what you call as jugaad, or will you go for a system process-driven execution?
You need both. So actually, when you see a startup to succeed needs many things, but it needs people with three qualities. may not all be the same person. There could be 3 different founders, but hustler, hacker, visionary.
Hustler,
hacker,
visionary.
Okay. So you need somebody with a big idea and strategy and thinking ahead. You need somebody who's a hustler, making it happen,
right?
Raising the money, making sales happen. And hacker, the guy who's building the stuff actually.
Absolutely, beautiful answer, sir. When you look at choice of an organization structure in a company that you have recently invested, let's say, would you advise a company to go for a small team with a relatively higher pay per head, or would you tell them go for a large team with a lower blended pay cost?
I think in the beginning you need missionaries, not mercenaries.
Okay.
People who believe in the idea, believe that they're doing a good thing, and they're not doing it for the money. Now, obviously, they have to be paid well enough to live, maybe a little bit more, but they should be generously compensated with stock. So if they believe enough in the endeavor, in the vision, in the company, they should believe that stock will have value in the future.
Okay, great. And rewarding top performers, cash bonus or ESOPs?
Both actually. See, people in sales want sales incentives,
right?
But if you don't give them ESOP, afterwards when the stock gets valuable, they will look back and feel cheated,
right?
So I recall in the early 2000s, when we gave ESOP to people, they would not value it because there had been no example in the past of people getting wealthy on ESOP. And so they said, look, we want cash payment, money. But eventually we had to give both. So we did give both.
But you feel stock being a currency for a listed company, ESOP is a very good way of defraying costs and to make the employees participate.
No, it's not. You're not defraying cost actually. ESOP does have a cost.
And the implied
Black-Scholes.
Yeah, Black-Scholes cost.
Okay, and it goes into your P&L. And because when you dilute giving stock, you're diluting shareholders.
Yeah.
It does impact your EPS.
Yeah.
Right, as your shareholder base, your share base goes up. But you see, and also when you give stock in a private company, and then it goes public and it's a good IPO, then the kicker is that much higher.
That much higher. Yeah.
Whereas if after a company is listed and you give stock, there's a limited amount of rewards you can give for stock.
Right. Sir, organic growth versus inorganic growth.
So historically, we have never been good at inorganic growth. We've done some, but we've not done any big acquisitions. We think big acquisitions are hard to integrate. We prefer to build. So we are builders, not buyers.
Okay.
But having said that, we've done some acquisitions.
But you would advise people to be on the lookout for both kind of opportunities?
Yeah, both can work. We have been unable to do a big acquisition.
Okay.
Perhaps we are conservative.
Okay. Sir, a few questions from the point of view of an investor, not as an entrepreneur, but as an investor. You invest in a business model versus investing in the right team. What is most important?
Early stage, the team is very important. Obviously, they have to be chasing a good idea.
Okay, sure. Profits or cash flow?
Cash flow first.
Cash flow first.
Profits is something which
will come later.
See, when you're doing a startup and you're bootstrapping, it's operating cash flow that counts. But that ensures you can pay your salary at the end of the month. Now, the profit was something the CA would determine at the end of the year. Okay, this is the profit, this is the tax. Now pay it.
Yeah, right. So cash is more important.
Yes,
actually.
absolutely.
And in a company, how would you like the capital to be returned to you? Would it be in the form of dividend or a buyback? Or maybe you don't want the company to give back the cash, you want them to invest?
I think the company should invest and grow and eventually go public. Because as an investor, we will get our best returns when a company goes public.
No, that's right, sir. But if they are generating cash profits, would you want them to look for acquisitions and grow the business, or you would want them to return the money to the shareholders?
I would want them to grow the business because startups are about growth. Yeah. They're not about giving dividends.
Yeah, exactly. Most important trait in a founder, integrity or intellect?
The single most important quality of a successful entrepreneur is the ability to create trust across the tables. I'm able to talk to somebody and generate trust, whether it's a prospective employee, whether it's a co-founder, whether it's an investor, whether it's a customer, whether it's the taxman who comes calling, right? Can I create trust across the table? And if you're the kind of person who can create trust across the table, that's half the battle won.
Okay, wonderful. Last question, sir. What is a better trade-off? A low valuation, low growth company that you're acquiring or a high valuation, high growth company?
we would go for growth.
You would pay the price for this.
Because, the valuation, today's valuation, which seems high today, would seem very, very cheap 2 years from now if the company is growing very fast.
Okay, absolutely. Yeah.
Of course, if you pay a high valuation, then the company fails to grow, you have a problem.
They have a problem. Yeah. So you said your conservative would actually went for the aggressive option.
Yeah.
Okay. Thank you very much. Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Sanjeev, you are widely recognized as a visionary leader and a pioneer of India's internet landscape. We want to broadly deal in three areas. The one is, of course, the whole AI-related challenges and opportunities. The second subject is the evolution of newest tech companies. Third, time permitting, investing into these companies, especially when they transition into public market. So coming to the first one, Sanjeev, let's begin with a critical observation regarding India's position in the global digital landscape. India stands as world's most enthusiastic consumer of global digital platforms with staggering user numbers. We are largest Facebook audience, over 400 million users. Instagram, 472 plus million users, surpassing US. WhatsApp, is over 530 million active users. And we are already a second largest user of Anthropic, just behind US. The key concern that arises is India has primarily been a consumer rather than a builder of these foundational platforms. This leads to the core anxiety when global investors assesses India through an AI lens. They often perceive it as world's largest captive market for tool builds elsewhere rather than a nation hosting the next NVIDIA or OpenAI. Having closely observed the rapidly evolving landscape of global technology and innovation within Indian context, Sanjeev, we are keen to understand your perspective. Where do you see India digital tech stacking up globally? And do you believe India can emerge as a meaningful innovator of newest tech in coming years? If so, what will it take us to get there?
देखो, LLM बनाना मुश्किल है, महंगा है, and हमको देरी भी हो गई है, ठीक है? So it's not as if India will make a lot of LLMs and make them fast and and so on. What we have going for us is data. We've got possibly the largest amount of data after China, and China is a walled garden, so you don't get Chinese data. So the question really is, what can we do with our data? But our GPUs will, at least for the foreseeable future, have to come from outside. The LLMs we use will be global LLMs, right? Of course, there's enough open source out there, okay? So you can do some stuff. But our IP will be built around our data. Now, can we do stuff? Answer is yes. It will necessarily have to be collaborative with mostly the US companies, maybe a little bit with China. And it's not as if we can't succeed with that strategy. We can. Would I love to have 5 Indian LLMs that are global? Answer is yes. Do I see it happening next 5 years? Answer is no. And we have to live with that.
But Sanjeev, in the context of our consumer tech companies, including yours, Naukri, or some of the ones that you, of course, invested early, like Zomato or Policy Bazaar, they deal with millions of data points, like what you said, which is also a treasure in some extent, and of course, they deal with millions of users, billions of data points. You said 5 years, but Prasanna in his opening remark mentioned that US took 30 years to build all of that.
Listen, let's understand how much capital it takes to build an LLM, right? So let's take a OpenAI, ChatGPT. Let's take a Anthropic. Let's take any other LLM. I mean, tens of billions of dollars, right, is what it took now, and it continues to suck in a lot of money. And then the data centers, right? So in India, who has that kind of capital? It's not venture capitalists, and the venture capitalists did not create the LLMs in the US. Because when VC fund का life होता है 8 साल, 10 साल, 12 साल. This is a 20-30 year game. Right? You're here from Axel, right? You think Axel in India can fund an LLM stay for 30 years? Not. The funds are not structured like that. They're not large enough. Right? Who can do it? Government can do it. Large public sector companies with big balance sheets can do it. very large private sector, companies like Reliance, Adani, Tata's, Mahindra, they can do it. Right? You need to deploy that kind of capital. And very often, there is no light at the end of the tunnel. You don't know if these LLMs, will they be profitable? Even now in the US, you don't know. So I don't know, whether we are positioned to do it. I mean, no, we can sit over here, हम तो पैसे नहीं लगा रहे. उनको आप लगाओ पैसे. Nobody's going to do it, right? So I think in India we have to cut our coat according to our cloth. We do not have the kind of capital that US and China can deploy, and therefore there will be fewer concentrated efforts, possibly government supported aid, which will perhaps make some headway in this area.
So Sanjeev, in some sense, recalling your early days in Naukri, when your competitor jobahead.com, ahead of times raised a lot of money and posed a potential disruption. Do you see a moment like that? Do you think you were lucky, of course, but do you think our ecosystem will be lucky?
See, the ecosystem may or may not be. Companies have to be lucky. Now, will there be enough lucky companies and good companies? The answer is yes. Okay. We ourselves, for example, we began to invest in AI pretty early, and before Gen AI, I mean, around 2008-9, we began to do stuff which today is called AI. We didn't know it was then. We were doing it, but now, if I look back, that's AI. Right? That time we didn't call it AI. Right now, we've got about 130 AI engineers. We've got another 30, ML engineers, 150, 160 inside our company, just working on Naukri, to using AI to improve what we are doing for our clients.
So, Sanjeev, will shift gear to the new age tech companies in India. When you embarked in your journey for Naukri.com, internet penetration was, of course, very nascent. I mean, you acknowledge that, when you hosted Naukri on internet, India had barely 14,000 registered users. Yeah, but fast forward today, the digital economy in India is booming. It's a vibrant startup ecosystem has emerged already. The startup ecosystem has undergone a remarkable transformation. And here, what it is. You see, the focus is now shifting from the fundamental question that does the problem even exist to the target market, sizing, to the validation of unit economics, and then to next is profitability. Where do you see this going? What is the next phase of this evolution? Where do you see the trajectory?
देखो जब पैसे कम होते हैं ना, आपको profit बनाना पड़ता है, ठीक है? So when we started, there was no venture capital in India, and there were 14,000 Indian accounts, and we had no money. We were broke, and we said we have to break even in this. If you don't break even, you can't survive. So we had a sales target, and our sales target was simply this: that if we can get 500 companies in India to give us 1,000 rupees every month to list one job on the website every month, right? That's 5 lakh rupees a month. That's 60 lakh rupees a year. If you can reach that in 3 years' time, we can be profitable. I can take a salary. It was a simple sales target. Vision, there was no vision yet. There was just a simple sales target. So companies that have a sales target break even and make a profit. Companies that have a vision make a loss, right? Let's be clear about that. So, पहले अपना sales target ठीक करो, achieve it, make a profit, then you can evolve a vision. So I think और जब पैसे आ जाते हैं ना, then people say हम तो vision है, हम दुनिया बदल देंगे, वो सब ठीक है, but पहले यार profit बनाओ, ठीक है? Get to break even.
So Sanjeev, on the related note, right? You coined a term called repeatable profitable unit. What I learned is that you look at almost 1,000 startups every quarter as a firm, of course. Did you, in the recent time, come across, something, which embodies this philosophy?
We used to sell by direct mail. Okay, हम चिट्ठियाँ भेजते थे to companies. We had a mailing list, and they would send us checks in advance along with the job information, which we would upload on the site. So we had reached 3 lakhs a month of sales. Okay, when we raised venture capital from ICICI Venture, and one day Hitesh had a brainwave. He says, "Yeah, let's hire some 3-4 salespeople in Delhi market and see what happens." We had got the money, in the bank. हमने 7.5 crore raise किए थे. So we said, okay. So Hitesh hired 4 salespeople, and they went out in the field to try and sell. And we discovered a few things. The total cost of an average salesperson was 22,000 रुपए महीने का. We basically 10,000 rupees salary, and sales incentive, conveyance, you load on the office rent, the air conditioning, the shared computer cost, all that. So, 22,000 रुपए आता था. And we learned that within 4 months' time, the average sales guy was delivering revenue of 50,000 रुपए महीने का. There is no variable cost in putting up an extra job on Naukri, except data entry, and that's very little. So essentially, the salesperson was making a 28,000 rupee profit on his own cost. Right? And this number was headed north because 50,000 was growing. जो sales का number था. So we said, boss, this is a profitable unit. A salesperson is a profitable unit, and it's repeatable. Just keep on adding more salespeople across the country until the last sales guy is not making a profit on his own cost. So that's what we did. Within 3 years, we had got 11 offices around the country and 240 salespeople, and we had grown 35 times in top line, and we made a profit. So what we always say is, for a company to scale profitably, you need to discover your repeatable, profitable unit and then double down on it, step on the gas. Now, your repeatable, profitable unit could be anything. In our case, we're a sales guy. In the case of a QSR chain, it could be an outlet, it could be a hamburger, it could be whatever. But find your repeatable, profitable unit and just double down on it.
Interesting. Sanjeev, I'm mindful of time. Of course, I would love to ask more and more questions and keep learning. But my last question, and a very quick response from you on what is the mantra for surviving difficult times as an investor like we are currently on?
I think stay focused behind and getting behind frugal entrepreneurs. Okay. And guide them through a tough time. And yes, sometimes you may have to give more money than you thought to guide, to sort of allow them to come through. And you have to demonstrate the conviction and play the long game. We have been, we invested in 2008 in Policy Bazaar. We are still there, 18 साल हो गए. We invested in 2010 in Zomato. 16 साल हो गए, we're still there. So in India, अगर आपको startup में invest करना है, you have to play the long game.
Thank you so much, Sanjeev. I mean, it was really candid and insightful, and thank you so much for your time. It's absolute a pleasure, and all the best to you. Thank you, everyone.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
At the New Age Tech Campus event for ICICI Securities reports launch, and we have Mr. Abhay Mathur with us, the CFO of Urban Company. Thank you so much for joining us today, Abhay.
Thank you for having me.
How has technology changed the way consumers discover and trust service platforms?
I think consumers are looking for convenience, quality at the right price. As their lives become busier, they want less and less friction. Any platform which is able to do that will thrive.
Marketplaces face the challenge of serving diverse customer bases. In India, with its many segments and income groups, how do you think platforms can stay relevant across such varied markets?
I think India is not one market, it's many markets. We know that from other industries. So to make sure that you're relevant for every single segment, every single income group takes effort, but it's not impossible.
Thank you for joining us today.
Thank you so much for having me.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
We are here at the New Age Tech Campus event for ICICI Securities reports launch, and we have Mr. Saikat Mukhopadhyay, the CFO of Wheelside. Thank you so much for joining us today. With India's digital infrastructure
moves towards, we're talking about the nearly 900 gigawatt of non-fossil capacity. So there is also a lot of efforts in the direction. If you see, there's a huge amount of policy support. So viability, because we know that when the technology matures, when the volume effect kicks in, and that's where we are able to reach the affordable price point. And we have seen with the solar, we are going to see the same way the battery energy storage in that. And initially, the government has set up the policy support in the viability gap fundings, and also 100% waiver of interstate transmission schemes. All these things is to ensure that the volume effect will kick in and the adoption of the technology will come into picture. And once the adoption technology comes in picture, then everything will become a business case itself in that. The integration, so why the energy storage, battery energy storage? Because the integration of solar and wind energy for grid stability, and battery storage is also an instrumental source supporting renewable around-the-clock power in that. So this is the second unlock. And the third one is also very important, is to ensure that the 900 gigawatt of power we install and generate, how does it reaches to the nook and corner of this country? And that's what is what you can see here. The Central Electricity Authority, which has unveiled the plan, ambitious plan for 2035-36, has also categorically mentioned that, we need to ensure that the transmission network and the infrastructure is built to ensure that this 900 gigawatt of generated capacity is ensured, reaches the consumers or where it is required in that. So transmission plan to quickly meet the peak demand of 459 gigawatt. If I give you a scale, this is almost twice of what is today, peak gigawatt. And a plant, and it has got a very clear plans, from where to where in that. So 66 gigawatt of HVDC projects. As you all know that HVDC is a technology, just like how you have a national superhighways built, right? 8 ways, 10 ways, 12 ways. In this HVDC technology, is one highway, you can take up to 6 gigawatt or right up to the 12 gigawatt. So that's the kind of technology being built in that. So 66 gigawatt of HVDC lines, they are planning and expected to commission by 2035, because the generation will come in, and by that time, you need to have this thing done. Depending upon the size and scale of this project, we are talking about anywhere between 10 to 20 projects in the next few years in that. So there's a third unlock. And the fourth one, guys, can you please check this clicker is not working, please? Back. Yeah. So the fourth one is also very important. While we have seen the generation is coming in, and we've also seen how the energy storage will play around, we're also seeing the transmission is also being built alongside the generation coming, so that whatever we generate, we are able to transmit wherever we want to that. But at the same time, the electrification is accelerating across the sectors. If you recall my first slide, where electrons are replacing the molecules, and this is the one good examples that every industry, steel industry, for example, we are the second largest manufacturer of steel in the world, and among the top 3 countries in forging, industrial heating, and there is a big opportunity to replace that industrial heating with electrons. And wherever it is not possible with the direct electrons, we can replace with the green hydrogen. We have seen a prolific adoption of electrical vehicles in the 2 and 3 wheelers space, but gradually the early cycle of the LCVs and also HCVs and also mining equipment is a big opportunity in that. This structural shift across industries and mobility will significantly strengthen economic growth and in turn drive rapid urban expansions. India is expected to add nearly 30 million people to its urban centers every year through migration, natural populations, and job opportunities, etc. As a result of urbanization, levels are projected to increase from approximately 36% in 2025 to 40%. So that will be additional driver in addition to electrons are replacing in the steel industry, in the industrial heating circle, in the transportation sector like electrical vehicles, in the buildings, data center, as you all know. I'll come back on the data centers later, but the sustainable fuels in that. This is why I'm saying the massive opportunity in every part of our where we are operating, electrons are replacing molecules. Many times what I am saying, the rate at which it is happening and the speed at which it is happening, and we ourselves are recalibrating on that. Electrification across the mobility sector, if I talk about this. Another study and a significant driver of electricity demand is mobility. We all know that. And Indian Railways mission to achieve 100% electrification is a cornerstone of this transition. They already completed 99%. But if I tell you how much of billion units this particular initiative is adding into the grid, talking about 29 billion units annually. 29 billion units annually. the one initiative of, electrification of the Indian Railways is adding into that. Similarly, we are talking about the metros. So there are plans of 2,000 kilometers of metros. And if I give you how every 20 kilometers, you need 6 power transformers and close to 60 dry type transformer, in addition to the rest of the equipment like a switchgear, like automation, power, automation SCADA, and 2,000 means just multiply that in that. The significant opportunities for the electrical industry equipment in that. The final dimensions of the mobility is the electrical vehicle. While EVs, we all know that are still at a relatively early stage, growth rate remains strong given the low base, but we've already seen a significant adoption of two-wheeler and three-wheeler, but we see the massive scale in going forward in that. And the next one, which is very, very important, is the data centers. And right now, data centers in India, if you take a hyperscale, co-loco, small data center, is less than 2 gigawatt. And one of the most substantial emerging demand drivers of electricity is the DC. And driven by, the drivers are, we all know that driven by AI workloads, cloud adoption, and stringent data localization requirements in that. Talking about anywhere between, depending upon what, which report you refer, anywhere between $50 billion to $100 billion investments, talking about next 2030. 13.65 gigawatt, and in other report we are talking about 15 gigawatt, but everything is a radical, deployment of the data centers. The data centers, AI-led data centers demand also brings a new level of complexity to power system. AI-led data center, I've seen myself in one of the AI-ready data center. The swing of the power in an AI-ready data center is 250 megawatt in less than seconds. Less than seconds. It goes up and comes down in seconds. That means you need to have a one power plant going up and coming back in a one data center. The complexity arising out of this variability of this nature is a huge. It needs a complex infrastructure, needs a complex power systems, and the existing ones need to be refurbished on that. It's a very unique transient dynamics and heavy varying stages of load behavior, and it's not possible to do that because any of these AI-ready, if you put a query on the chat GPT, the load on the data center racks is 9 times. I myself seen at that time. Maybe over a period of time, this also will become efficient. The 9 may become 6 times, but that is the kind of thing in that. Compared to a Google search, it needs a X percentage. You put a query on the chat GPT, it needs a 9 times of the momentary power in that. So what's happening in that? Hence, while the modern power system continue to serve the same fundamental objects, so power system has remained in the last 50 years, it's the same thing, right? You have the power, you have voltage, you have various loads in that. But today, it is completely complex. It will be much bigger, and it will be much more complex. I was talking to one of the TSOs, and he's saying that earlier we used to have a few takeoff points and even more few, input and output, takeoff points and things. Today it is multiple takeoff points and multiple input points in that. The grid is becoming more complex, and the generation side, we are seeing a significantly higher variability due to the increasing share of renewables. You all know the renewable means what? It brings your intermittency, and it brings the power quality challenges, right? The intermittencies are so huge. You can't predict that, how do we manage the complexity out of that in that. And that's about the supply side. But on the demand side, consumers are no longer just consumers. They are also producers, leading to the bidirectional power flow across the network. In addition, the power system is evolving into hybrid architecture with an increasing mix of AC and DC systems. Under these new conditions, managing the power system becomes more complex and more challenging without deploying the technologies in that. If I give you one example without going into the too much of technicalities, look at the second chart in that, where one of the sunny day, one of the summer day, where this is the actual hour of the day on that particular day Look at the red curve, the variable renewable energy in that, okay? And also look at the net demand in that. So how do we ensure that, these kind of peaks and troughs, the system need to manage it. That's where the complexity comes into picture. In addition to this, also operational challenges. The grid facing a new environmental factors, where the climate vulnerability with the extreme weather events from a deep freezes to intense heat waves and simultaneous spike in electricity demand and damage grid infrastructure and compromising resilience. All those things are one side in that. Cyber security, with more and more digital assets we are putting into the grid, the cyber security threat is no more a threat, but it is a real in that. So how do we ensure that our technologies will come and play a major role to ensure that every equipment going into the system today is a future-proof, not only future-proof, but future cyber-proof on that. And the last but not the least is very important, the energy trilemma, what we talk about, affordability, sustainability, and security of supply in that. So balancing sustainability and affordability, energy security continues to be a complex and evolving challenge of all stakeholders, not only from the government standpoint, government, regulators, and policymakers, everybody in that. If you take all three things together, these factors further reinforce the need for a fundamentally different approach for designing, operation, and managing the power system of the future. So what is the mitigation actions for this? So if I talk about the first mitigation action, in this evolving landscape, ensuring reliability despite potential gigascale intermittency becomes absolutely critical. And you have seen the graph, red graph in that, right? That's a real, and managing that also is real in that. This requires a portfolio-driven approach that continues high capacity storage, geographic diversity, renewable resources, and so on and so forth in that. But if you look at the draft National Electricity Plan, there are a lot of things are talking about, enabling technology solutions to manage the complexity arising in that. Automation, digitalization to manage growing complexity in that thing. The National Transmission Asset Management Center, which recently we completed, is a one good example to talk about that. The second one is India Energy Stake. Just like how UPI, the Unified Payment Mechanism we have, and this is what Government of India has launched this, where peer-to-peer energy trading is going to be the heart of that in that. It's quite a big shift in that. If we are successful in that, it's a huge opportunities, and we can also become a kind of global benchmark in this India Energy Stock in that. We're happy to inform that Hitachi Energy is also playing a very massive role in part of this designing this India Energy Stack in that. We are not there yet, but I think the direction looks great in that. And the second is that we also need the technology, products, systems which go into this future power system in line with whether it is an upgraded transformer, whether it is a digitally enabled, sustainable, optimized, and the SF6 free gas certificate. We're talking about, so much on the sustainability. If I give you one or two example on that, SF6 is gas most of the industry uses in the equipment of the electrical industry in the massive scale. And if I give you greenhouse gas, SF6 gas is 23,000 times more potent than CO2. And this will be in the atmosphere for 1,000 years. 1,000 years, I repeat it, because sometimes when you hear this, it's very scary, but that's how it is. And there are a lot of efforts happened over a period of time to ensure that we replace this SF6 gas in all the equipments. There are already legislations in Europe and North America at some point in time, complete replacement of that. And we see a lot of our products are suitable for this kind of environment in that. And since it is a complex network, we need to have a lot of digitalization to understand the predictive analytics and preventive maintenance, predictive analytics, because a lot of thing depends on the energy, electricity and that. Because more and more you're electrifying it, and important is that how do we ensure that the reliability of this electricity is not like a previous times, but even more than in that. Advanced monitoring and predictive analytics, enabling proactive risk assessment, not only for asset performance, but also for environmental and operational impacts. These technologies will help to support the evolving needs of the energy transition. In addition, the business model. Building on these two things, last I talked about policy supports and also energy stock example, and then the products and technology. Building on these trends, innovative solutions are now emerging that combine two powerful mega trends, decentralization and digitalization. One such concept is energy hub, a flexible power supply model that integrates multiple on-site generation and storage assets. This becomes particularly relevant for the industries or data centers that are challenged by constraint on the grid connectivity and high energy cost while pursuing the electrification at a scale in that. So these are a couple of examples that what are the mitigations in that. So that's the first chapter, but the next couple of minutes I would like to talk about my journey, our journey, Hitachi Energy journey, how we are powering this energy landscape, what you have seen in that. As a key enabler, Hitachi Energy, you all know that our portfolio, be it a product, system, services, software, is the bridge between the generation and the consumption. So we are there in the generation, we are there in the transmission, we are there in the distribution, also on the consumption, whether it is an electrical vehicle, whether it is a data center, railways, etc. So what we did, we carved out from ABB, you all know our story. In the last 5-6 years, our orders have gone 5 times, our revenue has gone more than 2 times. And the last 5 years, we created not only for our listed company, but also in our other company where we have the Global Capability Center, all put together close to 4 times our employee base in that. So offshoot of all this, you understand where we are in terms of our market cap. And 9 out of the 18 HVDC links, including the new links in India, they run through our technology. This technology has been invented by us 70 years back. Continue to invest, continue to innovate, bring the new innovation into that. 1 out of the 3 locomotives, whether it's the Shatabdi, Rajdhani, new Vande Bharat, is powered by Hitachi Energy's transformer manufactured locally here in that. More than 60 gigawatt of our renewable, it runs through our technology in that. 80% of the metro use our technology. This was possible only because we continue to develop and introduce leading edge technology, whether it's the innovation, whether it's the grid to rack solutions, whether it is AI data center ready, and also, as you said, SF6 free switchgear, and all these things we continue to bring it to our customers in that, whether it is in the new data center, whether it is electrical vehicle charging. Some of our charging technologies will get a boost of the charge to the buses in less than 20 seconds. Less than 20 seconds. As people are getting off the bus gets 1/4 of the charge and keep going in that. You need these kind of technologies to ensure that the really electrons replaces the molecules and at the same speed as we are there. And we are investing in India. In anticipation of the demand, we are always ahead of the curve in investing in that. This is what in the last 4-5 years, we have continued to invest. Last 4-5 years, we have invested. And in the next 3-4 years, even more investing in that. We announced as part of our 75-year celebration in October 2024, we announced a 2,000 crores investment in that. And in addition, in the last 2 weeks back, we announced an additional 2,000 crores investment to set up our greenfield power transformer factory in Gujarat. And groundbreaking of that is scheduled on 12th of this month in Gujarat in there. So altogether, 4,000 crores in own capex manufacturing in that. Additionally, we are also doing investment, our people, building up the capacities, global capability centers, innovation centers, so on and so forth in that. So if I conclude, before I open it for a Q&A, in this rapidly evolving electricity landscape, where electrons are replacing molecules at a rapid scale, not only we strive for operational excellence, this is very, very important in that, but focus on foundations and operational excellence in that. Accelerate our strategic growth and reinforce our market-leading positions, invest capacity ahead of the curve, and that's what we have been doing it. We continue to do that. And we leverage digitalization is extremely important. The IT, OT integration is the one area where it is taking shape at a massive scale. That is in the energy sector in that. And with this, we aim to maintain our faster than market growth and healthy revenue to order backlog ratios in that. This is my last slide. And this is a very important slide, not only from the investment company standpoint, but also personally in that. Why do we say the next 25? The next 25 means the decision we make today will impact the next generations. That's a sustainable. The decision we make on electrification today will shape the world for centuries to come. Not only for our generations, but the generations to come that. Electricity powers our industries and countries, communities, underpinning innovation, manufacturing, production, services, and ultimately the well-being of people and prosperity. Electricity provides cleaner, renewable power, reducing emissions, and accelerating the energy transitions for a more sustainable future. So, ladies and gentlemen, that's why we call our work is crucial for sustainable future of people for the planet. Thank you very much, and thank you for listening to me. And happy to take any questions if you have.
Yes, ladies and gentlemen, there will be questions from the audience. You all know the drill.
Yes.
Please raise your hands and you can ask a question. Thank you so much. Over to the audience.
Thank you very much, Mr. Venu, for that insightful presentation. I'm focusing more on the slides that's got to do with accelerating electrification and the contribution by Hitachi Energy. So that's phenomenal. Again, I'm zooming in primarily into the data centers, and then your following slide was about the conventional way, the conventional way of setting up these centers and the new way of doing it.
Yeah.
So these data centers today are known to be disseminating huge amount of heat in the environment, as well as huge amount of consumption of the water, which is actually disrupting and degrading the current environment around us.
Right.
So what is Hitachi's plan or vision or roadmap to try and ensure that while you all are focusing on the building of the data centers, you're also taking care of the environment and ensuring that it's sustainable?
Yeah, absolutely. No, I think this is a really great question. Thank you very much for that. When it comes to data center, you're absolutely right, because data center is also like a heat sink. It produces the more heat, right? So let me first talk about what we are doing, then I'll also give you a little bit of industry viewpoint, okay? From Hitachi Energy, what we are doing is that we are ensuring that every product we send inside is more sustainable than what it used to that. I give an example of that. For example, the data center today, they use a lot of switchgear, which has a lot of SF6 into it. And then we try to, offer to our customers alternative things, which is SF6 free. That is itself is a big chapter in that. Then second one is, we do a lot of optimizations, okay? 1 + 1 is not 2, 1 + 1 is how do we ensure that we have more than 2? And we bring a lot of our digital technologies and we optimize the energy requirement. One is that what is energy, and then the efficiency of the energy requirement. So also the grid connection, the optimization, all those things, we will do that. From the industry standpoint, I think there's a lot of research doing, which not Hitachi Energy, but Hitachi is also doing on the cooling. How do we ensure that we bring the efficient cooling so that we bring the whole emissions down in that? I think there's a lot of opportunity for the industries who are already in the cooling to ensure that we have a balance in that. But again, we need to, you're absolutely right, we need this growth, but at the same time, we need to also ensure that the sustainability is matched in that. Thank you. Thank you.
Hello.
Yes.
Thank you very much for your insightful presentation on the electrification.
Right.
I think Hitachi is playing a very important role on the Indian electrification. So I want to just understand from you that how does the energy cost of India,
how much?
How is the energy cost of India versus the Europe or the US? Because we have been finding always in Europe, you can buy power for next 5 years and lock in the price. So what happens is to the manufacturing industry, which now government is saying that they should focus on manufacturing industry. So the GDP growth and other things are going to be driven by manufacturing.
Yeah.
So how do you think that the power cost will come down comparable to Europe or other places, and the same way we can buy the power for next 4 years, 5 years and remain competitive?
Right.
Please throw light on it.
So let me give you one example of our own thing, what we have put it in our operations, and then I'll come back to you on your thing. You know, when we announced our 2030 sustainable targets for Hitachi Energy in India, so one of the metrics was, you know, we power all our facilities with a renewable power. So we said, we announced it in 2021 or something like that, and we have a target for 2024, but we reached 1 year before itself. So when we changed to renewable, of course we did in 2-3 different ways, and our cost of power is much, much lower than what we were paying it to the ESCOMs. Okay, and it's a very substantial reduction in that. And today, all our 19 factories, our project sites, our offices is all powered to the renewable power. Okay. Then I come back to your question is that how we are comparable with the Europe. We all know that our power cost, okay, it's a different tariff, but even if you take an industrial tariff, is very, very competitive. But it is not about the cost. Where the challenge lies is reliability. Where we are far behind from other countries is reliability. Just imagine the West Asia crisis. When West Asia crisis happened, we didn't have LPG supplies. Many of the hoteliers in Bangalore, where I live, is all shut the things because they would have easily converted into the electric cooking had the reliability has been guaranteed in that. So we have a challenge on the reliability, and that's where we need to work on that, and that's where we see most of the National Electricity Plan, etc. They're talking about the reliability, bringing the more technologies come into that. In that cost-wise, we are competitive. Thank you.
Yeah. My question is, since you have been in this sector for a pretty long time, see, we had a similar kind of projections when in 2006, 2008.
So long time is not my age, right?
We were in industry at least for more than 20 years.
Right.
See, we had a similar projection from in 2006, 2008, and then there was a big thing.
Yeah.
Then suddenly for next 10 years, GE went almost bankrupt, Hitachi and ABB also had a problem there. So what went wrong and what lessons and what risk and why we did not go or we won't overbuild this time?
Yeah.
That is what my question is. Just a basic problem.
No, I think it's absolutely a valid question, and I fully agree with what you talked about, but it's a two different things. Today is a structural change. Earlier, our only thing was to add capacities. So we started with the power plants, ultra mega power plants, those are the things, only thing in that. Without looking in the rest of the thing is that. Today what is playing, 3-4 vectors are playing. One is very clearly irreversible penetration of the renewable. Whatever we say, the renewables are irreversible. We talked about 500 gigawatts, 600 gigawatt, and also government is talking about 900 gigawatts. With a clear visibility of the transmission, matching the transmission to evacuate this. Even today, we are not there. If you see in many of the places, we are still, you back down, some of the generation because you don't have the matching thing in that, right? So that is what is the thing in that. And third, which is very important, is electrification. The electrification is a massive, and that is what is the thing. So the structural change compared to what we have seen in the previous year in that. So if you add all these things, so electricity growth this year, last year, is in the high single digit or close to double digit. Even if you take high single digit growth of electricity for the next, and that is without data center coming in a big play, it's a massive opportunity in that. So that's what is the difference compared to the previous one. Thank you. Yes, sir. Somebody can give a mic.
Hi, sir. Good afternoon.
Where is he?
Hi. Over here.
Yeah, sorry.
Okay. So my question was more regarding the storage capacity of India, because currently I think the peak demand is about 270 gigawatts, and you said this is projected to increase to 459.
Right.
And we're also seeing massive investments in wind and solar energies, but from what I remember, the storage capacity is under 5 gigawatts in India, right?
Right.
So obviously, as you said, there is investment in storage, but is there enough investment to meet the demand and to meet the investments that are happening in wind and solar as well?
So, yeah, again, it's a great question on that. It's absolutely, without storage, I think the round-the-clock reliable green power will not be achieved. But if you really look at the storage, again, in the Central Electricity Authority's plan is 140 gigawatt. So it's a combination of the battery energy storage and pumped hydro storage, right? So 80 and 60. 80 gigawatt is from battery energy storage and 60 gigawatt is from the pumped hydro. I think the pumped hydro, a lot of projects are happening, many more projects will happen, and the price point and other things should be okay in that. Where the challenge is in the battery energy storage. So batteries prices is similar to the PV prices, It has come down from a $250 per megawatt hour to today 50, 60 megawatt hour. But as you know, government is giving a lot of push for the local manufacturing of these batteries. If the batteries will come down in the range of $25, $30 per megawatt hour, it's a really business case, 25 to 30 range in that. So with the volume effect, what you see, the 80 gigawatt is a really scale. So that has a scale investments, and we are very confident that with that scale level, the price should be attractive to further investments in that. Okay, thank you.
Yeah. This side, right at the back.
Yeah.
Hi.
Hi.
See, I had two questions. One is related to losses. From generation to discount, there is one sector, and second is at the consumption end.
Sorry, second is?
At the consumption end,
Yeah.
big industries and all that stuff.
Right.
So is Hitachi contributing in some way to reduce those losses? Well, that itself is a major contributor on the power sector.
Yeah.
Second question is related to power quality parameters.
Sorry?
Power quality parameters.
Yeah.
Because we have a variable sources of generation from renewable to traditional. And integrating them into the grid and supplying it to power, there are multiple power quality parameter challenges are apparent.
Yeah.
So is Hitachi contributing to that?
Sure.
There are two questions.
Thank you. Again, it's a great questions. So first one, when you talk about the losses, there are two types of losses. We all know that. One is the technical losses, another one is the commercial losses, right? So the aggregate of these technical and commercial losses is the total losses of a DISCOM or a thing in that. Where Hitachi Energy is playing in a big way is in the transmission to ensure that, all our equipment is really, world class and the low loss designs. For example, some of our transformers are very low loss designs. And our HVDC footprint brings a very low loss, 6,000 megawatt of power, transmitting at a very, very low losses comparable anywhere in the world in that. So these technologies, we are playing a very massive, massive role in that. So we will also do in the distribution standpoint, whether it's the distribution automation, demand side management. So those things in that. Where we don't do is the commercial losses. That's where the DISCOMs have to do in that. The second question was on the power quality in that. Yeah, again, this is a very close to us, and you have seen a massive opportunity for the power quality portfolio arising out of the intermittency of the renewables. And we have a power quality, we have the capacitors, we have power quality, automating power quality control, we have STATCOMs. So a whole lot of portfolio we can offer to our customers in designing the power quality, stable power quality solutions in that. Thank you.
Hi, I have one question. You spoke about in your presentation about the big increase that is coming in data centers. You spoke about a target of about 13.6 gigawatts.
Yeah.
My only question is that can power or power availability become a very large constraint to all these estimates, primarily because we are already seeing peaking power shortfalls in the country. where is the capacity to meet this demand? Even 6 to 8 gigawatts, which is far more conservative than what you mentioned, will require, I think, about 10 to 15,000 megawatts or more. Where is that power capacity?
Yeah.
And what is the solution?
Yeah. If I have to be politically correct answer, there is no shortage of the power. Okay. That's what the government states, and I'll also raise that. Where the challenge is the reliability. It is not about lack of power, it's reliability is a challenge is that. So I was just telling you during my presentation, there's still close to, I don't remember exactly the number, anywhere between 20-25 gigawatt worth of generation, they are not able to transmit because of lack of transmission, lack of last mile connectivity, you name any of those things in that. The challenge, I say that, is not about availability of the power. With the 900 gigawatt, with the 800 gigawatt of the renewable, and those things are in place, it's not about that. It is all about how do we ensure that we give the reliable power to these data centers. Data centers, as you all know, is extremely high reliable than any other segment. So far, I've seen 99.999%. So they call a technical term SAIDI, and SAIFI is just in digits, 0.000, things like that. So that's what is our challenge, and that is challenge has been recognized by our policymakers and other people, and I'm sure that those things will be in things. So how do you manage it? It's not. You need to invest in the infrastructure. You need to ensure that the grids are more flexible, robust, and you're able to transmit in other directions in that. It's all about bringing the technology. The good part is the technology is available. They're available in the country itself. The key is to deploy those technologies to ensure that we bring the reliable power and use the automation and integrate the IT and OT in a massive scale and do that. I'm very confident that will happen. Thank you. Maybe one last question. I think time is flashing.
Yeah, this side. Yeah,
hi.
Yeah. Hi, great presentation. In fact, I'm just trying to looking at the fund manager.
Yeah.
I'm paying 20x price to sales, 150 price to earning. What should I budget in if something has to really go wrong? What are the red flags that I should be keep watching in your company to make a sense of this?
I've been saying, the best is yet to come. At that level.
So that's your job, actually.
Anyway, leaving apart, I think, there are a lot of things goes wrong, right? There are many things can go wrong in this country. We have seen this. The policy support has been very consistent for the last several years. And going forward also, we need that kind of support to ensure that these new technologies come in, they're absorbed, they're deployed in that. And we also, in a very complex, highly technology-intense projects we do. And execution is also very important for us. Execution on timeline, cost line is very, very important in that. So in addition to that, we have all this, everyday new crisis will come, every day one tweet will create a lot of challenges, right? So ensuring that, the shipping lines available because we do a lot of exports here. So there are a lot of things are there. But the good part is that we are a global company. So far, we are able to manage those things in that. Yeah, thank you. Yes.
Sir, just two questions and from your presentation itself. So you mentioned that the energy trading is going to evolve into something like a UPI. So
energy, yeah, right.
So if you can just elaborate on that, because what happens to the energy exchanges which exist today for a B2B transaction? One, your views on that. And the second is, Hitachi definitely is undergoing a massive capex cycle, as you said, and probably over the next 4 years, the capital intensity will go up materially. So 4 years out, the turnover complexion of your company, would it change significantly from what we are seeing today? If that you can elaborate. Thanks.
Very good. So the first one on the India Energy Stock, IES, it's just like an UPI, right? UPI, we are able to trade, but banking still work, and rest of the regulator system still work. Same is the case, they wanted to do that. For example, in my own house in Bangalore, I have a rooftop. I have a 20 kilowatt of rooftop. I don't need 20 kilometer rooftop. What do? If I give it to the ESCOM, they'll give a very nominal thing. How can I sell it to you in the same city or different city in that? It's all about that. So we do the peer-to-peer energy trading. all the rest of the infrastructure will remain there. When we are doing our cash transaction through UPI, banking systems, everybody, it'll debit from my account, it goes to your account, but then you have the UPI model. It's the same thing in energy trading. I have the energy, I log into the exchange or whatever it is, and then if I want to trade to you, and that's how it's the thing. That's a direction. We are not there at the product-wise, but that's what is the direction. If that happens at the same scale, I think this is a big innovation in the energy sector in that. Yeah. Yeah. What was the second question? Sorry, I missed it.
The capital intensity of the company is going up materially.
Yeah.
You were 1,000 crore capital gross block till last year, and you're investing another 4,000 crores.
Right.
So how will the complexion of the company's turnover evolve over the next 4 years?
We don't give a forward-looking statement, even though I wish to give it to that. You can look at whatever we have done the capacities in the last 4 years, and our asset turnover in the range of 5 to 6 times. So you can just make your own maths.
So what you're trying to tell us that
I'm not trying to say anything future. All I'm saying is that there is a asterisk mark. Our past is not guaranteed that in future it will go in the same way. Right? With that, I want to leave you. Thank you very much, ladies and gentlemen. It's a pleasure to be here. And thank you very much, Deepak, once again. Thank you.
So I request you to remain on stage, please, Mr. N. Venu. As a token of our appreciation for taking time to share your thoughts and your perspectives with us today, may I invite Mr. Prem Tikuna, Head of Capital Markets Execution at ICICI Securities, to kindly join us on stage and present a memento to our guest. A thunderous round of applause for Sir, please. As India continues to expand its economic footprint, the importance of reliable, intelligent, and future-ready energy infrastructure cannot be overstated. Your insights have provided valuable perspectives for all of us. Ladies and gentlemen, please join me in thanking Mr. N. Venu, Managing Director and CEO of Hitachi Energy, Managing Director, Hitachi India. Every investment cycle produces a defining question. Today, one of the most debated questions amongst investors is India's position in global portfolios. Ladies and gentlemen, we do have a panel discussion coming up, but in the meanwhile, I'd love it if you can tell us how you found our session so far, especially Mr. N. Venu's. I'd love your perspective on that. We have ma'am here. Ma'am, a thunderous round of applause for ma'am. Ma'am, khade ho jaiye, please. Thank you. So, ma'am, what did you think of our session so far? How's it going? Would love your perspective.
See, it's creating a lot of buzz with all our investors which are here and representing the ICICI Bank and all over the fraternity from every segment, manufacturing, CIOs, CEOs of different companies. And it's creating lots of information and insights for the current scenario, that how you can say that renewable sources of energy, fossil fuels, non-fossil fuels on the science side, on the, the building construction, cement. So every aspect of the, you can say the information is being in flow over here, and I believe that everybody is enjoying the session from Securities and ICICI Bank.
I'm sure they are. I am sure they are. Ladies and gentlemen, we have another gentleman here. We'd love to make it very, very interactive. We'd love to know what you're thinking about our sessions. Here is a sir who's dressed in an Indian attire. How are you, sir? Namaskar. Request you, kaise hain sir? Khade ho jaiye excellently. Please, thank you. Looking very wonderful, sir. Love the Indian attire. Hamare sessions kaise lag rahe hain aapko so far?
They are very informative and knowledgeable, and there are a lot of things to take home with it.
Thank you so much, sir. Sir, believe karte hain ki 3 line mein bolo aur wo bullseye hit kare. Hello, ma'am. How are you? Can I get your name as well, please?
My name is Pankti.
Hi, Pankti. How are you finding our sessions? We'd love your feedback, points to take home, please.
It's very informative. Being an investor, I'm learning a lot of new things about the market and securities and different segments.
Thank you. Thank you. We have another very, very dynamic sir here right now who's so engrossed with the stage and the proceedings. He's not looked to the left or the right. Can you please get up, sir? I'd love you to stand. You're such a fit person. I love the fact, fit India, hit India. Give it up for sir's personality as well. What's your name, sir?
I'm Rajesh Rotila.
Rajesh, sir, kaisa laga hamara sessions? the India Investor Conference 2026, India Rising, the next chapter. Would love your feedback.
It's an amazing session. I represent FPI funds and we actively invest in energy sector. We in fact heavily invested in renewable energy sector. And this is a very interesting sector to be in and insights are pretty useful.
Thank you so much. We have ma'am here as well. Ma'am, can I request a minute of your time, please? Khade ho jaiye, please. Ma'am, what's your name?
Ananya Dapke.
Hi, Anandya. How are you finding our sessions? Would love your point of view.
It's like my first year in the industry, so I recently graduated. So definitely everyone here is part of this industry for a much longer time, and I'm learning from all the veterans here, and it's very interesting and very insightful for me.
Thank you, and hope you have a brilliant career as well. Thank you so much. Ladies and gentlemen, we have this wonderful man who's continuously smiling. He should be given the award for the best smile as well. Sir, khade ho jaiye ek second ke liye. Firm handshake, beautiful smile, lethal combination. Sir, kaisa laga hamare sessions up till now?
It's been great. I think there's a great audience, great speakers, so appreciate having all this set up.
Thank you so much, sir. So we've also got this very, very dapper-looking man dressed sharp in grey. Good afternoon, sir. Can I get your name as well, please?
Shreyansh Basotia.
Hi, Shreyansh. Shreyansh, any perspective that you'd like us to understand, grasp, and what's been your takeaway with regard to what's been happening on stage?
So basically, I just graduated last month only. So this is my first year in investing. And also the best part is the Q&A sessions, and the different perspective on the same sector from various people. So that's very inspiring.
How nice, my friend. I also graduated this year only. Thank you so much. Here's looking forward to a bright future. Yahan pe ek sir hai, jo I'm sure has graduated quite some time back. But I know, sir, he's a living legend. Sir, can I get your name as well, please?
Yeah, I'm Sridhar. I came just for this session in the afternoon. Mr. Venu has given the insights about the electrical energy utilization, generation, and future requirements as well. One interesting Q&A session question was from the investment perspective. The company is trading at 150 PE. So that was interesting.
Oh, thank you so much, sir. All right, I've got your perspectives. Yes, Amit, there is... everything's ready to roar. I know you're so mesmerized looking at me. So, thank you. All right, ladies and gentlemen, back to where the action is on stage as well. So here we go. Ready to roar. Ladies and gentlemen, every investment cycle produces a defining question. Today, one of the most debated questions amongst investors is India's position in global portfolios. After a prolonged period of strong economic performance and increasing investor interest, has India become over-owned? Or is the country still under-allocated relative to its long-term potential? To discuss this, we have assembled a distinguished panel representing public markets, private equity, and growth capital. Our first panelist represents one of the world's leading growth investors. As Managing Director and Head of India at General Atlantic, he's been instrumental in identifying and partnering with some of India's most promising businesses across financial services, healthcare, and consumer sectors. Before joining General Atlantic, he built an exceptional track record as a principal at Apex Partners and as a management consultant at McKinsey & Company. Please welcome Mr. Shantanu Rastogi on stage, please. Come on, everybody. Representing the private equity perspective is a leader who spent over 2 decades investing in and helping build businesses across India. As managing partner of Chris Capital, one of India's leading private equity firms, he oversees investment activities across sectors and economic cycles. He is also a founder and trustee at Ashoka University and Plaksha University and chairs the private equity committee of FICCI FICCI. Please welcome Mr. Sanjay Kukreja on stage, please. Good afternoon, sir. So happy to have you. You can make it louder for our friends, please. Our next panelist is one of the most respected names in Indian asset management. Over a distinguished career spanning more than 3 decades, he has managed some of India's most successful equity portfolios while earning a reputation for long-term thinking, disciplined investing, and conviction-led decision-making. Today, as founder and chief investment officer of 3P Investment Manager, he continues to focus on identifying businesses capable of creating sustainable, long-term value. Please welcome Mr. Prashant Jain. So can I have you on stage, please? Our final panelist is a leader with nearly 2 decades of fund management experience. He oversees fixed income strategies as well as investments in commodities, REITs, and InvITs. He has been recognized multiple times with industry awards for fund management excellence. As Chief Investment Officer, Fixed Income at ICICI Prudential AMC, he leads the firm's debt fund management function. Please welcome Mr. Manish Banthia. Hello, sir. Make it louder for them. Come on, everybody. What a formidable force, ladies and gentlemen. Can't get bigger than this. Dosto, I request all you to please take your seats immediately. May I now invite Prem Dikuna, ladies and gentlemen, to join us on stage and present a bouquet to our distinguished guests. Prem sir, can we have you on stage, please? Here's a bouquet from all of us for you. Ladies and gentlemen, India rising and how? जैसे कहते the diggajas who've set benchmarks beyond the realms of the ordinary on stage. People who believe that nothing is impossible. The game changers, the trendsetters. Thank you, our panelists, for giving us your precious time. Thank you. I request you take your seat as well. Moderating this session is a professional who works at the intersection of capital, strategy, and corporate decision-making. As Executive Director and Head of Investment Banking and Institutional Equities at ICICI Securities, his perspective is rooted in over 30 years of navigating Indian cycles, from leading global markets at ICICI Bank to serving on the RBI and SEBI committees. Ladies and gentlemen, already on stage, we welcome Mr. Prasanna Balchandar. Prasanna sir, I leave you with our dignitaries. Looking forward to this session. If there are 5 people, it should be 5 times the applause.
So, good afternoon, ladies and gentlemen, and a very, very warm welcome to this, I would call it a very interesting session. And the reason I'm calling it interesting is multifold. First is that you have 2 critical segments of the Indian capital market system, or you might want to call the entire capital formation process. You have the private equity masters on one side, and you have the public market champions on the other side. That's one aspect. It's on the same stage. Not too many such instances in the past. The second interesting thing, of course, is the fact that typically, like in a relay race, one runs and passes the baton on to the second runner, and they complete the race. So we call the private equity masters as the first runner, who then passes the baton on to the public markets champion to complete the race. And it's very critical that I think both the participants are hale and healthy for the race to be completed to the satisfaction of everybody. So I think from that perspective, I think 2 very critical components of India's capital market, and we need both of them to work together, and we need investment bankers like us also to interact with them frequently as possible. So I think the beautiful thing also is the fact that the Indian growth runway is really so vast that there are so many opportunities as we go by the buy side, and this growth story has the ability to accommodate all of these players, with the economy so vast, the opportunities being so vast, and
the industries in which India is present significantly being so diversified. So I think it's a great combination, and we want the private equity masters, to identify companies with new ideas, great ideas, bankable ideas, support them at an early stage, help them take the company to a kind of a scale, and then, kind of hand it over to the public markets for the journey to continue beyond that. So I think it's a perfect, match, or rather complementary styles in terms of the way capital formation runs. And so we are really happy at ISEC that we were able to, get a very good combination of this in the panel today. So having said that, I'll just start off with a kind of a top-down approach, because we will need to first, before we get into the nitty-gritties of whether it's private equity, whether exits are happening, whether it's happening at the right time, and so on and so forth, out of which I'm sure, a lot of discussions and arguments and debates can happen. We will kind of take it from the top. And interestingly, we have, Manish, who handles fixed income, macro, and commodities, asset allocation, and all that. So I thought we'll start off with, Manish, and then, flow through once we have that kind of a background on the macros. So we'll have, if time permits, roughly around 5 rounds. Not necessary that every round we will want to have contribution from everybody, but we'll try and, figure out as we go through. So on the macro side, Manish, so my question, of course, we've had a lot of discussions in the morning as well. But long story short, we were in a sweet spot. Yes, we had a AI and a job creation problem in the month, till the month of February, which we have forgotten now because other problems have come up. But ever since that, now we have seen, at that time, inflation was fine, current account deficit was fine, rates were low. So there was not really any problem. Earnings growth, which is actually the most important, was the only problem we had at that time. But at least there was some kind of a roadmap, and people thought that FY27, we are surely going to get some kind of earnings growth. But now, as we speak, all kinds of geopolitical cross-currents have happened, talking about trade, destroying supply chains. So the current account deficit has now gone to 2% of GDP. Inflation is going to go towards 5.5%. There is a balance of payment hole, but at least till the time the Friday measures came, we really had a problem for this year. So do you think that this is a passing phase as far as weakening macros are concerned? Or do you think that, it will take substantial amount of time for India to get back into a sweet spot?
Let's, kind of look at it a little differently. I would look at it from more of a cycle perspective. Where are we in the cycle? And some of these structural stories, at different points in the cycle sound very differently. Back in 2024, clearly the story was, there was no alternative but to invest in India. And, at that point of time, the macros were not very different. In the sense that, the earning cycle was good, money was coming in, valuations, were becoming expensive. From there to where we are right now, I think last year there was a slowdown, but it was rightly, tackled by the policymakers. And then we had a very good recovery. The good thing is that overall balance sheets in India are in a great shape today. And that, I think, is very important to understand, how long the cycle can continue. So when we look at, the corporate balance sheets, they like one of the best shapes today. Households broadly, are very decently placed in terms of balance sheet. The third is the government. We've seen fiscal consolidation over the last 3 years. So some of these shocks, when you have good balance sheets, they can be absorbed by the system. And which is where, if you look at this oil price shock, while, from sentiment perspective, it seems that everything is fallen apart. But if you look at the impact on a common man, largely it has got contained. Pump prices have just gone by 8 rupees, 9 rupees. And that's nothing material in terms of, the impact. So I think the economy is rightly shaped. What you need to look at is you have to make a judgment whether the war continues for a long period of time or it's going to stop, at some point of time, maybe in 3 months or 6 months. Now, if you think that it stops in the next 3 months, 6 months, and we've protected largely, the balance sheets, then everything will come back again.
Okay.
And that is my perspective that, if in the next 3 months, 6 months, if we generally protect the balance sheets of the households and the corporates, I think growth is going to come back again. While the momentum is still strong, but the sentiments will improve and growth is going to come back again.
So thank you, Manish. I'll just give a very quick follow-up to that. Maybe you can respond. In fact, my personal opinion, I was always thinking that the sooner the government passes on the higher cost of oil onto consumers and shift the burden from the government to the consumers, because then you will also have some kind of elasticity of demand, hopefully, and India consuming less oil, which today is not happening. You and I are not really bothered, and we are just, consuming oil as if price was at much lower levels. So isn't it that we should be actually hiking more than what we have done so far? Just a short answer to that.
So I would have accepted if, the oil price was flexible on both sides. Right. On the way down, when oil went to $60, the prices were kept at rupees 100.
Okay, sure.
So that has created a buffer for us to, keep a, shock absorber on the other side as well.
Okay. So, we'll take that and let me now proceed on the same round on the macro to Prashant. Prashant, we know that you are a very typical micro bottoms-up person. Of course, you take a view on the macro, but beyond that, you look for companies, you look for moats, you look for sustainable business models and all that. But just on the earnings growth, we thought FY26 we had a very high real GDP growth, but the nominal growth was almost just as bad or as good as the real growth because inflation was so low. This obviously reflected in FY26 earnings growth of corporates, and the index didn't have a great run. FY27, we thought that, with GDP growth at 7.5%, and inflation is going to be at 4-5%, you are going to see nominal growth at 12-13%, and maybe earnings growth even higher than that. So does this, do you subscribe to this view that next year is going to be one of notwithstanding the crisis, the war, how long it stays and all that, broadly we will go from a very low earnings growth year to a high earnings growth year?
I think I would agree with that this year the earnings growth, in my opinion, should be better than last year. See, last year, banks are the largest component of Nifty. And as lending rates got passed on faster because bulk of the loan books are floating, banks' earnings growth was minuscule last year.
I can't hear you.
I was saying that banks' earnings growth last year was minuscule because most of the asset side is on floating rate loans. I think this year banks should do a lot better. Higher bond yields, lesser borrowings in ECBs, increased working capital cycles due to supply chain issues, commodity issues, I think bode well for faster growth. And by and large, currency depreciation is also positive for earnings. So I would say there are very few sectors, at least in Nifty, which are vulnerable to the adversely impacted by the current macro. So I would be quite hopeful of a very healthy earnings growth. Of course, this excludes some sectors which might get impacted by supply chain issues, but I don't think in Nifty such companies have a meaningful weight.
So would you go for a 15% kind of a growth in Nifty this year?
I think anywhere between 12 to 15, 12 to 16% I think is doable. See, there is a fair bit of component of metals also. So actually the earnings growth could be higher because metal prices are quite robust. And while the weight is small, but the delta on earnings can be quite significant given the nature of that sector.
And if Nifty itself is going to be at 12 to 15, would you then expect the mid-cap earnings and the broader BSE 500 kind of earnings to be much higher?
See, there is no real evidence that small mid-caps have, as a category, outperformed large caps in terms of profit growth. But of course, the number of companies, the diversity of companies in small mid-cap space is so large that dispersion in profit growth is much higher. And therefore, some of the fastest growing companies in India should be from the small mid-cap space.
Okay, got it. Thank you, Prashant. So I think now we'll get on to the second round. I think Shantanu and Sanjay have patiently waited for the public market champions to give their views. Maybe we will get to hear something very different from them. But instead of continuing on the same topic, of course, if you have to add something which is different, please feel free to add. But I thought I'll start with Shantanu. I think if you look at the emerging market space this year, I think Prashant also alluded to, Manish also spoke about it. Between, say, 1.5 years ago and now, whatever India does, if the world does better, we are still relatively poor off. And that seems to have been playing in the minds of at least the foreign investors who have a choice to move money across markets. And so there seem to be every other emerging market which has done so well. So if you really look at our index and our equity market performance, we might not have done too bad. But when you start comparing it with what has happened in other countries, it seems like a bear market, though it is actually not maybe fallen much. So how do you answer this riddle, like whether it is Vietnam, Indonesia, Mexico, or even from valuations perspective, if you look at China, that's at 10, 11 times. You look at Korea, it is close to 10 times even after such a big rally. But India, even without performance and with 2 years of earnings growth in the bag, we are still at 20 times. So how do you put this puzzle in place?
Sure. I think first of all, we, just by the nature of mandate and capital we have, are long-term investors. And our purpose to invest is to address, specific, to bring a good rhythm to execution, to improve governance, to allocate capital properly, to improve quality of technology, quality of management. That is really the purpose of, growth private equity, which is the nature of investment we make. So short-term changes to valuation are not, I would say, the most important factor on the basis of which we invest. But to address, at least my perspective, given I'm not a public market investor, my perspective on what might be happening is that I think from, and maybe Manish and Prashant would have a better view on this, but if I have to look back 20 years and look at the nature of capital flows globally, there was still a lot of active public money, which is still a dominant kind of capital in India. Our active mutual funds are still a very large, have a lot of participation in the public markets. But globally, a lot of capital has either become passive or algo and hedge fund driven, or it has moved, a lot of long-term capital actually has moved to the private markets. Number of companies, listed companies, I think has halved in the last 2 decades, from 6,000 to 3,000 in the US.
Okay.
And it appears to me that passive investors who just have to make sure that they are rightly allocated have to follow the trend. And the trend has to be followed within a quarter, maybe within 2 quarters. And algo trading or hedge funds have to do the same. So I wonder if there is a lot of capital left in the public markets, or the marginal capital, not a lot, but a marginal capital in the public markets in the US, how much of it is actually for a structural growth story, which is willing to suffer for 4 or 5 years and then reap the rewards. And that maybe, is what is reflected in short-term movements into 3, 4 companies in Korea and, Taiwan. And so I don't think it should, is that the nature of capital that India needs? Probably not. I think we need good quality, long-term investing. We need it from global corporations, which bring capital and technology and talent. We need it from private equity funds who come with a long-term view. So I don't think this is something that should be a big bother for the country. As far as, so all these other markets you spoke about, when we look at them, even for our business, there's hardly any depth in them. Because there are a few companies, if you take the example of Vietnam, there are less than 10 companies that you can actually trade even in the public markets. And when we go to look for private opportunities outside of real estate, maybe some manufacturing, you cannot find businesses with structural advantages, intellectual property. Very few. There are.
Sure.
So I think the scale that India has, the quality of talent, which I think we have a distinctive advantage on, and hence the quality of businesses getting built, which one can acquire scale because of the nature of our country, which is already quite large. So serving the domestic market helps you bring, build a lot of business muscle. And now, IT and pharmaceuticals were the sectors which went global, but I see many more companies now taking this scale and intellectual property and becoming global. So I think it's still a very attractive market. And part of the earnings premium or multiple premium that you speak about is actually reflected in the structural growth story and a deep domestic capital pool, which is not existent in in some of the other markets.
Okay. So I think a couple of interesting takeaways, Shantanu. I think the fact that momentum trading from all these hedge funds, and I think that exaggerates the price movement in any one direction. And I think the way you're putting it out, it seems that whenever a correction does happen, it's going to be quite steep. And the other thing, the point you made about the patient capital, if public markets are going to be in passive investing, then patient capital will have to come into private equity, and then that should fund the next stage of India's growth. I think two very interesting points. One of it, I will probably build on it a little later as to whether the private equity capital that we are getting from abroad, does it have its own pitfalls maybe at the next round. But let me just stick to this round's philosophy. Let me come to Sanjay. So kind of carrying on with what Shantanu said, I know that you're a terrific homegrown private equity fund making waves in the international markets, Indian markets. But I'm sure you would also be doing a very active analysis in terms of where asset allocation looking attractive, where people can move money. What are your 2 cents on this entire topic of
India versus other markets?
Yeah,
within
India versus other
India
markets.
versus other markets. First of all, thanks for having me here and for hosting and asking these questions. So while we are focused largely on India, and that's where we spend and invest our capital, I did end up spending a fair amount of my time last month in the US, and I came out kind of blown away with 2 or 3 things. I think it felt to me that it was very much one giant, AI trade that was going around everywhere in the world. Met lots of capital allocators, banks, private equity funds, and I think the entire question was, either are you investing in, some part of the models, or keep going back in the layers of the cakes and saying, okay, are you in, in the infrastructure of it or wherever else? And struck by somewhat, what I would articulate is the irrelevance of India in that whole conversation. And I'm not saying that just to, to make a point. I think it hurt me, right? When you're having that conversation with global capital allocators, and the whole point you're talking about is where does India fit in the stack? And it wasn't really there today. That doesn't mean it won't be there. I think some of the things that you're talking about in terms of talent and, Indian entrepreneurs are actually top notch. So I think those opportunities exist for us all the way from infrastructure, to I think up the chain as well. But the reality is some of these hot money, if you will, right? And the question that you asked, is it even relevant that they should come to India or not? Or at least their focus at this point seems to be everything related to the supply chain of AI and all of that. And India doesn't have a play. And it's not an anti-India trade. It's just, where can I get something that's in short supply or a squeeze and I can make money more in the next 1 to 2 years or even lesser? And every time I push back on the question saying, do you do cyclically adjusted earnings? And, what about when supply really comes through? And the view was generally that will be gone by then, right? So the world is becoming increasingly short-term oriented. And I think those are cycles that are natural in financial markets. You have to kind of live with it.
Yeah.
The question for us as a country and for private equity is how do you build long-term sustainable businesses, right? And take up or take advantage of these opportunities.
Okay.
So, you know, we hear a lot of the negative news on the macro, but every time I get a little depressed, you know, I go back and meet the founder of Lenskart, for instance, or the founder of Healthcart, or, you know, or some of our other portfolio companies, and you see 30% growth coming in this year, and you feel SSSG is good, and you see the opportunity, and, you know, you feel better about yourself and your country. So there's a short way of answering. If I look at our portfolio today of 25 odd companies, we're just doing an exercise. We think our portfolio on aggregate, it includes some of the slow growth of IT and everything, but on an aggregate basis, we think we're still growing to go somewhere in the nature of between 22 to 25% in earnings growth this year, right? So you feel very good about, you know, that. Now, it could get maybe, you know, obviously inflation is yet to come and some of these things are still about to play out. Maybe it slows to 20, right? Or maybe 18 even. But it's still a good number. It's a very good number. And I think you get that in India. When you look at other markets, I think you also have to, when you say 10 or 12, you have to also, I think, strip out state-owned enterprises. One of the exercises I've done several times for our global LPs is to say, look, like for like, show me high ROE businesses, consumer, pharma, IT, right? And strip state-owned enterprises and then compare different markets. Korea now is obviously higher on that element as well, but it's driven by short-term supply squeeze. So can you do a cyclical adjusted, you know, number on that and then see what the premium in India is? So when you see a combination of long-term decadal growth and high ROE, there's a reason why, you know, I think India should still continue to have that premium, and we feel good about building businesses here.
Right. That's very interesting, Sanjay. I think with a little bit of now the discussion on macros and global, let's now shift focus to our own markets a little bit more. So the thing that I have at least observed this broadly for this background of this round, we've noticed that with the tremendous amount of retail flows which are, you know, coming into India, and the valuations, you could say, deserves a higher rating multiple because of this huge amount of money that gushes in. But because of that, when other opportunities in the rest of the world happens, this market becomes a market which is primarily for the domestic investors, and the international investors are not able to, you know, find it attractive enough to come in. So Sanjay, I'll actually start with you again on this. The question is, I think we definitely need a homegrown private equity kind of capital. I mean, the reason I bring it up is most of the selling which is happening today, while of course a lot of it could have been originally private public market investments, but a lot of the selling is also what originally came in as FDI, classified as private equity at that time, now possibly, you know, getting out at 4 times, 5 times the original value. And while of course from an equity market perspective, you have the domestics flows to, you know, kind of bolster the market, India is suffering because of the currency weakening. So is there a case for a homegrown private equity firm like yourself to attract more of private equity type of money from within the shores of India? Because I don't think, you know, Indians are as much investing in private equity as you guys are able to garner money from outside. And the more you keep garnering from outside, even if you're a homegrown PE, if the money is going to come from outside, you have to give it back to them when you exit. So can you, you know, address that, or do you have a thought? And you can be a little louder, Sanjay. We are finding it difficult to catch you.
Sure. So no, thanks for bringing that out. I think clearly there's a case for domestic capital to drive private equity. I think we've seen that play out in China in a major way, where global capital was transformed to domestic capital, driving private equity firms there as well. And I think we'll probably see that play out in India. In our own funds, Fund 10 was the first fund where we've actually taken domestic capital, and that was roughly about 15% of the fund. And I think its time has come because Indian family offices have become more sophisticated. I think insurance pools have become pretty large in India, and we're not going into private equity earlier, now have started doing that. So we have a few institutions. Globally, we have about 7, 8, maybe 10, 12 insurance companies, but even in India now, insurance companies have started to invest in private equity. And that helps achieve what you're saying, that now the profits also get retained within India.
Yeah.
But, you know, step back. I think the issue, you know, this whole narrative of, you know, if investors do well and the foreign money goes out, then what will happen to the currency is not, in my view, the correct narrative on that at all. You want foreign capital to come in and make, you know, good returns. Otherwise, what's the point of it, right? India needs the growth of it, right? I think the issue here is you need, other than IT and to some extent pharma, you need other sectors to become global leaders. And for that, you need manufacturing to come up and set up and scale. We've been investing in India for the last 26 years. We're seeing a pickup in manufacturing now, you know, in a way different than what we saw in the past. And we've made 2 recent investments as well in manufacturing. You know, one more import substitution play, another design-led export play. So we're actually beginning to see that. And I think that as those companies scale and you really take manufacturing, you know, to a different level, through the, you know, electronics components and other parts of the value chain, that's when you're going to solve this problem. And I think we have to attack the fundamental nature of how can we make our, whether it's subsidies, whether it's capital.
So the currency is a symptom and not the problem. That's what you're saying. You need to,
you can't say, why are investors making money? Let's keep the money in and therefore somehow we'll do. No, you won't attract more capital coming in.
Sure, thank you. Shantanu, just quickly, before I go to the other friends, I think when you look at control transactions in the private equity world, we see a lot of such transactions happening in the Western markets and has started happening substantially in India as well. I'm sure you are also holding a lot of controlling stakes in a lot of companies. So how do you see this entire aspect developing? Like, do you expect more and more of your deals in the future that you will be spending more time and more capital in deals where you hold a majority stake and you kind of steer the trajectory of the company, the strategy of the company through your board representations versus picking up minority stakes in multiple companies?
For us, we actually do not see that to be the mix of minority versus control investments to change materially. I think in the West, control transactions happened largely in the form of leveraged buyouts or take privates, wherein leverage was a big source of generating returns from such transactions. And the primary lever of creating value was cutting costs, managing working capital, selling divisions, or corporate restructurings, right? I think India is not a take-private market, first of all. And two, for us as General Atlantic, leverage is not a source of returns. I think we are investors in growth, and we are huge believers in backing entrepreneurs, backing founders to execute on that growth. So for us, whether we own 70% or 7%, we are still backing a great founder, a great entrepreneur, or a great CEO to execute. And hence, our partnership with that team or with that, typically with a team, is not dependent on the stake we own. Yes, owning a higher stake sometimes helps you have somewhat higher influence, but I'm a big believer that the best argument should win and not who has how much stake. Okay. So it shouldn't change that much for us.
Okay, brilliant. Prashant, let me come to you now. Of course, currency has been a very significant part of discussions and discourse over the last, I would say, 4, 5, 6 months. So in your vantage point, in terms of sectors or themes, what are the ones which are likely to benefit out of the currency behavior? Are you actively picking up those kind of thematics in your fund, or are you looking at some kind of import substitution? How exactly are you going about building your portfolio?
No, Prasanna, I don't think I am really looking for businesses that will benefit from currency, because in India, most of the exporters are B2B exporters.
Most of the exporters are?
Business to business. We don't have any B2C exports.
Okay.
So all currency gains tend to get priced out very quickly. And the IT industry is a great example of that. Currency has gone from maybe 30 to 90 and margins have been sliding lower. I think it's only the metals and maybe global cyclicals like refining which could hold on to those gains. But that's a very small part of the market. So yes, equities are a hedge against inflation. Equities are a hedge against currency depreciation because it will ultimately show up in higher consumer prices. But I don't think I would like to do anything to the portfolio just to benefit from currency depreciation.
So forgetting the currency point, Prashant, then I think I have to ask you this question. Just your top pick in terms of which sector you think is going to do the best in the next, say, 5 to 10 years, and maybe a sector which you think has attracted much more capital than what it possibly deserved in terms of the business potential that that entire sector carried. Any two such picks that you can, any two such sectors that you can think of?
I think, Prasanna, we need to differentiate between high growth sectors and where returns could be better or worse. So high growth need not always translate to high returns because sometimes that growth is overestimated and over discounted. And at times we have seen slower growing businesses turn out to be the best. If you look at last 5 years, some of the banks, some of the large banks, large utilities, defense companies, which have not been probably very fast growing, but they have been the best investments over last 5 years. So I think next 5 years, if you think clearly, I think capex should outgrow consumption, discretionary consumption should outgrow staples. I think so. These are sectors which might grow faster, but in terms of investments, I think large banks are offering a very compelling opportunity because structurally their competitive advantages are deepening and they should continue to grow faster than the system. And the amount of derating has been very, very significant, from almost 4.5 times price to book, 4 times to all the way down to 1.5 times. While yes, those earlier ROEs are unlikely to come back, but I think the sustainability of this business is extremely high. So that would be one place. And this has also been the space where the maximum FPI selling has taken place.
Right.
So I think this is why this sector is derated. So I think that should do quite well. I'm seeing one more interesting trend. There are at least 3 companies in India in the pharmaceutical space which are doing genuinely world-class NCE research. And we have had 2 announcements already, one from Glenmark and just few days back, Wockhardt announced FDA approval for Zenic. So I think we are seeing innovation come up in pharmaceuticals and that could be a very rewarding space. Of course, it's a bit risky. I think one area which I personally feel is very expensive for comfort is this, contract manufacturing type of.
What's that?
This contract manufacturing, EMS or, this, the likes of assemblers of electronic products. I think it's a business that offers you longer term growth, huge runway for growth. But I just feel the potential ROEs and the multiples where we are trading, at least for many of the companies, it looks to be out of sync with my assessment of that space.
Okay, sure. Thank you, Prashant. That is, again, a very interesting response. Manish, to just round up this round, but going on a different tangent, trying to address the elephant in the room and that too a large room. Are the taxation structures for domestic investors misaligned? I know that you're specifically looking at fixed income. You're the CIO of fixed income for ICICI Prudential. But my question is a little bit more from the financial stability perspective rather than, attracting money kind of a thing. Are we encouraging too much money to go into a particular asset class?
Thanks, Prasanna, for asking this question.
I've been a fixed income person in the past.
I was willing somebody asked me this question. Look, while I agree with Sanjay that part of the problem is how we, really grow in terms of earnings, ROEs, how do we create microstructures which continuously keep the growth going. But if I wear an asset allocation hat and look at how asset allocation has changed, particularly in the last 3 years since debt taxation has changed, what it has done is it has pushed money from pockets, left pocket to right pocket. Left pocket is debt and right pocket is equity. Right, and effectively, if you allocate more money, and compulsorily people have to who are subject to tax, that increases compulsory allocation to one asset class. What effectively it means is that it makes markets, discount more than normally what the near-term earnings is, and sometimes makes the market expensive, and also create capital allocation issues. I think one of the reasons why India has become so expensive is because more money is chasing equity than debt at this point of time. And in a way, what it leads to is, foreigners who have the option to invest in India or option to invest anywhere else, they would choose cheaper destinations, and which is the reason why capital outflow has happened in India. Now, if we equate that with a counter thing which RBI has done over the last 2 years is they have kind of used reserves to make sure that depreciation is orderly. So you have capital outflow going out, RBI reserves coming down, and now you have measures which have got announced. They are good measures, but in a way, from a more macro perspective, look at it, you're disallowing incentives to domestic investors, but then getting costly foreign money coming in. So that's how, the entire matrix has got...
So how do you solve for this?
So I think clearly, you can't have excess in any particular asset class. You need to have money moving to both debt and equity. And over a long period of time, I've seen in different countries as well, allocation of money. And if you look at from that perspective, debt money is required either through the banking system or through the capital markets. This money goes to the bottom of the pyramid, which is the SME and MSME. So only 1% of corporate India is listed. In terms of volume, numbers of companies, 99% is unlisted. And that money feeds on the banking capital, it feeds on the capital market and related entities. So I think a good mix of equity and debt has to be maintained. And if that is done, I think some of these extraordinary moves that we see, they'll get more stabilized. And we'll have a more healthy market, both equity and fixed income.
Okay. Shantanu, any response to that?
I can't agree more. I don't think he said the point he wanted to say, but
he stopped short of it.
He wants the tax rate to change
Do debt taxation come down or equity taxation goes up is the point.
Exactly.
But anyway.
I think he wants some harmonization, which appears right now, it definitely seems,
So we have a problem, but the solution to the problem might lead to a bigger problem. So that is the whole issue. That's where we are, I guess, right now at this point. But anyway. So I think let's shift focus. We have maybe around 20 minutes time to exit environment and the liquidity. So I'll possibly pose one question to the private equity person and one to the public. In terms of a company going from scratch to exit, to the public, is the time frame very short at this point of time? Do you think that Indian markets should actually let some of these companies continue to be in the unlisted space for a little longer, for them to achieve scale, for them to achieve consistency, before they kind of come on to the public markets? Because at the end of the day, public markets is not just institutions, it's also retail people. So is there a thought around what is the ideal time? Either one of you can take the...
Yeah, I think so. What I'll say is that, earlier, when I used to look at companies and say, listen, how many companies have scaled from, say, 0 to 100 million in India, and how long does it take to do that? Right? You looked at 5 years or 10 years as a frame of reference. There was very few companies that you could count them on your fingertips that started and scaled to 100 million, very quickly. I think that's beginning to change and has changed, I would say, in the last, 5-10 years. Now when I look at it, there's a lot more companies that I can find which are scaled to 100 million at least in revenue, which were 5 years ago or 7 years ago. So India's starting to get scale. Nowhere near, if you raise private equity money with a 10-year cycle, and if you think about today, the number of listed companies and what can trade and what is effectively, I think anything less than 5,000-6,000 crores of, market cap is a difficult, proposition. At least we guide our companies to say, listen, you have to be at least much higher than that and see if you can get to 10,000 crore, market cap zone very quickly. And so if you think about 5,000 crore and some multiple and what you need to do, and you start to say, oh, from scratch, it's very hard. So when we think about the companies that we enter into, they're not from scratch, right? We're private equity. There's this whole ecosystem, right? You start from VC, accelerator, all that stuff. But we're backing companies that typically already have about, say, 50 to 100 crores of profitability. And then you have to scale them to at least 200, 300 crores. Then you put some multiple on, I'm doing EBITDA math. Right. And then you find that they can, get to this range where they can go public. So that's how I would characterize the type of size and scale that you need for a company to reach to before you can actually take them public. Of course, there is multiple dimensions. Scale is just one, but governance, institutional ownership, how do you handle, talent sort of development and all those things, which has its own maturity curve in every company. But you need to get to that level. I think one interesting analysis we did was, we've taken some, there's a fair amount of companies public in India. And we were looking at the analysis of after they went public, what has been the track record and the returns thereafter. And we were pleasantly surprised to see that it was still 18-20%, compounded in INR terms. From the last 10 years,
so you've taken the data
once
for
we've exited
all the companies that listed.
That through our cap table that have come out. And it's a full set. So there will be some that didn't do well, some that did exceedingly well. So that just, talks about that there is a further, it's not the baton that you talked about, right? You build a company and all of that. Of course, in our, period, we may have made more than the 25, 30, zip code. But as they become larger, it's harder to, continue to doing that. But it's done well. It's not as if, there have been peak of the market and, after that there's been, no return to be had, etc. These companies continue to scale. And so there is for even for public market managers, and maybe they'll let them comment, but, there is a scope for better companies coming out which are still younger and, and have maybe faster growth. I, of course, agree that growth doesn't always translate into returns, but if they have a good combination of high ROEs and governance and all that, typically they could produce some interesting ideas, so that's how I feel about this.
Okay, then let me throw now the question to the other side. So Prashant, if I have to ask you, any areas of concern or anything that you feel, say a differentiation between when you invest in a company when it comes for an IPO or a pre-IPO, when it is PE funded versus a company which is not PE funded. Any concerns from your side?
I think PE generally has done a great service to the nation, and they've brought to the market great companies which otherwise would not have scaled up. So I think the country certainly benefits and wins. When participating in a company which is owned by PEs, one is certainly a little more alert, I would say. And one concern which and that's because they understand that company a lot better, because they have played a far more active role than what a public market investor would do in terms of time spent, understanding, etc. So therefore, you are dealing with a set of sellers who are far more informed, both about the business and equally well informed about the capital markets. So that's why one needs to be a lot more alert. I think one place where I am not so optimistic is the promoter stake in many of the public companies is so low that it's very hard to look for, who will handle these companies? What will be the governance structure in these companies once private equity sells out completely? We have a large number of companies where individuals have 2-3% stakes. That's nothing. And I'm sure, the Ps will sell out, and then these investors, these individuals may or may not be motivated or incentivized. And I don't think public markets, public managers in India yet are there at a stage where they can play a more activist kind of a role. So I am slightly cautious on such companies. But otherwise, I think they've brought to the market very many outstanding business models.
Okay. Thank you, Prashant. So I think we are running out of time, so I think I'll bring down my last round to just one question, and then we'll kind of open it up to Q&A. Maybe it's an open-ended question, anybody can contribute, but I think Manish is possibly best positioned to answer it because of your asset allocation responsibilities. So we have gone through a tumultuous period. Sometimes you feel that there is no place to hide. Cash is possibly the only place where you don't lose money. Otherwise, we have seen, for example, on Friday, just yesterday, we saw everything falling, including gold, including equities. The only thing which went up was VIX. So this kind of a situation, going forward, do you have some kind of, can you guide us as to what could be returns from various asset classes? And what are you, in your fund, what kind of principles are you following at this point of time?
So I think, 2 years back, there was a place for precious metals to be a part of the portfolio. I mean, particularly from the fact that we were just starting about that geopolitical and global turmoil. Central banks started adding precious metals, and the valuation was also good. They had not performed for 10 years. So we like precious metals as a category. But over the last 2 years, I think precious metals have delivered fantastic returns. And from a broad perspective, I think they are more than fairly valued now. So I would be more cautious to have precious metals in my portfolio at this juncture. Also, from a global perspective, 2 years back, India, as I said, was very expensive. Right now, on a dollar-adjusted basis, why I say dollar-adjusted? Because the FPIs who are selling look at the dollar returns. They don't look at the INR returns. On a dollar-adjusted basis, I think India has become cheap compared to other emerging markets. Whereas, from a domestic parlance, we continue to be fair or a little expensive. But for foreign investors, it's become cheap. Both debt and equity have become cheap from that perspective. So I think these trends are more cyclical. They will change at a particular point of time. In my portfolio at this juncture, I'll have a mix of debt and equity. Both are attractively valued. It would be largely 50-50. It's a boring allocation, but I think it's the right allocation at this juncture.
So you would say zero in precious metals?
Zero in precious metals today. That is...
and the fact that, let's say, US Treasury itself is yielding around 4.5%, means the opportunity cost for holding gold in your portfolio from a dollar return perspective that much higher.
Right. So, I mean, people talk about de-dollarization. I, kind of like that perspective that the narrative has de-dollarization into it. You have been in fixed income for such a long period of time. I mean, back from 2000, if I had held long bonds, US long bonds in my portfolio, and say gold was the base currency, I would have lost 93% of my value. Yeah. So effectively, it's there in the price. De-dollarization is there in the price, and gold has kind of discounted all of what volatility exists at this point of time.
So do you think the central bank diversification away from dollar into gold stops right now or slows down?
So if you look at central bank balance sheets, 40-50% is gold now. Not because they've accumulated so much. Yes, they have accumulated. But the price change itself has converted gold to 40-50%. So they're very well diversified now. So I would say if gold price is high, central banks should sell gold, not buy gold at this juncture.
Shantanu, Sanjay, any closing comments from you before we open up to the Q&A? Anything? Blue sky. Both of you can say.
I think equities over fixed income over metals, precious metals. That would be my...
Equities over?
Equities should do a lot better in the next 2-3 years. And I think fixed income is fairly predictable. I think you don't... I think precious metals, I would completely agree with what was said earlier. And whatever indicator you look at, precious metals appear to be unreasonably precious.
Okay.
It's very hard to defend those prices.
Okay. Thank you so much, gentlemen. I think now it's a time for us to open it to the participants. So please show up your hands and the mic will, come to your table. And please also let know to whom you are addressing the question, and we'll be able to,
Hi, this is for Manish. Manish was suggesting in a way that income tax on the debt should be a little lower as compared to the equity. Is there any trend anywhere in any part of the world where the tax rates are lower on debt as compared to equity?
So if you look at global, they don't really differentiate between debt and equity. In fact, in a large part of European markets, debt investments are much larger than equity. Even in US, in sum total, debt investments are much, much higher from a retail perspective. I'm saying institutional business any which ways need to park their money. Debt is a much larger asset class. In India, debt is a very small asset class from a retail and household, investment purpose. Of course, they invest through bank deposits, they invest through, other means. But I still think that, from a capital market perspective, debt is very small at this point of time. And there's a huge scope for debt to grow.
No, my question was, is there an example available in other parts of the world where the income tax rate is lower on the debt as compared to the equity?
Most of the places it's similar. So they don't differentiate debt and equity. I mean, that is how it should be. I mean, if you are thinking about capital gains tax, right, effectively over a period of time, you invest in any asset class, it will generate capital returns. And therefore, tax should be looked at from that perspective, whether it is one asset class or the other. Both generate a similar kind of capital for you, I mean, proportionately. So taxation, therefore, and globally, that's what it is about. Most, if you look at taxation in most parts of the world, they are similar, they're not different.
Okay, thanks.
So any other question? So I can see a hand in the last row.
This is a general question, not necessary to capital asset allocation. What we heard right through the various deliberations, that employment level is increasing. Now, on one hand, we have missed the bus as far as AI is concerned. On the other hand, what I hear is that we are not adequately trained, or manpower is not adequately trained to handle AI. That's the other shortage. We missed the bus for in the AI sphere. And on the other hand, now when we want to enter, we don't have enough talent in the AI sphere. It's a general question. Anyone can answer or throw light on this question.
For one, we are investors in AI companies globally and in AI companies in India, AI native companies. And the other thing I would say is, pretty much all our portfolio companies are at par in terms of developing AI based products or using AI for productivity improvements, at par with all our global portfolio companies. So the narrative that India has missed the AI bus seems overblown. And even if the Pentium and the microprocessor was not developed in India, one could argue that since the mid-1980s, one of the biggest beneficiary of the microprocessor development, has actually been India, because the microprocessor, along with the internet, could move a lot of work, to a good educated population out of India and develop a sector like IT services, which became such a large part of our exports. So it's too early to start calling winners and losers in AI. Will the value get captured in LLMs or chips or users of AI? I think it's too early. AI is overblown in the short term and probably underestimated in the long term. And I think the last thing I would say is, with the young population that we have, picking up AI or using AI to develop new products, internal tools, I would think we have a unfair advantage in having, in my view, the most skilled workforce that is likely to benefit from AI. So I hold a contrary view to the narrative that exists today.
Okay. Sanjay, want to say something? Okay. So I think with that, gentlemen and ladies, we come to a end of this session. I think you should give a big round of applause for our set of
Yes, ladies and gentlemen, thank you so much. But I request all of you to remain on stage because we have some wonderful mementos to give you. So as a token of our appreciation for taking the time to share your thoughts and perspectives with us, I request Prasanna sir to present mementos to our guests. And I must tell you, the way you give mementos from the heart, sir, is totally endearing. So there you go, ladies and gentlemen. As India continues to attract attention from investors around the world, conversations like these help us examine opportunities and trade-offs that accompany this evolving landscape. Thank you to our leaders on stage for sharing your insights and perspectives. Ladies and gentlemen, do not go anywhere because we've got a stellar lineup coming up in a few minutes from now. Please join me in thanking our panelists and moderator. There's nothing like the solid round of applause which keeps everyone motivated. Thank you, ladies and gentlemen. Thank you to our moderator as well. I request our panelists to kindly take their seats as well. Ladies and gentlemen, moving bumper to bumper to our next segment. Thank you, gentlemen. Thank you. Artificial intelligence is the technology story of the decade, and for companies operating at India scale, the challenge extends beyond adopting AI. Now, the real challenge lies in applying this technology to solve real-world problems for millions of customers across diverse geographies, behaviors, and economic realities. The next generation of India's digital champions will likely be defined not by technology alone, but how effectively they combine innovation, execution, and scale. Our next panel explores exactly that. Our first panelist represents one of India's most influential digital commerce platforms. As head of AI and machine learning at Flipkart, he plays a key role in shaping AI-driven systems designed to optimize consumer experience at one of India's largest technology-led consumer businesses. Please welcome Mr. Sameer Shah on stage, please. Hello, sir. Great to have you with us. Please take your seats. तालियों में कंजूसी कभी नहीं करनी चाहिए दोस्तों, ये मैंने सुना हुआ है. Our next panelist is helping redefine how millions of Indians access credit. As co-founder and chief financial officer of Credit Bee, he has been instrumental in scaling a business that leverages technology and data to improve access to credit for millions of consumers across the country. Please welcome Mr. Vivek Veda on stage. Hello, sir. Lovely to have you with us. Our final panelist is helping solve one of the most important challenges in India's electric mobility ecosystem. As co-founder and chief executive officer of Battery Smart, he has helped build one of India's largest battery swapping networks, supporting the rapid adoption of electric vehicles through innovative infrastructure solutions. Please welcome Mr. Pulkit Khurana. There you see all of them on stage, our distinguished panel. May I invite Mr. Pritish Kandoy, co-head of investment banking at ICICI Securities, to kindly join us on stage and present a bouquet to our distinguished guests. You know, the world should know that we are here for this panel discussion. Come on, thank you. The awesome threesome on stage as well. Looking forward to this conversation, ladies and gentlemen. Of course, we've got our moderator also coming up, who I'm going to be introducing you in a few seconds from now. Thank you, sir, for presenting the bouquet as well. Now, moderating this discussion is a legendary voice in consumer markets. He provides the long-term lens needed to see where the landscape is shifting next. Please welcome Mr. Manoj Menon, Head of Institutional Equities Research at ICICI Securities. Over to you, Mr. Menon.
Is it mic'd up? Yeah, it's loud and clear. You know what? We were chatting for about half an hour prior to the session. I never really thought we'll actually start the session actually with a thank you note to the gentleman who actually asked the question on AI. It actually essentially helps us to move completely seamlessly into this chat. So the way we are structured largely is to start with a fair amount of generic sort of questions, and then we'll try to get real-life examples, because we are truly blessed to have a very diverse set of panelists out here. One representing consumer tech, mobility tech, fintech, right? And I'm a generalist. So I think hopefully you'll have something to take away in the next 45 minutes. Just to start with you, Samir, right? What are your thoughts on, let's say, the readiness of the AI ecosystem in India, right? Or let me flip it differently. You heard the question which our good friend asked a little earlier. Would you have a response to that, about India readiness, etc.? That will be a good starting point.
I love the response, first of all. So it was a great response, and I'll tell you what. I believe we have about 1 billion internet users. We have the strongest DPI, the digital public infrastructure.
Sure.
Right? I have worked in Aadhaar for 10 years myself. So we have Aadhaar, we have UPI, we have ONDC. We have a lot of stuff built in India. AI presents a unique opportunity. It is actually helping us integrate it at Flipkart. It is helping us integrate AI in various product cycles. It is not an independent, standalone technology. It is actually being integrated in our discovery, personalization, customer support, seller growth, and lots of things. I believe necessity is the mother of invention. It is extremely important right now to get the most value of AI at the application layer. And if there is a need, there will always be innovation. So for example, in the field of voice, multilingual AI, we have now started doing a lot better as a country. There is a lot of innovation happening. So in case if we are able to get AI into the depth of every single product what we are building, I'm pretty sure we have not missed the bus. We will be able to innovate and innovate really well. So I don't believe there is any need to build AI just because we want to build AI.
Sure.
We have to make sure that it is very useful for us, and innovation definitely will be around the corner.
Understood. Just to follow up, Samir, so essentially what you're saying is that of the 5 layers of AI, let's say starting with a power manufacturer or an equipment manufacturer till the eventual user who will be using it for a business case. If I understood you correctly, you're essentially saying that India will be at the, let's say, the other end of the spectrum where we'll be more of users of AI in businesses? Is that the way to understand?
I think what I'm saying is we have the unique blend of having humongous, number of people use internet, right? We have a very strong DPI.
Sure.
I think we are at the cusp of getting the most value of AI. And the moment we get the most value of AI, wherever we will have hindrances, for example, how many countries have the number of languages what we have, right? How many of them have the dialects what we have? And whenever we are using AI and we use it and we face hurdles, innovation is going to be around the corner. We have seen it already, right? We have seen so many different models coming out of India, which are helping us, converse with our customers. There are people who never used to use, e-commerce, for example. Now they're able to come, they're able to talk, express themselves in the language they like. They're able to switch languages, and we're able to support it. It is not because we have adopted AI, we're also building AI. So I feel, innovation will always be around the corner when there is a humongous adoption of AI, and that is where the value is. So I don't think we need to be worried about or paranoid about whether we are builders. We are going to be builders. We are already building where it is needed rather than building for the heck of it.
Loud and clear. Vivek, your perspective, please.
Yeah, I just want to add that, we don't have to be in the race of being number one, right? Because that definitely we won't be able to achieve. Because the kind of investments we are looking at, the kind of power consumptions, the kind of infrastructure what we are looking at. But definitely if we look at the use case, there is a humongous opportunity what we can do it. And definitely look at the tech stack what we are having, right? with JAM, with UPI, with the account aggregator. We have the complete tech stack which is ready. Now we have to just look at the use case on how the AI can help it to reach to the masses. Now think of a situation, language is a major barrier today, right? We are used for any of the apps coming in, say in English language or in Hindi language. Now with the AI, the customer can interact in any of the languages what they want to and can get their problem solved. So that is the larger use case what we have to look at rather than just looking at whether we should be in the #1 position, because that is not possible. But yes, there can be a lot of use cases with the kind of population, with the kind of demographic dividend we are having. I think there can be a lot of use cases which can make the life very easy, especially using AI.
Sure. Pulkit,
I think the gentleman in the previous panel articulated it really well in terms of we not being the ones who invented processors, and maybe that part of the value chain was not captured by our country, but the downstream benefits were captured. If you actually think hard about it, that has been true for various sectors in India. The other example could be smartphones themselves. The smartphones, even today, we are basically just manufacturing downstream, but we did not invent the IP, nor did we capture the original value that, let's say, an Apple or a Samsung did. But all the downstream applications, businesses, and models, as well as UPI and other things that could be built on that infrastructure is something that the country could benefit from, and multiple businesses as well as a lot of new age companies like us, or in fact all of us, were created because of that. Similarly, the same thing even happened in hardware when it comes to, say, solar. We are today one of the largest renewable generating company because of the demographic situation of our country, getting a lot of sunlight, we need more energy. We were not the ones who actually invented the modules or the wafers or the technology. Even until today, we are major importers of that. That is also happening in EVs. The cells are coming from China for most of the world. That does not mean the country will not benefit by adopting those technologies. I believe it is too early to say that the value has been lost. In terms of us not able to capture what is possible by just missing the LLM wave. There is so much more that a lot of us will not even imagine that could happen in next decade on the top of AI.
Sure. No, thank you so much for that I think opening insights, I would say, and then more to come. Look, I think all of us are in the business of selling. For example, my industry is called sell side, right? I mean, so we also sell ideas. So, for example, consumer tech, mobility tech, logistics. I think it's all about selling. Generally, tell me, in your opinion, right, as AI adoption, gets, let's say, bigger in India, what are those aspects, businesses, which actually probably would use it the most? Whether it's your industry or your career, your observations, etc. Right? Just beyond your industry, which you could talk about, the top 3-4 use cases, which industries would have?
So, sorry, just to ask a clarifying question. You are asking this in the in the business we are in, or in
including and both, right? And what you observe beyond your business, because again, the objective here is that we got 3 diverse business leaders sitting here. Whether it's in your business, you will anyway touch upon later, right? In your business, outside of it, in your observation, where given the stage of evolution in India at this point in time, you think things could look very different in 5 years' time.
So I think one of the biggest use cases we are seeing, right? And by the way, AI is getting enabled. Speaking on behalf of Flipkart, where we are using AI, it is being integrated in every single part of the business where we are working. For example, there was a time when people used to come and use keywords in search. Right now, customers have started coming and trying to say, hey, by the way, my daughter's birthday is coming, 12th birthday, and what should I do, right? And there you go, you are going to be able to convince them that what should they buy, and how much, what are the return gifts they will need to buy, whether there is an event to be planned. So it is basically becoming conversational. At the same time, customer support, seller growth, there are questions coming in, what happened to my last return order? And you need to be able to understand what the customer is going through, empathize, right? Try to understand every single aspect of it. I believe, when sellers come, they want their catalog to do really well. So can we enrich the catalog, right? Can we make it, very, very relevant to the customers? So I think the use cases of AI span across the breadth. there are, like I was saying to the other question when I responded, there are people coming who have never used e-commerce, and now they want to use it because they now know that, we can understand them in the language and in the modality they like. Earlier, they had to type it in. Now they can talk, right? They can upload an image. And all of this is going to be, is becoming possible because of AI being used. Just one caveat outside, right? While we know in commerce lots of use cases, what about our day-to-day life? I come from Bangalore, I think so is most of the panel here. Traffic, right? There is one thing in the morning and the evening, day starts with traffic, day ends with traffic. Couldn't AI be used to solve traffic problems?
Right.
I think there are enormous use cases, and they're all looking to be realistic now. Earlier, there was a thing that, okay, can technology help? Now it seems like it is going to be at the cusp of it, right? So AI is going to be able to help solve a lot of problems around us, which are very relevant to us.
Oh, that's quite interesting, actually. So are there startups working on something like traffic management? I mean, I was not aware of this, actually.
So there are lots of challenges online to be able to solve, traffic problems. I will be surprised, if there are none of them working on that problem, because at the end of the day, where are the, where are the points of, traffic congestion. Right, how much time the signals are. Many of the the lights are not smart enough. So you could actually look at the entire layout and figure out better ways to manage the traffic, how one-ways could be planned. Right, earlier it needed a lot of expertise, right, which is like very, very domain-centric. Now, with the age of AI, I believe a lot of things could be possible, which was not earlier.
Super, Vivek.
Yeah. So let me I think what my panelist said is really something which AI can help. But let me give industry-specific way on how I look at it. Two major industries, one fintech, which we are into. I'll touch upon that in the later phase. But I think on the education side, AI can act a lot of benefit to the people. Just I was reading somewhere that IIT JEE, which is one of the most prestigious exam, with the AI model, the paper was solved in 2 hours, right, as compared to the 6 hours given to the student and everything. Now think of a situation, earlier to enter into this course, one has to take coachings, which is not accessible to everyone. There's a huge expenditure what need to be done. Now with this, AI, you have the papers available, you have the interactive sessions available. So a mass student who still can't afford that kind of a coaching can at least start the preparation and take it to a certain level before getting into the formal channel. So somewhere that's the kind of tool what we are developing to help, reach to the masses. Quickly on the fintech. So just to give you an idea, we at Credit B, we are one of the largest digital lender in the country. When I say largest, I'll give you some numbers. We have around 80 million app downloads. We have covered or we have given loans to 18 million unique customers. Further to elaborate, every day 60,000 people apply on my app for a loan. Now think of a situation, if this kind of a public stand in front of a ICICI bank branch, you need to call the agencies to manage the crowd. So 60,000 people, unique customers apply on my app to take the loan. So what I mean to say is that somewhere we bought that disruption and today we became one of the largest digital lender in the country. Now further to add, how AI can benefit. Today, our app is available in 1 language or 2 languages. With AI, we can reach to the masses who don't understand English but can use the app, apply, work on it, navigate to the app, and apply for a loan. So easy. We can guide them, we can instruct them in the language what they are looking for. So there are various use cases which can help to make the life of a person easy just by using the tool very judiciously and responsibly.
Pulkit, anything to add?
I'll just take a step back and try to explain how I have been explaining it to myself. I think the best way to think of this is that there is an exponential curve, and it is always hard to follow an exponential curve when things happen. But the kids who are born today cannot imagine what smartphone penetration looked like and what it could have done. But a lot of people in this room can recall how that happened. What happened with smartphone and internet was that the information highway got created both way, which made it a lot democratic to avail information and give information. So when Credit processes 60,000 applications, it is because they can collect all of that information in parallel because of smartphone and internet. Why I'm saying all of this is, with AI, all we have to do is replace flow of information with flow of tasks and intelligence, right? So earlier, businesses got created with smartphones and internet availability that could relay real-time information at a broader space. Whether weather apps came, then listings came, and then commerce happened, right? So those businesses got created because now it was very easy, cheap, and convenient to give or take information at a very large scale. Now replace that and imagine you can do thousands of steps in parallel without enough cost or people for which you needed people. So everything where there are repeated tasks, where people are needed, or machines had to do that in a step-by-step manner, all of them will get replaced, which means a lot of business models and the way businesses work will have to be reinvented. It would take a few years for everyone to catch up and start doing that for all of us also in our businesses, but that has started to happen because it is possible today, right? For example, what we do is that we are a battery swapping network. We operate almost a gigawatt hour of batteries. These are like 3 lakh batteries, which 1 lakh customers use every day and swap. And we generate a lot of data from these batteries, whether it's location or where are they going, and we operate this in 70 cities today. But why I'm saying all of that is, let's say we had to have a team of engineers, data scientists to analyze all of that information. We knew what to analyze, how to analyze, but it would take certain steps to happen. Today you don't need to do that. I can pull out my phone and say, is there a battery which is not performing at par in Varanasi, and my phone will tell me which battery it is based on today's data or historical data, right? Because you can process a lot of information in parallel without needing people today. So that's just an example. But that is how a lot of businesses will get disrupted as well as reinvented. And at least I assume businesses which are purely digital or doing purely repeated work again and again are the ones who are going to get disrupted the fastest.
Super helpful. You know what, in your responses, you did touch upon a lot of use cases, right? But I still want to ask you something which has been there in my mind for a while. Given the fact that you are from 3 completely diverse industries, right? I mean, so could you just think of, let's say, real life use cases which could be different, which could be same, which was like unimaginable 5 or 10 years back, let's say a machine would have solved, or rather solving today, which was like, let's say, a decade back, you thought it's like, in those days probably it's fiction, reality today.
So to me, I think so we are working in this area, right? One of the things which was completely unimaginable, like 5 years ago, was conversational commerce. And I'll tell you what. So like I said, right, customers used to come on the app, and this is known worldwide, right? Even if you look at different internet search providers, Google was you search something and you get links, right? So it was all about you search something, you get the results, you don't like them, you go back and change it, right? Yeah. And now imagine what is happening. So customers are coming and not expressing themselves in keywords, but intent. My intent is to be able to, like I said, right, there is a wedding coming, or I'm going to Goa with my family of 4, what should I buy, right? Then the question comes back, when are you planning to travel, right? So July, and then it knows that, okay, there is, it's likely to rain. So there are certain kind of products you want to be buying, right? So follow-ups happen, context gets built and preserved, so that next time you come, it also knows, a little more about you, so that it can contextually respond. Sure. There is a personalization which happens because you could actually know now what are the type of products you like, what are the brands you like, what are the price ranges you are looking in, and in different categories. So a lot of this conversational commerce was, in my opinion, like completely unthinkable 5 years ago. To top it, the modalities don't have to be text alone. You can type and then you can talk. You can talk and you can upload an image. Wow. And you can upload an image and then you can upload a video, right? Everything seamlessly can start happening, which was just in my mind at least 5 years ago, we wouldn't have thought about this.
Awesome.
So if you look at 10 years back, right, when we started this, I think nobody talked about digital lending. What does that mean is that you are not meeting the customer or not meeting the person and you are sending the money in his bank account, or a person availing a loan without even interacting or submitting the documents or data face to face and something like that. So when we came out with that model, what we realized that, financial data is just one aspect. Behavioral data plays a very crucial role in terms to gauge that whether the person really needs the money and whether there is an intent to pay the money. Just to elaborate it, think of a situation. In my app, I try to gauge the person repayment behavior and the capacity to repay based on various parameters, like how much time he's spending to fill his basic information. So for example, if you are putting your information with a very slow speed, if you are putting your phone number with a very slow speed, somewhere the idea is that are you trying to impersonate someone? No financial data involved, just based on the pattern how the person is navigating my app, we are trying to gauge whether this is the right person to give the loan or not. Other use case, think of a situation we all rely on, say, our addresses based on Aadhaar or based on electricity bill and so forth, which is one of the documents required for the KYC. But what we rely more is where is your Amazon order is getting delivered? Where is your Swiggy orders are getting delivered? Either it's your office address or home address. What I mean to say is these surrogates help us to underwrite a person in a very different manner, but somewhere in a better way rather than the traditional method. And that's the kind of disruption what we try to build in. Just to give you further idea, today, around 60% of the queries what we receive from the customers are handled by the system with no manual intervention. So you write a query, the system will answer it, you further talk to the system and the system will try to solve the problem. We are at a stage where 60% of the queries, and I'm talking about huge customer base, right? Around 50 lakh customers come on my app to repay the EMI every month. So that's the kind of customer base what we are talking. Now their problems, their queries, their questions, 60% today are answered by the system. So that's the kind of disruption what we tried to bring 10 years back and today where we stand. I think the next growth will come from the AI where we further see the disruption and we have to be ahead in the curve. When we say ahead in the curve, might be, tomorrow, today we are working in 2-3 languages, might be tomorrow the app should respond in 5-6 languages, 7-8 languages seamlessly to make sure that the mass customers is catered to. So I think a lot more to come in the playtime, just that everyone has to be on their toes to, capture that.
Super. Okay.
I think the short answer is we are barely a 5.5-year-old company. So none of this was imagined for us 5 years ago. But at the same time, when we look at AI, I think most of the use cases that we have been able to adopt have been either identified or developed in just last 2 years. For us, what that means is a gig worker driving to a station even without a smartphone, their face getting processed on the edge through AI models to authenticate which customer is coming in, which battery he must have brought, what is the state of health and charge, what he should be charged, and then returning the right battery to him on that exchange. And we do this 30 lakh times in a month. And we do that, every transaction happens under 1 minute. So all of that is only possible, which we couldn't have imagined that we would be able to do so many transactions of physical assets on the ground without having access to that kind of data and information at all times. But at the same time, the fact that we can sit in one central office and monitor every asset and pinpoint its health conditions every 15 seconds is also something which is only possible today with the advent of AI at the speeds at which you can reiterate on the data that a battery generates. We also process 50 lakh kilometers of data every day. So that gives us heat maps of where these drivers would likely go on their next delivery, where are they going for hubs, where are they picking up their cargoes or passengers or whatever business they are in, where do they live, where do they eat breakfast, things like that. And that helps us a lot in planning out a very optimized network in terms of where should the next station be opened, what should be the size of battery capacity at that station and so on. But the bottom line to put all of that is, today with lot of workflows that can be automated, what that means for a company like us and other companies also is that you can grow at a much faster pace because the speed of deployment of your features, of activities that you want to do has been cut short drastically. We we are able to grow by 60% in last year without adding anyone in the headcount. And that itself speaks on the efficiencies that AI is unlocking at most of the new age companies who are able to adopt to it.
Just, it's been super helpful actually. So just pushing the envelope a little bit on the same thing. A lot of the business use cases you spoke about, are there any unglamorous outcomes, solutions, not necessarily customer facing or consumer touching, which you stumbled upon, using AI and machine learning?
I think there are tons of them, like I said, right? So AI is being used across the funnel, by a lot of companies, including us. At Flipkart, think of assortment planning, demand forecasting, inventory optimization, right? And so many other use cases, which our customers don't come to know, but they all happen at the back end. Supply chain, transformation. So lots of those use cases are being powered, by AI. We are using AI to, do all of these things much, much better than we could have done earlier. Of course, the fancy use cases are the ones we all see, yes. But at the back end, a lot of things are also getting powered. At the same time, I wanted to make sure that we, realize that, AI is not a magic bullet to everything. So we also need to be very careful. At times, there are very, highly sensitive areas where human involvement becomes important, right? We don't want to be, depending on AI solely, and making sure that there is a human involved whenever sensitive cases are handled, or any other, such, let's say, for example, payment fraud, right? Or something like that happens. You want to be ensuring that there is a human in the loop. But having said that, lots of, such not glamorous, but at the back end use cases of AI.
Super.
For the fintech industry, I'll say that, data crunching, what we do in the back end, which customer is not aware of. So for example, today we are using a lot of AI on the collection processes. So what does that mean is that one is ability to pay and second is intent to pay. Ability to pay can be, assessed by the traditional methods, say your, bureau scores and so forth. But intent to pay can be assessed by the models what we have developed. So for example, the way the customer is talking about, right? The way the customer is responding to the systems, that gives us an idea whether there is an intent to pay or whether there is a, not an intent to pay. Another thing one has to look at is that there is no emotional attachment attached to these models. So what does that mean is that the models can talk to the customer in a similar tone, similar fashion, multiple times, where if there is a human interaction, after 2-3 interactions, the tendency is to lose the, temper and say that, okay, why don't you are paying and all those things. But when there is a AI bot running and talking to the customer, it's the same language, same temper, same thing what we are talking about. And the customer is not even aware that whether they are talking to the bot or they are talking to the real person behind it. So somewhere, a lot of these things, and then again, what time a customer need to be called upon. All these things based on the past experience and so forth, the system can decide, okay, this customer need to be addressed at this time based on this language and so forth. So somewhere all this backup preparation is done, and which the customer is not aware, and then the customer is having a good experience just because the way it has been handled by the system.
Awesome.
I think I've already covered most of the use cases. For us, it is mostly back-end, given we are a physical infrastructure at play. But at the same time, before passing on, I'll just say some of the businesses that can never get disrupted by AI are the ones which are physical in nature, at least for now, until we see humanoid AIs come in and do all of that. But at least those businesses are slightly away from disruptive forces of AI in the short term.
You know what, actually, I just want to still continue on the use cases because real-life examples are always super helpful. Just changing, track for the time being, and then we'll definitely come back to this, because I can't. Could you just talk a bit about, anyone can actually take it, AI and data security. AI and data security, right? Your perspectives, real-life situations, global case studies, anything value-add?
Yeah, see, I think, AI presents a lot of opportunities. At the same time, also exposes us to a lot of risks, right? And it's important for us to be aware of it. Right? For example, we have all now been discussing about various different places where AI can add value. At the same time, it also enhances the threat vector.
Sure.
Right? Identity theft and so many other things which were not possible earlier, so easily possible earlier, could happen now. Having said that, AI is also something which we are using very actively to, in fact, detect, all of these different, threats which are coming in, anomaly detection, right? Spoof detection, right? So a lot of places where AI could actually be used to mitigate the threats. At the same time, in my opinion, our regulatory frameworks like DPDP Act, which has come in, right? It makes sure that we understand what data security means, right? What is a user consent? How do we use users' data, right? Where is it right to use it? Where it is not right to use? Where is it okay to share? Where it is not okay to share? So a lot of those constraints have also come in, which is a very, very welcome thing, because that also gives a framework for the entire industry to work with, right? At the end of it, like I said earlier as well, so we have these acts, regulatory frameworks which have come in. We have AI being used to mitigate threats. At the same time, a human involvement, I cannot stress more, is also extremely important. There is a mad rush, right? Can we get everything automated? No human. I don't think that is right. And we are also being very careful about that. Whenever required, wherever required, a human involvement is necessary. We should be, open to it, and we should be using it. So with all of this, I feel we'll be in a much safer environment than ever before.
Thank you.
Yeah, so I think two major threats, it's a double-edged sword. So two major threats, one is definitely impersonation, and second is data theft. There is a classical case where, a person impersonate as a CFO of a company and directed a treasurer sitting in another part of the world to transfer some millions of dollars by just impersonating a office conditions, similar voice, and all those things. So these threats, are becoming reality now, where there is a actual monetary loss, reputational loss, which is going in. On the other way, if you have to look at it, AI is helping to solve a lot of these threats in terms of now you can fix the bug at a real time. You can run the checks and balances, fraud checks and balances 24/7 on a real-time basis. Plus, there is a lot of guardrails which have been put in by the regulators now. So, for example, there is already a paper in discussion that any videos which are AI generated and all those things have to be clearly marked that these are AI generated videos or talks and whatsoever, so that the person knows about it and can act very judicially upon it. So I think if it has to be used in a judicial way with the guardrails what has been put in, it can be a boom. Otherwise, we have already seen in past companies losing reputation, companies losing money, just because of the new tech what we are having in our hand.
Super.
I think this is one topic where at least I feel very worried what is going to happen, because as rightly said by both the panelists before me, is that we are using AI to fight AI, and one of them is trying to breach into the systems, and we are using the same technology to defend the system. So it's AI versus AI. Whereas in the past, whenever there was a new technology, it was typically someone else or some other body or tool that was required to fight that particular threat. So I am not sure what the future would look like for this threat to go away. A lot of governance and regulation will have to evolve faster than the threat. And at the same time, it would hinge upon those regulations to control the penetration that AI could do from a data security standpoint.
Sure. Thank you. I just quickly want to move into the last lap. Three specific questions to all three of you business leaders from your industry. Starting Vivek. Now, collections is one of the most, collections in your industry is one of the most, I would say, activities which has got a high human interface, right? Is there anything which you could do in machine learning AI to help improve your collection efficiency?
Right, definitely. So over a period of time, if you look at our business is doubling every year on year, but our collection manpower has remained stable or stagnant. We are not hiring more and more people. So definitely that is happening because of the AI tools what we are using. And as I said, today, which customer we have to call on day one, which we can wait for some time, everything is decided by the system. There's nothing like a person taking a call that, okay, I have to collect an EMI from 5 people, let me call him or her first, and then let's wait for it. It will be a system which will decide whom to call, when to call, and how to talk about it. Everything will be a system driven. So and clearly that is evident where the business is increasing, but not the manpower. Otherwise, it's a directly proportional. If your book is increasing, you have to hire more and more collection agent. So that we are able to address just because of the AI tools what we have developed into the collection ecosystem. However, the only drawback is that the personal touch or personal touch what is required, that cannot be touched upon by the AI. So for example, if there is a real hardship for a person, and because of that the person is not able to pay, I don't think so that AI will be smart enough to gauge that and work on it. So there the manual interventions and all those things are required. But otherwise, yes, it has helped us to manage the manpower, help us to efficiently cater the customers, help us to, make sure that the customer satisfaction is at the maximum level, in spite of it's a dirty call of a collection or a bad call of a collection, what needs to be done.
Super. Pulkit, actually, in the mobility tech side of it, right? So, is there something, again, from a consumer side of it, you could actually have done or, in the works to do? One example I could think of is actually the range anxiety, right, of the state of the health of, the charging networks, etc., from a consumer point of view. Any such thing? I don't want to give a leading sort of a thing, but yeah, any such thing, because that's something which I was reading that kind of, so which is where AI is being helpful.
Yeah, I think as the technology further improves and a lot of OEMs as well as battery manufacturers would be able to integrate this on edge, on device, within, say, our cars, vehicles that we drive, range anxiety would partially be solved in the sense that you can optimize when to, how the battery is getting discharged from a state of charge perspective. However, what you said about state of health is very different, which is the deterioration of the life of the battery, when does it need a replacement, and how many more kilometers are left in life of the battery and so on. I think both those things are already happening at certain stage, but they are not as widely being used for the consumer today, given the lack of awareness, and because it's a new category anyways, most of the EVs are new on the road, haven't seen the degradation that they are likely to see eventually. But for someone like us as a enterprise and having, say, 300,000 assets, this is our bread and butter, because we will not be able to live with a poor utilization or poor health of any battery in the network. So we had to develop all of that to ensure higher utilization and life of every asset that we use, and also solve for range anxiety of a gig worker who might not even understand the term range anxiety per se, but ensuring that they reach the swap station when they have to, rather than getting stuck on the road ever. So that getting into hands of consumers, I think, is slightly away. But at the same time, every large enterprise who is working on battery tech would have to kind of build that at some stage.
Super. Samir, the final word to you, actually, representing a consumer tech business, 500 million plus users, right? Multiple languages. Where do you put actually AI's help the entire industry, not necessarily your company, in truly democratizing the language barrier, right? Particularly, in parts of India where, it is absolutely relevant.
I think it's one of the biggest problem we are trying to solve as well. See, take a customer who's coming from a remote place anywhere in India, right? What are the nuances? First of all, we have seen that if they're not used to typing, they want to talk, right? And then they use a language of their choice. They flip languages, right? What we call code switch, right? They will have different types of interruptions. I don't know how many of you have seen this. When we were trying to use different AI models to understand what the customer is saying and even be able to understand the interruptions, many times interruptions actually are not meant to be interruptions. So for example, somebody is speaking something, and guess what? A lot of models will start thinking of them as interruptions. They will wait, right, for the customer to speak. And the customer is not speaking because they're just nodding to what you're saying. So there are lots of such nuances, right, which actually come from the field. Another thing, right, in India, if somebody is talking, there will be like two other people talking in the background, right? Almost, similar voice. Yes. And these are all realities of, where the customers may be coming from. So any tech, any AI should be smart enough to understand interruptions, to understand what is not meant to be interruption but comes out as interruption, right? To understand how to isolate noise, to understand how to isolate the voice of the customer who is speaking and ignore, other people who may be talking in similar tone and, similar, magnitude, right? Like the customer is speaking. Ability to handle switches of languages, right? And then able to respond. And not only understand the switch, but, ourselves modulate. Right? That, so let's say if they are switching from Hindi to Tamil, we should be able to respond back in Tamil. Right? Wow. And all of this while maintaining the context of what the user started with, understanding the intent really well, and personalize. So even our search, our recommendations have to really powerfully understand what the customer is saying, because guess what? The way they are speaking to us is very different than the way regular customer would have come on the app and typed what they were looking for. So entire funnel has to be upgraded, right, to be able to understand these nuances. And this, I believe, is one of the biggest area of investments, and where AI can be very, very powerfully leveraged by us.
Oh, thank you. Thank you, Samir, Vivek, and Pulkit for, honestly, I didn't expect this to be this much jargon-free and real-life, examples, to enlighten us. Super thanks. I think we got about 15 minutes left for your participation. So the floor is yours now. Thank you.
Hi, my question is to Samir. You all have given very good insights on the use of AI in various aspects of the company. Now, what is the percentage of labor that has been replaced by AI? And do you think that the replaced workforce is getting trained to handle AI? And if not, is it increasing the unemployment? That's the first question. And the second one is that there is a big gap between the technology that is adopted in India and the technology of the US. So by the time the companies in India adopt and implement the AI, there could be some technological innovation in the US already, which makes this adoption obsolete. So that the amount of money that goes on into this, building this AI infrastructure could just become irrelevant, and you would have to adopt something new from the US. So I wanted to know your thoughts on it, and how well are you geared up for that?
I think excellent question. I like the second one because I'm a technologist a lot more, but I'll respond. I think one of the things which I did not mention earlier is, right, there are also people saying, by the way, will Gemini become, or the ChatGPT become, the commerce? I think what people are not understanding is that while AI gives a beautiful interface for customers to talk to us, right, the real deal is the commerce layer underneath. Right? And commerce layer underneath is where, our supply chain works, where we handle deliveries, right? Where we, answer to your questions of expedited delivery, where we, take your return requests, where we, process your, installation requests. That is in my opinion, the commerce layer underneath, which is very powerful. So I see this as an opportunity where it is not like a small pie where we are trying to replace each other, rather the pie increasing significantly. If you even look at, right, and I think, this is a forum filled with a lot of finance guys, so I should not be saying, but look at how many companies in the US in the last couple of years have become $1 trillion companies which did not exist. Yeah. Right? So it is not like, people are replacing each other. I think it is the pie is increasing. We can do a lot more than what we used to do before, right? And we can do a lot more business than what we could do before, because that's the power of AI. Addressing the second question, I think it's real. Every other day, I mean, ChatGPT was the talk of the town last year. Then came Gemini. Now we are talking about Claude. And God knows, right, things are going to keep changing. I think as a builder, right, we need to be very focused on what we want to build. What is the problem we are solving? Who is the customer, right? What is the value add we are doing to the customer? If we lose track of that and build AI for the heck of building AI, I think we are going to be in a bad state. But if we are building AI to solve real problems, at least I believe we will not have a problem like, competing with others, rather building what works for us. However, if we are using AI, right, what becomes extremely important, because technology is changing by the day, right? I was telling someone, you go on a leave for a week. It appears like, you have been out for 6 months. because things have changed, right? In that advent, what we as technology companies have to do is build really rigorous evaluation sets. Wherever we are adopting AI, what if a new technology comes which is better? Could it come, and get deployed in a record amount of time, right, in an automated manner, rather than, we're spending 6 months to evaluate it, and then thereby another company has come, another model has come, right? So we have to make sure our technology layer has adapted, right, and is automated in a way to evaluate different technologies, which are coming by us, and be able to upgrade and update, on the fly. I think that is where I believe we have to be with the way the world is changing so fast.
Yeah, this side. So I am coming from perspective that all the three of you had created this business when probably AI was not in the picture, right? And whatever I heard from you people is that you people have seen amazing efficiency gains in your back-end processes because of the AI coming into picture. I am just wanted to pick up your brain in terms of what level you see that the cost of token, right, becomes costlier than the extra manpower which you may want to have in your business, because that's where actually somewhere you will have to figure out, because that's the cost, right? I think assuming that you are getting the cost. So that's one probably question. And second is this, that which are the new businesses which are probably only getting created because of AI? Because I heard a lot of businesses getting huge efficiency gains. But where are those businesses which are probably now only coming out of AI is something which I want to have your perspective.
Anyone? Shall I take a first shot? Maybe I'll hand it over to you. I think new businesses, I mean, I just read a report from NVIDIA, right? So AI factories. Where did the concept exist earlier, right? And earlier there were obviously data centers. Now you ask anyone what does a data center mean? It is no more that you have CPUs, you have networking, you have GPUs. It's all an integrated unit. If everything works at the same efficiency, then you get the most out of it. So to your question on tokens per dollar or tokens per rupee, could it be tokens per watt? That is the new metric being used by everyone as well, right? And to the second point, yes, of course, AI models are expensive. At the same time, there is a breadth of models available, and you could have your own AI models, right, which could be solving your problem in a way more efficient manner than using a model which is built for the world but doesn't solve your problem. So I think we have to be smart at figuring out what works where, rather than building anything and everything, for all our use cases. I think the moment we start making those smarter choices is when AI becomes economical and, we can actually get a lot more out of it.
See, how I see it is that AI can be enabler to your business, but cannot be your business, right? So what does that mean is that human manpower, human interaction, human data support, all those things will be required and will continue to be required. The only thing is the way we are dealing with the information, the fast we can process the information is something what is changing. So for example, whether we require the tech people going forward, answer is yes. But with the size of the business growing, whether we need to hire the similar quantity of the people, answer is no, because the efficiency is increasing. So for example, today if there is a code which need to be tested and it is done by 5 people, might be tomorrow when your business scales, the code deployment increases, those 5 people can only do the same kind of work what we are looking by using the AI tools. So how we see it is, it can be an enabler. One has to be, fast to adapt it. But at the same time, human intervention, human skills, human emotions will continue to remain in the business to run the business for the longer run. I think nothing can replicate it or change it.
Super. Thank you.
I think I totally agree with the analysis that you're pointing to, because that we are at a point and juncture where we will have to start evaluating the trade-off between what kind of tasks do we really want to automate at the cost of what we are going to pay for the tokens, right? Especially given there would be a lot of tasks in the Indian context where the labor is cheap, Do you still want to automate that and burn tokens, where the tokens are also subsidized today, which might not be the case forever, right? So because that will change, I think from a financial analysis and projection standpoint, the CFOs of the organizations of future will evolve to understand the trade-offs in terms of budgets today, where it is people versus efficiency. It would be token versus people versus efficiency, right? So I think that will change very quickly for most of the organizations.
If I may just, I remembered one more, use case to your point, right? Where do you see new things coming up? I don't know if it is new, but, I discovered lately there was an app built by someone, right, for investors who are naive, right? But they don't want to go to any investment advisor. I'm sorry I'm saying this in this forum, but the app was simple, right? What they had created is, there is a Rakesh Jhunjhunwala profile, right? A persona. Then there is a Warren Buffett persona. There are so many personas created. And now it also scans all the stocks in the market, right? Whatever analyst report has come, right? Any Twitter feed on that stock. And then eventually what it does is, let's say I like a particular 3 people I follow. So it will get every one of those stocks vetted by those 3 people, the way they have been investing in the last 3-4 decades, right? And then they will score the stocks. And then they will say, oh, by the way, if it was Warren Buffett, he wouldn't have bought because this is not value, right? And so on and so forth. And guess what? I mean, the number of subscriptions I saw that person sold, it was crazy. So I think newer and newer such opportunities are coming up. And, I think, in my opinion, the opportunity is like just infinite here.
Just on a lighter note, if things go wrong, so there's a stock recommendation from an ICICI Securities RM, and things go wrong, at least you can call him and scold him. But not in the case of AI. You have to live with the losses. So that's another differentiating factor, right? So both the things will work.
So Samir, just curious actually. So, the example which you just mentioned, right? So if you recall the Warren Buffett style of investing earlier, he would have never bought an Apple, which he did a few years back, right? Or he would have never bought a Goldman Sachs. So I don't know whether the learning is happening at pace with, the change of views by those legends also.
Sorry, you're saying learning.
What I'm saying is, let's say Warren Buffett would have bought, let's say, Coca-Cola, 30 years back, when he wanted to say, no, I'm okay to now buy a technology company. I'm okay to buy a financial institution, which was not really the thesis. The initial money was made.
I cannot agree more. And by the way, to his point, I agree. I mean, I wouldn't go to such an app, but I was just saying, things are coming up like by the day.
Yeah.
And to your point, just think of it, right? So there is a Warren Buffett, and then there are 10 other people, and you can eventually average the score, and you can say, this is my area of liking, this is not. And it just becomes like, the opportunity is infinite, and what people can try creatively is like just, in my opinion, marvelous.
Fair enough. Any last question, please? Almost out of time.
I have like 2 questions. Excuse me. Here. So I have like 2 questions. Question number 1, partly maybe answered, is that do you now calculate the ROI on the investment at all? Or is it too early? If yes, then when will you start kind of calculating the same? And the second part of the question is that do any of you use any of the mid-cap Indian IT players or any of the IT players in order to give you the AI solutions or give you the IT products based on those AI solutions? Because a large part in this room are secondary market investors. They themselves are holders of number of mid-cap IT stocks and the large-cap IT stocks, right? So I'm keen to have your views on that.
So I'll take the first one, the ROI question. Of course, I think goes without saying that ROI is extremely important, but I think the only thing is it depends on what you're trying to do. Let's say you are in an exploratory journey on certain things, right? At that point in time, you want to try it out, right? Because optimizations can, at the end of the day, we are all Indians, right? We know how to optimize the heck out of anything what we build. So if you are able to build something which is credible, which is what we call as a minimum lovable product, right, or a feature, then you can always optimize. So there are certain places where you look at ROI from the beginning. There are certain where you want to build first, figure out whether it works, whether customers are loving it, and if yes, then you figure out the ROI question. So ROI is extremely important. It just depends, right? I think on the building AI solutions, right, we are ourselves doing it. We also use a lot of different models. We are also using, if let's say there is an area of expertise available, because at the end of the day, we are in the business of commerce, right? So we want to run And for us to run, if there is something good coming from anywhere, right, we are more than open to, leverage it.
See, I'll say that, I think that's the differentiating factor when we say that we are still lagging behind a lot in terms of the investment into the, AI world and so on and so forth. I think one of the main reason is because from day one, we have to start looking at ROI, whether this investment will generate the ROI, and there are many analysts sitting here. The first question is, okay, you are making this investment, but what kind of ROI you're looking at it? Correct. And then at the same time, we also say that we are lagging on the investments because you see how US is growing, how China is growing on the CI investment. So I think it will be too early if we start counting on the ROI formula on this investment, because everyone is learning, right? Be it the small or large IT companies, be it the companies in US, China, and so on and so forth. The only difference is the capacity, the investment there are really huge, which we still are have to make and do to reach to that level. And that's why I always say that let's not follow the race of being the number one. Let's look at the use cases and try to deploy it, which can help your business and improve your ROI in the longer run. So that's my 2 bits on this question.
I would agree. I mean, it's just too early to say that. There is obviously a play budget that the team gets to try out things, just in the hope that it would turn out into something. But for everything else, it is very evident when it starts adding to efficiency of your manpower. If the person is able to do 5x more work, you are actually eliminating the need of future hires. So that justifies the investment eventually.
I think its time's really up. I think it's been flashing for a while. Thank you so much, Samir, Vivek, Pulkit, and to the lovely audience for fascinating questions and eking out those wonderful responses. Thank you, everyone. Appreciate it.
Listen, ladies and gentlemen, we've got an epic lineup. Speaker coming up in a few minutes from now. But before that, a round of applause for all our dignitaries on stage. Please remain. Kahi mat jaiye. One of the greatest cricketers of all time is coming up in a few seconds from now. Few seconds. The most legendary cricketer we can find. But in the meanwhile, a token of appreciation for our esteemed guests to share your thoughts and perspective with us. May I invite Mr. Jaideep Goswami, Head of Equities at ICICI Securities, to join us on stage and present a memento to all our panelists, please. Give it up for Jaideep, sir. Ladies and gentlemen, do not go anywhere. एक ही क्षण में आने वाले हैं. One of the greatest cricketers the world has known. Fireside chat. Be in the hall. Don't go anywhere. Today's conversation demonstrated how India's technology ecosystem continues to innovate at an extraordinary scale. Thank you to our panelists and moderator for sharing your experiences and insights. Thank you to our panelists, moderator. What a picture. Tali bajaiye doston. My friends who are at the back, come in front and take your seats. Thank you, panelists. Thank you, moderator. I request you to please take your seats. Thank you. Moving forward, ladies